also to keep ourselves abreast, updated, and to know what's new, what's waiting for us at the next turn, and that is exactly what we are prepared to deliver today. My name is Zenia Fernandez, and it's my absolute pleasure to welcome all of you to the 17th edition of Mint Annual BFSI Summit and Awards 2025, and that is your cue for a huge round of applause. Come on. Thank you so much for braving what we call absolute peak traffic in the city of Mumbai and joining us here early this morning. Well, if I were to describe today, I'd say that, we're actually heading towards Republic Day, and very soon we'll have some nice Bollywood blockbusters on the big screen. But today, ladies and gentlemen, is Mumbai's financial equivalent of a blockbuster premiere. We've gathered here not just to talk shop, but also to reimagine, to reshape, and to rejuvenate the world of finance. Think of this day, the Mint BFSI Summit and Awards, something that, abruptly that I've been hosting for a couple of years now. Think of it as the financial world's very own Dabbawala system. It is meticulously planned, it is fast-paced, and it's going to deliver value to you no matter what. And of course, where better than the financial capital of the country, Mumbai, to host this very summit and awards where innovation and ambition meet chai breaks and candid discussions. From wealth management to climate financing, from the thrills of the IPO surges that we're witnessing since 2024 to the twists in AI-driven banking, all of the sessions that you are going to participate in are set to keep all of us at the edge of the seat. So normally as a host, I say sit back, relax, and enjoy the show, but I'm not going to say that today because it's going to be quite a thrilling ride. However, I want to take the next moment to thank all of our partners, very, very importantly. They are the ones who make events like these possible. Our partners, Zafin, JSA Advocates and Solicitors, Airtel Payment Bank, PhonePe Insurance, HDFC Pension, NetApp, Equirus Capital, Axis Bank Life Insurance, Awards Knowledge Partners, How India Lives.com, and FISDIM. May I please request you to put your hands together for all of our partners whose support we absolutely cherish. Well, all of you are physically present here, and I know we have a huge audience watching us live online right now. I invite all of you to please join me in sharing all of the knowledge and the information that we're going to receive with our online community, those who couldn't be here physically. And when you do that using your social media platforms, don't forget to use the official hashtag, which is hashtag MintBFSI2025. And you can also tag us at LiveMint so that we know where to find that wisdom. Now, I want to introduce you to a concept that we're also introducing this year, and we're very thrilled about it because we figured in the last 16 editions that a lot of us are here to meet each other, to have conversations, and so we just wanted to smoothen that process out for all of you. So when you registered, you would have received a WhatsApp message that would come to you from Mint BFSI Summit. If you look at that message carefully, it invites you to connect with other people in this premise right now. If you in fact scroll through that message, ladies and gentlemen, you will find an option that says Join Now. You can simply click on Join Now, or you can also find a 10 card on your tables. It's a black and white 10 card that has a QR code that you can scan. We have these QR codes across the venue. Scan it using your smartphone. Follow the easy steps, and you will be connected instantly to a world of opportunities, collaboration, and partnerships that are waiting to be discovered. So I really encourage you to take those time gaps between speakers and panel discussions and find like-minded people so that when you step outside during our strategic breaks, you know exactly who to speak with. As always, the show must go on, so let's dive right in. And to set the tone for today's discussion, please join me in welcoming Editor-in-Chief of Mint, whose sharp insights guide India's most trusted financial publication, Ravi Krishnan.
Ladies and gentlemen, I'm thrilled to welcome you all to the second edition of Mint BFSI Summit Awards. I know that says 17th edition there. So for those of you who are new to the story, this summit is an updated version, a new avatar of Mint's annual banking conclave, which saw 15 successful editions. Now, the financial sector industry is one of the most happening in India today. It has seen the rise of some of the fastest growing and most disruptive firms in recent times, besides being the lubricant for our economic growth aspirations. That's why we decided to broaden the scope of discussion to the entire financial services sector and not just banking as we used to do. The sector is also now dealing with some of the most urgent and complex problems facing the world today. So I'd like to take this opportunity to briefly highlight a couple of examples. Now, these are areas that are of keen interest and a focus of editorial coverage in Mint also. The first is climate change and, by extension, climate financing. We are all acutely aware of the pressing need for climate action. Indian banks now, while they recognize the importance of this cause, they often lack the expertise and resources needed to effectively finance climate-related projects. The question before us is this: how can we bridge this competency gap? How can we ensure that Indian banks take a leading role in supporting the transition to a sustainable future? That's now just not a question of business. It is also a moral imperative. So that will be one of the key panels which I'm personally looking forward to today. Another challenge, one that also presents a great opportunity, is the rise of artificial intelligence. Now, AI is transforming quite a number of aspects in the financial world, from improving efficiency to also revolutionizing customer experience. But with this rapid transformation also comes some concerns. How do we ensure that in this rush to embrace AI, we don't lose a human touch that has always been the cornerstone of banking? How do we harness the power of artificial intelligence while ensuring that people remain at the heart of retail banking? Now, this is a delicate balance we must strike, and it's a conversation which we'll be having today. Now, all of you have the agenda in front of you, so I won't dwell on the details. I just want to say that we will discuss many of the challenges that represent opportunities for growth, innovation, and transformation of this industry. I encourage all of you to participate in the discussion, ask searching questions, and take full advantage of the event. And now, to kick off things, I welcome Sri M. Rajeshwar Rao, Deputy Governor of the Reserve Bank of India, to deliver the keynote address. Thank you.
Good morning, everybody. At the outset, let me thank the organizers for inviting me to this 17th edition of the Mint BFSI Summit and Awards. I'm delighted to get this opportunity to engage with you at this event. As a regulator for banks and non-banking financial companies, I thought this could be an occasion for me to reflect on a less debated area for the regulated entities, that is their liabilities management and the challenges, attendant challenges. In flagging the mismatch between deposits and credit growth, Governor Das had previously drawn our attention to the rising challenge in this area. So I thought of wading in with a few thoughts for your consideration. The core function of banking involves accepting deposits which are usually short-term and funding loans which generally have longer maturities. Maturity transformation is thus an inherent feature of financial intermediation, and banks are strongly exposed to the associated risks. As a result, strategic management of assets and liabilities is crucial to optimize profitability, improve liquidity, and protect the banks against the various risks. Historically, the regulatory frameworks, including Basel I and II norms, had placed a greater emphasis on the asset side of the balance sheet, focusing on credit risk management and capital adequacy. This focus arises from the belief that credit defaults and asset deterioration poses the main threat to a bank's solvency. Liquidity and funding risks, primarily stemming from liabilities, were largely viewed as an issue that the banks could manage themselves without requiring any regulatory oversight or intervention. The global financial crisis of 2008, during which the banks faced vulnerabilities on both sides of the balance sheet, challenged this approach, resulting in profound changes in the banking sector's regulatory framework. During the crisis, many banks experienced liquidity crises leading to insolvencies, despite adherence to the capital requirements, highlighting the fragility of funding structures reliant on short-term liabilities. This underscored the systemic importance of liquidity management and the need for regulatory oversight beyond the asset side vulnerabilities. The policy response was a paradigm shift that led to prescribing of comprehensive global liquidity standards through the liquidity coverage ratio and the net stable funding ratio, which targeted short and medium-term liquidity resilience. It is now well understood that liability management is crucial not only for the stability and solvency of a regulated entity, but is also a key factor influencing its return on capital as well as its growth trajectory. From the earnings perspective, the spread on interest earned on loans and the cost of funds determines the bank's net income and profitability. The cost of liabilities thus has a direct bearing on the net interest margins and the earning ratios. For instance, the share of current and saving deposits in the total deposits, the mix of retail versus wholesale funding, and the duration of liabilities play a key role in determining the funding costs and therefore the profitability of the banks. Further, the stability of funding is a key to the resilience during any crisis. In this context, let me dwell briefly on the evolution of liability management in India, the changing trends in the liability structure, the entity-specific challenges, as well as the regulatory expectations. Indian banking, all of you are aware, underwent a strategic transformation with the broader economic reforms in the 1990s. The deregulation of interest rates and greater global integration made the risks encountered by financial institutions more complex and significant, requiring strategic management. Accordingly, guidelines on asset liability management were issued to the financial institutions first in 1999, with further additions and refinements in the late 2000s, covering the interest rate and liquidity risks with further prudential limits and a disclosure framework. The prudential framework in India incorporated the Basel Committee on Banking Supervision Principles for Sound Liquidity Risk Management in 2012, followed by adoption of two minimum standards for funding liquidity, that is the LCR and the NSFR. Recognizing that LCR calibrations overlooked intraday liquidity and increasing interdependencies within the financial system that could lead to liquidity disruptions affecting payment and settlement processes, guidelines for monitoring intraday liquidity were also introduced. To mitigate the concentration risk and to curtail systemic implications for uncontrolled liability of larger banks, the Reserve Bank had very early on put in place limits on interbank liabilities for commercial banks in 2007 and interbank deposit limits for urban cooperative banks in 2009. The scheduled commercial banks, that is excluding the small finance and the payment banks and RRBs, have been permitted to set up board-approved limits for borrowing in the call and notice money markets within the prudential limits for the interbank liabilities. Such liability-based concentration limits are unique to India and reflect the Reserve Bank's early cognizance of these risks. Deposits continue to be the primary source of funds for the scheduled commercial banks, amounting to around 217 lakh crores, representing about 77% of the total liabilities as at the end of fiscal year 2024. In contrast, capital funds, that is capital, reserves and surplus, and borrowings each constitute around 9% of the liabilities. The comparison of data between the fiscal year 2016 to between the period 2016 to 2024 indicates that deposits have grown at an annual rate of around 10%, aligning with the overall balance sheet growth, and their contribution to total liabilities has remained around 77%. Meanwhile, the borrowings have grown at a lower rate of about 7%, as a result of which its share in the total liabilities have declined from 11 to 9%. On the other hand, capital funds have grown at close to 13% and its share has increased progressively from 7.6% to 9.3%, indicating deleveraging of the bank's balance sheets, boosted by higher profitability and capital raising efforts. Maturity-wise, during the same period, the contribution of term deposits has declined from 65.8% of total deposits to 60.9%, while the share of savings and current deposits have increased from 25.3% and 8.9% to 29.2% and 9.9% respectively. Consequently, the CASA ratios have improved from 34.2% to close to about 39.1%. This trend may have contributed to improvement in the net interest margins of the scheduled commercial banks, which has increased from 2.6% in 2015-16 to 3.3% in 23-24. Apart from deposits, bank raised liabilities in the form of debt capital instruments such as additional Tier 1 AT1 bonds and the Tier 2 bonds. Furthermore, the banks are permitted to issue domestic long-term bonds to finance infrastructure and affordable housing, and can also raise funds in the overseas markets under the ECB route. For non-banking financial companies, borrowings are a significant source of funding, amounting to rupees 34.46 lakh crores, or 68% of the total liabilities as at the end of March 2024. Within borrowings, debentures and borrowings from banks are the main contributors. This makes the NBFC liabilities more market-driven and sensitive to interest rate change as compared to that of the banks. When we look at the changing trends and challenges, what comes out is the fact that the banks are at the forefront of providing credit to productive sectors of the economy by channelizing household savings, which currently comprise approximately 2/3 of the gross savings. Recent trends indicate a shift in the household preference to financial assets for saving purposes, leading to movement of these savings beyond the traditional bank deposits towards capital market assets. This shift is driven by several factors, including the targeted efforts to deepen the financial sector, the growth of the digital public infrastructure that offers convenient and frictionless access to capital markets, changing investment preferences due to demographic shifts, increased financial awareness, and the recent periods of sustained high returns yielded by the equity markets. Additionally, the rise of alternate asset classes, search for higher yields, and portfolio diversification have further fueled this trend. Over the past decade, the number of subscribers and the assets under management of the mutual funds, pension and provident funds, as well as that of the insurers, has risen significantly, a trend which is likely to accentuate further. While this trend may not alter the aggregate funding available for banks, it may change the character of deposits, having implications for the cost of funds and the margins for banks. Although CASA deposits have improved over the longer term, as previously mentioned, there has been a recent shift with the share of CASA deposits declining and that of term deposits, especially in the higher interest buckets, increasing. I think that has been highlighted in the recent financial stability report. This has implications for the bank's net interest margins and profitability. Lately, the banks have also increased their reliance on short-term funding through certificates of deposits, and the average CD outstandings have reached the levels last seen in 2012. Banks must, however, take cognizance of the fact that higher reliance on short-term liabilities can have its own repercussions if the market conditions deteriorate. Banks adopt distinct liability sourcing strategies based on their competitive strengths, their market positioning, and the business priorities. Large banks with extensive branch networks may have access to low-cost, stable retail deposits, while the banks with more pronounced urban presence may target the affluent customer segments, offering high-value deposit products tailored to high-net-worth individuals and corporate clients. Additionally, some banks with advanced technology stacks leverage digital platforms to enhance customer acquisition and streamline liability sourcing, providing a competitive edge in attracting both retail and corporate deposits. On the other hand, differentiated banks are seen to be having higher reliance on interbank deposits and wholesale funding. This diversity in funding profiles presents a unique challenge in asset liability management, as each business strategy introduces its own complexities in managing liquidity, cost of funds, and the risk alignment. Institutionalizing of deposits, which I referred to earlier, will bring along specific challenges in asset liability management for banks. A reduced reliance on retail deposits, coupled with a greater share of funding from institutional sources, will likely result in increased funding costs, which can in turn negatively affect profitability. The quest to maintain margins can lead to eventual transmission of increased funding costs to the interest rates on loans. This would either constrain growth of the loan book or may force the lenders to dilute underwriting standards and lend to riskier borrowers to maintain the earnings ratio. Banks must stay alert to the risks of certain practices that may seem less evident during periods of strong economic growth but could lead to serious consequences during the downturns. Banks heavily reliant on wholesale borrowings or uninsured deposits are more vulnerable to rollover risks and outflows in times of economic stress. Therefore, effective liability management is crucial for mitigating these risks. Another issue pertains to deposit growth of certain banks not keeping pace with their loan growth, which has raised regulatory concerns about the risks associated with higher dependency on wholesale funding for credit disbursements. Such imbalances are viewed as indicators for potential structural liquidity vulnerabilities. While regulators monitor these trends as a macroeconomic gauge to assess systemic risks in the banking sector, it is crucial to recognize that for individual banks, these indicators alone are insufficient to fully capture the liquidity risk. From a short-term liquidity perspective, tools like liquidity coverage ratio offer a more nuanced view by considering factors such as the deposit stability, deposit behavior, and dynamics between retail and wholesale funding. The relationship between these indicators is multifaceted and often contradictory, making it essential to avoid relying on any single measure in isolation and necessitating a holistic assessment of the asset liability management profile of the bank. Contrary to banks, the liability profile of the non-banking financial companies is shaped by their primary activities, the regulatory requirements, and the type of assets that they finance. Historically, crises have demonstrated that NBFCs' over-reliance on short-term funding to support long-duration assets, such as infrastructure and housing loans, can result in significant liquidity constraints, deterioration in investor confidence, and credit rating downgrades, thereby constricting their ability to access capital markets. Consequently, NBFCs become heavily dependent on bank funding, both direct lending and bank subscriptions to debentures and commercial papers, leading to funding concentration. Recognizing the increasing dependency of NBFCs on bank borrowings, Reserve Bank had increased the risk weights on bank exposure to NBFCs by 25 percentage points in November 2023, which has helped in moderating the year-on-year growth in bank borrowings by the NBFCs. To offset this, the NBFCs have increased funding through CPs and non-convertible debentures. While accessing international markets can reduce the NBFC's reliance on domestic banking system and provide a broader range of funding options, it is also exposing them to additional risks, particularly the unhedged currency exposure, which can lead to volatility in funding costs and potential liquidity strains due to exchange rate fluctuations. NBFCs should integrate forex hedging with their ALM framework and closely monitor the currency exposure to mitigate funding volatility. The liquidity transformation of assets through securitization to free up resources for on-lending can also serve as an important tool to improve the ALM structure. Now let me flag a few issues that are being extensively debated globally on the ALM practices employed by the banks and NBFCs and the regulatory expectations on these issues. First, the rise of innovative products and technologies in banking has enhanced consumer flexibility in accessing funds and managing cash flows, significantly transforming customer behavior. Further, the evolving dynamics of information dissemination through traditional and social media can profoundly influence customer behavior, potentially escalating and amplifying in a crisis, or even amplifying a crisis. These factors present heightened challenges, and the banks and the NBFCs need to be watchful and carefully review their modeling assumptions on the stability of deposits and the customer behavior to better predict deposit retentions, the withdrawal patterns, the prepayments, and the interest rate sensitivities. Second, the liability-driven investment crisis in the United Kingdom demonstrated inherent vulnerabilities in a highly interconnected financial system, where the failure of one segment can precipitate cascading liquidity challenges across multiple sectors. Traditionally, liability management models, often based on historical data, may not adequately capture the risks posed by unprecedented market conditions. Consequently, the regulated entities must develop a more sophisticated stress testing methodologies that can evaluate the ability to withstand extreme scenarios, including those that involve the amplification of shocks across the interconnected financial networks. The final point is the importance of contingency funding plans. In general, the regulated entities must have formal contingency funding plans commensurate with their complexity, their risk profile, scope of operations, and their role in the financial system. Among others, it must clearly articulate the available potential contingency funding sources and the amount of funds that can be derived from these sources. It's important to note that the lender of last resort function of the central banks is regarded as an implicit assurance or an implicit insurance for banks against liquidity shocks that money market participants are unwilling or unable to absorb. The value of this insurance increases with the bank's exposure to liquidity risk, which consequently increases the moral hazard. Banks need to recognize that to address this moral hazard, the central banks retain the discretion to decide whether to extend emergency liquidity assistance to specific institutions. The assistance is intended as a safety net for the entire financial system through judicious use of public funds and is often accompanied by supervisory intervention and conditionalities. Therefore, the LOLR function should not be regarded as a routine component of contingency funding. As far as NBFCs are concerned, While they play a key role in enhancing access to credit and supporting growth, their activities involve a significant amount of maturity, liquidity, and credit transformation. Most NBFCs, unlike banks, do not have access to public deposits, as the regulatory approach over the years has been to disincentivize the deposit-taking activities of the NBFCs. Compared to more stable retail sources of funding available to banks, given their access to official backstops and deposit franchises, NBFCs will continue to be dependent on banks and capital markets for their funding. It's imperative for NBFCs to diversify their funding sources while optimizing borrowing costs and mitigating the associated risks so as to be on a sustainable growth path. Today, we collectively aspire for a Vikasit Bharat by 2047, the centenary of our independence. This ambition demands consistent and sustainable economic growth combined with a systemic capacity for resilience. In order to achieve the ambitious economic growth targets under this vision, the financial assets and the banking assets would need to achieve a high and consistent and high-paced growth over the next 2 decades, which would require a corresponding increase in liabilities and capital for the financial sector. This brings forth the need to address some of the emerging challenges as customer behavior and preferences are undergoing profound changes, while the global ecosystems and the external factors such as third-party dependencies and technology shifts are growing increasingly complex, thereby which is reshaping the business landscape. Collectively, these dynamics are creating a challenging environment for the regulated entities who would need to recalibrate their approach and business strategies. This is not just about managing risks, but also seizing the opportunities to optimize funding structures, enhance stability, and support economic growth. The road to a Viksit Bharat by 2047 will depend significantly on how well the financial system adapts to these trends and manages the complexities of raising resources and liability management. Thank you.
Thank you very much, sir. So I'm going to request you to please stay with me for 1 more minute. And Ravi, may I request you to please join us on stage and present a token of our utmost gratitude to Mr. Rao. So thank you so much for joining us here this morning and for sharing your insights with us. And please accept this token. Ladies and gentlemen, can we have a thunderous round of applause for Mr. Rao? Thank you, sir. Thank you so much. All right, let's talk about India's insurance sector, with a penetration reaching 4.7% owing to digital policies and, of course, an increased awareness post-pandemic. Our next speaker is here to talk to us about IRDAI's role, which is very pivotal in shaping an industry that's not just protecting wealth, but also the dreams and aspirations of the country. Ladies and gentlemen, please join me in welcoming whole-time member of the Insurance Regulatory and Development Authority of India, Mr. Deepak Sood.
These lights here. It's too bright. Okay. These two, if you can, just too bright. Okay, do your best. Thanks. Thank you. Yeah, it's better. Yeah. Thank you so much. Good morning. It's really lovely to be here and to have an opportunity to speak here. So when we were discussing, or rather having a word about what to speak about in this special address, I think what emerged was to talk more about rising global risks and building what was said to be a future-proof India, but I would like to say a future-ready India and the role of the insurance sector in this changing atmosphere. So, as India strides towards becoming a developed nation, we aim for Viksit Bharat 2047. Ensuring comprehensive financial security for every Indian citizen becomes a non-negotiable. For a stable and inclusive economy, it is the cornerstone of Viksit Bharat. And for us to achieve it, we need a multidimensional focus. We need to focus on sustainable and inclusive growth through bringing a rural and urban divide, bridging the rural and urban divide, to ensuring equitable access to opportunities and resources, investing in human capital by improving healthcare, education, and skills, promoting innovation and technology as creators of new opportunities, and financial inclusion for all. And herein lies the central theme of making India future-ready, or if you choose to say future-proof, amidst rising global risks. But if you talk about rising global risks, I look at it in two different categories altogether. Number one is the standard way of looking at the global risks, the geopolitical risks. Yes, those exist, as well as climate change, and we'll talk about it a bit later. But I think for a strong India that's resilient, that can withstand multiple risks arising from wherever they need to be, the most important thing is to have a very secure population. Securing the future of our people, their financial stability, is key to a future India. And only then, when we can be very sure of their security, can we really say that we are future ready and that we are future proof. The role of insurance in this can never be overstated. I think, you have many definitions of insurance, and one of the best that I've ever come across in my life says that insurance is an institution, whatever you would like to call it, that actually reduces the volatility or smoothens the volatility of any balance sheet, whether it be enterprise or it be individual. I don't think any other definition covers insurance so well. If you talk about statistics, we are at a position where we have 4% penetration by GDP, one of the measures of insurance premium as a percentage of GDP. It's increasing, but it's still far from the 6.8% average, global average. But that doesn't give the complete picture. I think if you look at the insurance gap, the gap for each individual, for each little enterprise, it's far more. With just 1%, imagine with just 1% homes really being covered under insurance, what is the exposure that we have to risks just by climate change and by natural catastrophic perils, and how difficult it is for people to get back to their livelihood once they're struck by any of these events. A lot has been said as to why insurance the penetration is less, or there continues to be a gap. We've all heard lack of awareness, trust deficit, affordability concerns, distribution challenges, especially in the rural areas. But within these challenges are the opportunities. And the road to universal coverage is something that we have to evolve. And it's in this context that Insurance for All 2047 is not just a regulatory vision, but it becomes a national imperative. It can be achieved by the contribution and the shared vision of each stakeholder, the government, the regulator, as well as the insurance industry. The government has been doing its piece by introducing flagship schemes such as the Ayushman Bharat. It has made significant strides in covering a very vast population segment of the population for health coverages. It has brought about protection for millions. The scheme serves as a beacon of hope. And equally important is bringing about financial literacy, something that teaches people that insurance is more a necessity and not just an expense. Incentivizing insurance adoption will also go a long way. Tax benefits, subsidies where it counts, all these things will benefit the insurance sector, the population, quite substantially. It will go a far way in increasing awareness, in increasing penetration, in increasing coverage at an individual level. And my concern or our concern is more that when you say insurance for all 2047, it really means that every Indian has at least a health policy, a life insurance policy, and a property policy that covers his home and his business. Awareness and government schemes can go a long way in that. Most recently, there is a proposal from the government to also increase FDI to 100%. The regulator has also been working towards increasing the number of players in this country so that there will be deeper penetration and we can expect more and more coverage. The IRDA on its own has been taking a lot of initiatives in this segment. A huge set of regulatory reforms has taken place in the last 2 years. As we strive towards a vision for insurance for all, we move to transformative reforms and policy initiatives have been taken that are aimed at enhancing penetration, promoting inclusivity, and ensuring that the insurance ecosystem evolves in steps with India's dynamic needs. To encourage innovation, we have reformed the product filing and approval system. It's much easier under the use and file system for insurers to make new products, innovative products, and bring them to the market with the reduced delays and higher efficiency. De-tariffing of the general insurance products has gone another step forward in opening the doors for innovation. The sandbox regulations that have come out from the regulator's office and the revised ones most recently have made it even easier on tap and long term to introduce new innovations, experiment with new innovations that can be useful in improving penetration as well as universal coverage. Most recently, in the regulations, in the revised regulations, there has been a greater and greater focus on policyholder protection. One of the key elements that was introduced was the consumer information sheet, something that has to be shared by whoever the distributor is, whoever the insurer is, with the insured, with the policyholder at the time of the sale of the policy itself. This is supposed to be a document that gives, in very simple terms, the coverages, the key points of an insurance policy, and makes the customer, the policyholder, the prospect aware of what he is going to acquire, what he is going to buy. There are always a lot of complaints, a lot of grievances that I didn't know what I was buying, there was a fine print. This is specifically in that direction to address and make clear and simple what is the insurance that you are buying. Customer-friendly steps have been introduced in health insurance in a big way. Move towards 100% cashless settlements anywhere, or pre-authorization within 1 hour of request, discharge within 3 hours, or discharge of the post-authorization of the claims within 3 hours of being put in have been made mandatory. There are penalties if insurers fail to meet that. These measures are all intended to make claiming easy. Claiming is easy, making a claim easy, and it is supported by a robust grievance handling mechanism, different levels, both at the insurance company level, at Bima Bharosa, as well as the ombudsman level. The multiple options are provided, and they are popularized at a regular intervals to make it more and more friendly for people to be able to make their insurance claims. The state-level insurance plans that have been introduced are intended to achieve deep penetration. With the lead insurers being assigned to each state, it is expected that it will drive insurance penetration at the grassroots level. State-specific needs are better understood through the collaboration of state governments and local stakeholders, and we will make sure through SLP that no region is left behind. One of the key initiatives that the insurance regulator has promoted is what you have been hearing, and I think later in the day that you have a discussion on it, is Bima Sugam. Bima Sugam is intended to be a digital public infrastructure, an insurance electronic marketplace, which aims at bringing all the stakeholders in the value chain at one platform, at one place, improving efficiency, improving transparency, making more products available, improving services and improving every aspect, deepening penetration, and as I said, making claims easier, which will get us to insurance for all by 2047. And of course, in all this, while the government has played its part, the regulator is also playing its part. The insurance industry cannot stay behind. Insurance industry needs to work towards achieving, rethinking their distribution models so that they can have deeper penetration across different segments, geographies, and products. Develop new customized products which will address the changing phases of risk, which will address the different needs. Importantly, while in the health segment, while the government schemes have been very adept and have efficiently covered a very vast population at the lower income end, at the upper income end, people are able to buy insurance, but we are left with something that is referred to as a missing middle. The insurance industry has to work towards bringing about a new approach, customized products, and developing methodologies, distribution, products, groups, whatever it takes to address this missing middle. Otherwise, we have a vast population which remains without health insurance coverage. Leveraging technology, I don't think we can ever say anything less about it. The speed at which technology is moving, that is the way to go. And as much as we leverage technology, the better it will be for policyholder, for transparency, as well as for being able to service the last mile. Given this background of how we are and should be working and progressing towards addressing our own needs, our own insurance needs, our population, the needs of our people, making everyone secure, we cannot lose sight of the fact that, like forever, risk is changing. The face of risk is always changing. It changes over the years, over the decades, and I don't think it has changed faster than this. There was a time in history when anything that the risk was only perceived to be purely physical, a fire or something. Then business interruptions became more important. Then other products became more important, other things became more important. And today I think what is in everybody's lips as we talk about it is on everybody's WhatsApp is the cyber risk. And the worst thing about cyber risk is, whereas it started from something as attacks or a risk for enterprises, it has moved to you and me. It has moved to individuals. It's in our pocket, which we carry day in and day out, and at the same time look at it for at least 7 to 8 hours a day. So that is the way that we are exposing. We have to understand this. We have to develop methods to prevent, to safeguard against these kind of risks, and this is what the globalization is bringing. And I was reading very recently that with the evolution of quantum computing, we are going to see technology jump at a speed that has been unheard of or unseen before. And at the same time, the nature of risk will once again change, and it will be upon us much faster and in a much more complex way. We need to work together to build preventive measures, to build measures that can protect each individual, and if you are struck by it, to see that you are protected through insurance. The emerging geopolitical risks across the world, be it conflicts in different places, be it financial stability or instability in certain areas, whatever it means, brings new challenges for us. It creates uncertainties and economic volatilities. There is increased risk of property damage, and above all, for the insurance industry, there is a decreasing capacity in the reinsurance market, which reduces overall capacity for us. We need to work for it as the regulator, as the insurance industry, to increase capacity, to increase domestic capacity, which can be brought about by introduction of new players, by other methodologies that can be done. The regulator has been working consistently towards bringing in the risk-based capital regime and the regulations. This is a way that will also benefit the insurers, benefit the market, and it will assign capital to the appropriate risk. And as we see more and more complex risks and other risks coming in, insurers will be able to better utilize and manage their capital. Not to leave behind something that gets talked about a lot and is really upon us is climate change. I think there is nothing more global than climate change today. And the manifestation that we are seeing and which is affecting us is increasing number and severity of the natural catastrophic or what are called NatCat perils and NatCat events. Not only is it increasing in severity in numbers, but it is coming up in unpredictable locations at unpredictable times. Patterns, we know that weather patterns are changing, but suddenly we have rains in locations which are just unheard of and of intensity that are unknown. An integrated approach is required from all sides, from all segments, right? Not only just in a question of insurance, but every segment needs to contribute in this, even to the extent that we may need to rethink the kind of drainages that we build in everywhere to handle far, far more amounts of rain in locations which were perhaps arid at one point of time. We need to build capacity, new kinds of products like parametric products, which will make it easier for people to not only take insurance against these perils, but also to be able to claim when such natural catastrophes strike. We need to expand reinsurance capacity in this market so that we are able to handle more and more and be self-reliant rather than go elsewhere. One of the key things, and I'm very proud of this fact, is that the global risks in this world brought the pandemic upon everyone across the globe. I think India responded phenomenally. The proactive government approach to the pandemic, the coming out of with the vaccine in time, saved lives and reduced the span of the pandemic. Even our insurance industry stood by its policyholders. Whereas in many geographies and jurisdictions which we don't hear about on a day-to-day basis, insurers withdrew, saying that this was not a covered peril. Not in the case in India. Every insurance policy stood by its policyholder, and that was a proud moment for us. So as we commit ourselves to a shared vision of insurance for all by 2047, we have to both address our internal risks, make our own population, our own people financially secure, make them secure through insurance. We have to ensure that each individual, as I said, at least has a sufficient health insurance, property insurance, and a life insurance so that they feel secure. And it is through this that we will be able to manage and address global risks that will continue to come upon us. With this, I would like to conclude and say that working together, all stakeholders, we can build a resilient, prosperous, and future-ready India. Thank you very much.
Thank you. Thank you so much, Mr. Sood. Ravi, may I request you to please join us on stage as we present a token of our gratitude to Mr. Sood. Sir, if you could please join us center stage. Ladies and gentlemen, please join me in putting your hands together, giving a thunderous round of applause to Mr. Deepak Sood. All right, ladies and gentlemen, stay glued to your seats. We're setting the stage for our very first power panel of this morning. Meanwhile, may I remind you and invite you once again to join us on the social media conversation. Please share your thoughts, your key takeaways, and when you do that, don't forget to use hashtag Mint BFSI 2025 and also tag us at Live Mint. Let's talk about AI and the world of endless and unlimited possibilities that it offers. The question is, what about the bankers? Let's find out what they think about AI and how future smart tech will continue to evolve and change the way we do retail banking. How is it helping? How is it elevating risk management, fraud detection, and even customer service? It's time to hear their story. And Time to invite them on stage, ladies and gentlemen. Moderating this chat is Gopika Gopakumar, Deputy Editor, Mint. Please join me, Gopika. Yes, keep the claps coming as I invite our panelists on stage. Vidya Krishnan, Deputy Managing Director, State Bank of India. Anjani Rathore, Chief Digital Officer, HDFC Bank. And Puneet Gupta, Managing Director and Vice President, NetApp India and South. Welcome to the stage. And everybody, can we have a powerful round of applause for our very first power panel? Over to you.
Thank you, everybody, and a very good morning. So before I pose questions to my panelists here, I would like to pose a question to all of you. I know I can see it's a mixed crowd of the Gen Z and a little older generation. So my question to you is, how many of you are comfortable interacting with the AI chatbot, using IVR for doing your banking requirements? Can I have a show of hands? That's like maybe 30, 40%. The remaining, all of you, I would assume that you're comfortable having a human on the other side. Is that what I can learn from this? Okay. Well, so that's a cue for them, because I asked them, what would you like to hear from the customers, the audience? So clearly that's a cue for them. And on that note, it's not just banks investing heavily in digital technology, it's also the customers, how comfortable they are in using this technology, right? So as you've seen that banks have been increasingly investing in digital technology across various functions like streamlining operations, improving customer efficiency, giving personalized offerings. So given that adoption of technology, we've also seen that RBI has been cautious, has been instructing banks to be cautious and more compliant. The government has been wanting banks to ensure privacy and secrecy. So given all these circumstances, how are banks integrating all of this and still being on top of technology? So that's my first question to my panelists. First to you, Vidya ma'am from SBI. How much of AI and digital, the new age digital technology has made inroads into your bank, SBI?
Yeah, thank you, Gopika, for having us here. State Bank of India has always been at the forefront of digital transformation in the country. We started our online banking in 2000, and then YONO, our flagship mobile app, we launched in 2017. We have progressed, and AI is a very integral part of the digital transformation that we've taken. And AI is a journey. We started with small bits. We have an analytics practice where we have our own data scientists who develop models indigenously for the bank. And they've been using AI in several areas. Our whole early warning signal for the bank is based on the AI technology. Our PRM, that is the proactive risk management, is based on AI technology. And these are all quite sophisticated and complex models. So these are the two big use cases for AI that we've deployed. More importantly, on the business side, we do around 20 to 25,000 crores of pre-approved loans, which is also based on AI technology. So we've leveraged AI for business. We've also leveraged AI for governance, for risks, so across. And now we are looking at Gen AI adoption in a big way. Yes, having said that, we are very particular, we are very clear. Our policy is very explicit that whatever we do should be ethical AI and responsible AI. So we'll stick to that.
Anjani, if I can come to you. As a customer, when I come to your bank website or your app, other than the interface that we see, what really goes behind? Can you give us a glimpse?
So in our bank, we have always endeavored to bring in the best for our customers. We leverage technology to make banking products and services as easy as possible. But when we bring in technology, the framework that we essentially look at is that what does it do to the consumer experience, to the customer experience? So if we have to make it make banking easy, it should be easy for people who are very well educated, people who may not be familiar with English, or some people who are living in rural hinterland, can they use it as well? So how simple can we make banking is one agenda. The other agenda is that in the digital world, one of the big differentiator is how well do we know our customers. So that comes from data. And the more we know about a customer, that customer intimacy helps us deliver banking products and services much better. And the third piece is safety and security. Banks are not just custodians of money. They are also custodians of data, because this is a lot of customer transactions which is available. So we have to protect that as well. And therefore, we bring in technology which makes things simpler for our customers, draws customer intimacy, and makes it safer. It started long time ago when we introduced core banking for the first time, which was centralized by HDFC Bank, and you could go and withdraw money from any part of the country through ATMs. Then it started progressing to net banking, mobile banking. Internet banking came in a big way. So banking has also evolved over the last 30 years. We started with branch banking, where a CRM was the face, the branch manager or the branch RM. A customer would walk in, that is a channel where you go and meet with people. That's a touch interface. Then came internet banking, and virtual banking, which was more on the internet type interface. Then came, virtual banking, where phone bankers would call it, that's talk. And now we are extending that across. You can see it on chat banking, on WhatsApp and other messages. We're able to deliver some of the banking products and services. So it has evolved over a period of time, and we use the best of technology, whether it is AI. At this point of time, AI is in vogue quite a bit. But it could be a host of other technologies as well, which is not visible to customers. For example, when you do a transaction, there is a huge amount of transaction monitoring which is running at the back end to ensure that it is a safe and secure transaction for the customer. Now that is not visible. That's a lot of tech which is going in. A lot of streaming happens. There has been, customers have brought out that they have been defrauded, etc. So we put a lot of controls. When you access even a mobile banking or a net banking from a different location, banks know that you are accessing it from a very different location. They can step up authentication to ensure that it is safe for the customers. So we are infusing technology all around, and it is keeping banks safe, customers safe, and improving the customer experience.
Right. So our money is safe in your bank, so to speak.
Absolutely.
Right. Puneet, I know these are two large banks in the forefront of implementing the best of technologies for customers. You would be, as a data infrastructure company, you would be sort of helping other banks, the mid-sized banks, small banks, also implement new age technology. How far do you think they have gone into adopting this, both AI and new age tech?
Okay, thanks, Kopika. Good morning, everyone, and really pleasure to be here. So look, first, like it's been said, digitization itself has had a very profound impact on the way customers have experienced banking. And you were asking this question about, folks who have experienced AI. Folks who have experienced the banking in the 90s, right, will kind of relate to the change that has happened over the years. Without any doubt, AI is going to be the next disruptor, or AI is the new technology that will change the world. Now, whether the banks are the largest or the mid-sized, there is no getting away from implementing the latest cutting edge technology if you really want to be in the market or in the business. If you look at what the analysts are saying, they're saying that AI itself will double the bank's bottom line in times to come. If you look at RBI reports, they are saying that the initiatives on AI have gone up significantly more in the last few years. In fact, in one report, they said that the word AI is used between 3 to 6 times, more over the last 7 years. I mean, that's how fast people are thinking about it. Now, you see a form of AI in terms of the AI chatbots, right? And if you are on a net banking site and if you are struggling to find something, then that chatbot is amazing. If you really know what you need, then it can be a little bit of an irritant. And I think right now the technology is evolving with customer experience on how that will truly show up. If you also look at the whole customer intimacy part, it was very data-driven with analytics. Right? That was the whole story. You would look at analytics, you would say, what product do I want to sell to whom? I think the journey from analytics to AI to intelligence is what will transform the personalized services for customers. And I think that's going to be the big transformation that will happen in the BFSI industry. So in my view, of course, the largest banks like SBI and HDFC both have cutting-edge technology. But even the mid-sized banks and some of the smaller ones are really adopting technology very fast because it's not an option. It's a necessity for survival.
Let me come to Vidya ma'am, you. What are the challenges that you are facing when it comes to implementing some of these technologies? Of course, a lot of investments are made, but can you elaborate on some of the challenges as a banker that you face?
So, as I said, it is a journey. And through that journey, you will have benefits and they won't come alone. They'll always come with some kind of challenges because it actually transforms the way in which we interact with our customers. So this whole narrative around making it simpler, as Anjali just mentioned, trying to second guess what the customer wants by deploying models on data that takes into account the behavior, etc. of the customer, and trying to kind of engage with the customer a little more so that we can offer our customer the best of experiences. Entails that we use a lot of data that is available, and we can make predictions on what is it that the customer wants. While doing that, we have to be very clear and ensure that we don't overstep the boundaries or the mandate that the customer has given us. So the laws that come in the form of the privacy, the act, etc., that will kick in very soon, will make it a little, I won't say challenging, but we will have to rethink the way we've been engaging the customers. That's one thing. From the customer side, many of our customers, like when you asked the group, they all said that all of them were happy using AI. But there are also risks which possibly as a customer, as a consumer, may not be aware. The banks have to make it a point to share that with customers, make them aware. So customer awareness is a very, very big thing. The second thing is that for a bank like State Bank, where we have 22,000 branches, we work through BCs. The customers across various geographies are not all the same. So there is no homogeneity there. So we have to have different products, different kind of awareness programs. Try to understand the preferences of those customers. It could even be, urban customers may use smartphones. In some of the rural areas that we serve, there's no internet. So we've got to curate products for them. And given the kind of branch network that we have, and I always say that AI today that sits in the servers, they're actually sitting in the brains of people who are serving customers. So it's not something new. So it's more about how we could leverage omni-channel experiences for our customers So I think these are the challenges which are more short term, and I'm sure as bankers who are very committed to give customers better experiences, better products, and also further the the whole inclusion program, I'm sure we'll find those solutions, and these challenges will vanish. Of course, new ones will come, but this is a journey. But having said that, AI is a very, very integral part of the transformation programs that all banks in India have undertaken. And in some ways, we are also ahead of our peers, because we've been able, in other geographies, because we've been able to create the kind of rails and products at cost, which really will benefit the country and the demography.
Anjani, you, what are some of the challenges that you face? Also, how relevant is human interaction in this? If you digitize the entire loan journey or you digitize the entire process, what would be the relevance of human interaction at all?
So in terms of challenges, as I mentioned earlier, there is a trio of experience, data intimacy, and security. Now these things have to be maximized with a balance. The more simpler you make, you have to also make it safe, because it's simpler for the customer, it's simpler for the fraudster as well. So how do we make it safe? The more data we use, we have to ensure that there are guardrails, that the privacy is maintained. So it's always a balance between experience, data intimacy, and security, and that's something that we always grapple with. The more insights we get from our customers, it helps us build products and services which can be offered digitally, and it's much easier for them to use. At the same time, what kind of guardrails can we put to make it safe, whether it is using AI or just traditional technology, that doesn't matter, but it has to be made safe. And this is where the human in the loop always comes into play. See, despite bringing in a lot of technology, there are always exceptions that happen. And the first thing is that we need human to manage those exceptions, because tech is not at a level where it can manage everything end to end. Of course, people are talking about autonomous systems that can do that also at some point of time. But today, with technology, we are removing various friction points in banking services. For example, when you want to open an account, you have to do KYC. Now, for KYC, you need to meet a banker. Then tech came in to say, no, you can do it over a video KYC. Now, with that tech, there were some challenges, but we've been able to resolve a lot of that. The new tech is that you can use face authorization that comes from Aadhaar. So it keeps on improving, but still, when you do a KYC, even if it is getting done through a video KYC, there is a banker sitting at the back. There is a human being who's sitting at the back. We offer customer care, customer service, what Vidya mentioned, that it improves through technology and AI. But even there, the simpler queries can be answered. If it's a very complicated query, then the call still goes to a human. Likewise, there are various pieces of puzzles in the entire value chain, which gets to a large extent simplified and automated through technology, but there is always a human to manage an exception. That need is there, and it continues to be there right now.
Yeah, so the human in the loop is very important, because the human in the loop will help enhance customer awareness. As he said, safety, especially from point of view of safety as well as from point of view of service. For instance, we have this whole PRM setup, which is the proactive risk monitoring, where I'm sure other banks also have, where we make calls to customers when we see some kind of anomaly in a transaction, which does not seem to be done by a customer. Now, the engine that is deployed is also an AI engine to discover this. And then it is a human that talks to the customer and finds out whether the transaction is genuine or not genuine. And then the transaction is put through. So from safety point of view also, we need human. The second thing is that not all products can be straight through processed or end-to-end digital. you may have loans where part of the product could be digitized, but another part like the documentation, etc., would require help. Sometimes during the course of the transaction, the customer may just drop off because the customer did not know how to proceed further. Here, a human can always help the customer come back, get back to digital, or complete the transaction through a physical intervention. Similarly, another thing is that as much as we could deploy AI models and solutions to replicate the kind of workflows that would generally have been done by human beings, they may not be all the time accurate. In order to train them also you need human. So banking is, there are very few products that can actually be end-to-end digital, but many of them would do better with a human. So I think it's all going to be phygital, but whatever it may be, you will have AI, you will also have the challenges, and you'll continuously mitigate, which I think is a collaborative effort, given that today we are all working on interconnected platforms. So this becomes a collaborative movement. Services become collaborative. Safety also requires that all of us pool in the kind of the intelligence that we have over a period of time accumulated, and actually come out with common solutions that can help the customer. I think collaboration is the key going forward.
One more question to the banker before I come to Puneet. So, of course, we hear fintechs, NBFCs digitizing their entire journey, no human touch. That's something that, large banks like you all will be comfortable. And is that model sustainable at all? Where you see fintechs and NBFCs only relying on tech?
See, every digital journey is amenable to be simplified using technology. And that is being done in the sector through regulated entities, and there are various partners who are stretching the boundaries as well. And the friction points are disappearing slowly. Effectively, what it is doing, it is making banking simple for the customers so they can take the product easily. Earlier, you had to go to a bank during office hours to do banking. Now you can do 24/7. You come to HDFC Bank site, you can take a home loan even at late at night. Even when the bank is shut, you can take those. Those things were not possible earlier. It's possible today. It improves human productivity. If our agents, our bankers are able to show you various products, a person is able to even make an offer to you and take you through the entire journey instantly on the tablet, on a computer, on a mobile device to offer you that full product end to end. The turnaround time of opening those accounts or taking the product has gone down significantly. If you go to one of our products, ASAP, and take a credit card Pixel, imagine the kind of experience that is offered today. It was not possible a few years ago. You can start with choosing a network, whether you want one network of MasterCard, Visa, RuPay. You can choose the benefit. You are a traveler, you want 5% discount on travel. You are a foodie, you want 3% discount on food. You can make your own plan on a credit card. And then you can choose your billing cycle. You want to pay on 5th, you want to pay on 10th, you want to pay on 15th. All these things are possible. So you are making your own card. You are utilizing it the way you want. And you are paying it the way you want. This entire piece is end-to-end digital. But there are pieces like if you are a new to bank customer, you have to do KYC. There is no other way. So those pieces do come in, but it improves the productivity of people that we have. It improves customer satisfaction because you can take the card instantly. The kind of products that we are able to create now digitally, maybe it was not possible a few years ago. So those kind of things are making this entire ecosystem go up. And I believe the fintechs are also talking about the same thing. That can we issue a credit card? Why do you always make me choose one network? Why should there be one billing cycle? Those things even banks are challenging and are changing it as we go forward.
Puneet, I'll come to you. Given the pace at which the banks are growing, the scale at which banks are growing, do you think they're prioritizing these investments in technology? Or do you think more needs to be done?
I think this is a good question. So let me answer this in 2 or 3 parts. First, if you look at it from a IT industry standpoint, the BFSI industry is probably one of the largest spenders. And that spend has been exponential in the last 4 or 5 years. For the growth that the Indian IT industry is seeing in India, a large part comes from BFSI. The second is that, India has this unique ability to do more with less. And two amazing examples that we have is Aadhaar and UPI. Aadhaar got implemented at a fraction of a cost that what the West believed it will take for a country of our demographics. The UPI implementation is, has been amazing, and if you talk to folks in the West, they are absolutely amazed at the kind of ecosystem that we have built. Now, folks like us, for all the right reasons, would love for the banks and the BFSI industry to spend more, right? We love all the business that would come in. But on a serious note, I think the amount of investment that's gone into the tech side in BFSI, I think has been phenomenal in the last few years. The jury will always be out that is the spending enough or not. And I would think more for effectiveness of what the tech is giving, more than the spending, because India will always find that for the same outcome, India will always spend less than the rest of the world.
Why do you think that is the case? Indian banks spending less. Even RBI seems to think in the Financial Stability Report, it said that Indian banks are spending less than 10% in emerging technology, although they believe that this is quite crucial. So do you think you all are doing enough, or there's more distance to be covered?
So spending in technology has definitely gone up over the last few years, and I think where we are as a bank today, this is globally benchmarked. You can see some of the best banks in the world also spending at this level. As a social infrastructure. So that gives us one additional boost to deliver good customer experience and good technology to our customers. If you think of it, things like UPI in one of our neighboring countries was a private sector enterprise. So you had large commerce companies creating BNPL capabilities. In India, the infrastructure by fintechs, by regulated entities, everybody, and you can create your on top of that. This is a tremendous a booster for the economy here, things that are getting created. And I think this is where investment is making in terms of social infrastructure.
Yeah, so I agree with this digital India and the sense of public good that have been created have helped us create interconnected platforms which could help us with scale leadership and at the same time cost efficiencies. So more than the percentage, it be where we spend cost efficiencies and ultimately what is the outcome. So having said that, we continue to invest in building products to train people. We will be doing more of insourcing. We've come out with an ad to take around 1,500 people. So that's
In AI?
In India, yeah, in our IT itself. We are modernizing our platforms. So including our core bank. VMs. we'll of upward of 40 petabytes. So that's the kind of scale that we are imagining. And since we are imagining these kind of scales, we are also mindful of the kind of efficiencies on the cost also that we should not miss out on. But we will continue to spend.
Yeah.
You know, one of the things that we will see, and we've seen this in many industries, like when Uber first came in, it was a tech company and not a taxi company. Element of tech in the BFSI industry is going to go up. And you will find tech companies, and that's where the fintechs are, right? And to your earlier point. But I think the element of tech in banks and the whole industry will go up dramatically over the next few years. And also, you know, and then to the point of spend. So this question will kind of go away, because if the element of tech is so much, then whether you're spending enough or not will just go away. Right? Because tech will drive a lot of the business that will go forward.
Before I close, I know this is one thing which is on top of everyone's mind, which is frauds. And I think all of us at some point in time may have been victim of this. Just one question to you, Anjani. I know you are on that committee, and of course you can't share what the committee is going to look at. But in terms of a framework, do you think there needs to be a better framework, a better regulatory structure to sort of look at, or legal structure to look at digital frauds?
See, digital fraud is an ecosystem problem. It's not just a problem that any one entity can 100% solve. Of course, every entity will have to work on its own. But it's also a good problem to solve if we come together as an ecosystem. So, and the problem cannot be solved at the time of transaction. It's too late. It has to be solved at the time when we are onboarding a customer into financial services for the first time. How due diligent are we in terms of ensuring that the KYC is proper, we know who the customer is, and every player has to work in that same manner so that everybody who joins the financial ecosystem is properly vetted and we know the customer very well. Once the customer comes in to the gates of financial services, then we have to do a proper due diligence. We have to ensure that what is the transaction patterns, etc. And that's where a lot of technology is going in to see that we are able to use not just the data which is within the bank, but also what is available as alternate data outside of the banking ecosystem. So there are lots of information available outside of banking ecosystem, which gives you a good signal in terms of profile of a customer. And then, of course, lastly, when the transaction is actually happening, if all this is done beforehand and the transaction is actually complying to what the profile has been built, then it's a good transaction. If it's not, then it's a bad transaction. And this is where the entire AI is helping us in a big way to identify some of that. Now, the problem here is that we are, 1.4 billion people. So even if there is a 5% incorrect catch, then you create a lot of friction for the customer. So this has to work in a manner that there are no false positive, which is very, very difficult problem to solve. But the good thing is that if all the entities come together, we create a framework of what information we will share with each other, what is the kind of due diligence that has to be done, what is the kind of alternate data that we can use to profile customers, and what do we do at the time of transaction. Even if money has moved from one bank to the other, are we able to trace it immediately and stop it from going outside the banking ecosystem? And all these things will require a good collaborative framework for us to ensure that we are able to protect it. There is a lot of work already happening, and I'm sure you are going to see some of the benefits of the work which is going on to ensure that we make banking much more safer for our customers.
On that note, we'll end this session. Thank you, panelists, for sharing your insights on this topic. And thank you all for listening in. Clearly, AI is going to be a game changer in the financial services, and it is both for the banks and customers to be cautious and also adopt some of these innovations also as we go along. Thank you all for listening in.
Thank you so much, Gopika. Yes, powerful round of applause. And Gopika, may I please request you to present a token of our gratitude to all of our panelists on behalf of all of us in the room. into another very important subject. We've all heard about foreign pension funds investing in Indian equity, but what about India's pension funds? Let's hear from Mr. Deepak Mohanty, Chairperson of the Pension Fund Regulatory and Development Authority, on the progress and the prospects of pension in India. Let's welcome him with a warm round of applause.
I thank the HT Media Group for this opportunity to be part of this distinguished gathering of BFSI. Finance is the lifeblood of the economy. As we aspire to Viksit Bharat by 2047, it is important that various segments of the financial sector develop commensurately to support the process. In this context, I am happy to share my thoughts on the pension segment, particularly the national pension system, reviewing the development so far and concluding by underscoring the need for wider coverage of pension going forward. The pension assets form a major chunk of global investment, estimated around 43% of total assets under management. In India, pension assets estimated around 50 lakh crore, that's about US $600 billion, are relatively modest compared to such global assets of over 63 trillion US dollar. The largest retirement fund in India is the Employees Provident Fund, and I presume most of you would be part of EPFO, ranks 21st by size in global pension fund ranking. With government pension fund, Japan ranking first with an AUM of over 1.6 trillion US dollar. The national pension system, including the Atal Pension Yojana that we in PFRDA manage, has assets of about 13.8 lakh crore, so which is about US $162 billion. In the past, pension was perceived to be the privilege of the government employment. It is no longer so with the introduction of NPS in 2004, first for the government employees and then extended to private corporates, including a common person in 2009, and now to children with the scheme of NPS Vatshalya, which we launched in September 2024. Why then there is a such slower pension adoption? Anyone coming of age joining the workforce will retire sometime. Hence, financial provision for post-retirement life ought to be made when one is working. That too early in the working career to build a corpus harnessing the power of compounding that could provide adequate regular income support post-retirement. Pension products are designed for that purpose. Why then pension adoption? Relative to both the size of our population and workforce is low. There could be several reasons. Let me emphasize on three of those. First, financial literacy and awareness. Financial literacy is a key driver in taking sound financial decisions. The objective of financial education is to make citizens better prepared to manage their money and finance, attain their financial goals, so as to avoid financial stress later in their lives. Elevated level of financial knowledge ultimately leads to improvement in individuals' financial well-being. The challenge of financial literacy is not limited to India alone. Only a third of adults surveys across 39 countries by the Organization of Economic Cooperation and Development, that is OECD, reach the minimum target score of financial literacy. Back home, RBI NCFE Financial Literacy Survey for India suggested that only 25% of people are thinking to make retirement savings. The additional challenge in the present time is also to improve digital financial literacy levels of citizens, as all of us are exposed to fintech for delivery of financial services. For example, NPS is fully digital, though there is physical mode of onboarding. It is important to be aware of one's responsibility in a digital financial environment while being cognizant of risk of digital cyber frauds. Considering our diverse population in terms of social, economic, and cultural factor, a one-size-fits-all approach of financial literacy program may not yield the desired results, and customization at different level of geographies is warranted. More than content, the manner of communication becomes important, as in the standard curriculum, aspects of personal finance are not generally covered. It is worth the effort improving financial literacy, which is seen to contribute positively to one's financial well-being. Second, the nature of our labor force. The bulk of the workforce is engaged in unorganized informal sector where they do not have access to occupational pension, such as in the organized sector. According to India Employment Report 2024, 81% of our labor force was in the unorganized sector in 2022. Efforts are made by the government to provide pension to low-income households. For example, under APY, a guaranteed pension of 1,000 to 5,000 rupees is available depending on one's contribution. We have enrolled 7.3 crore subscribers under APY, among whom 6.2 crore are currently active. Self-initiated saving by the old age is necessary. In addition, government does provide some social security assistance to underprivileged and low-income individuals, but that may not be adequate without one's own saving. The composition of a labor force creates its own challenge to retirement planning. The rise of gig economy, digital platform has redefined the character of our labor force. The Social Security Code 2020 envisages social security for them. While that takes shape, such workers could enroll under NPS or APY depending on their capacity. Third, affordability. In a contributory pension system, individual earnings do matter to a long-term financial decision like pension. Currently, with per capita income of around $2,500, we are a lower middle income country, as per the World Bank classification. With sustained GDP growth, India for sure will progress to an upper middle income country with per capita income of upwards of $4,200 in the next decade. We aspire to be a high income developed country by the middle of the century. One implication of this is that financial ability of our population to adapt pension would continue to increase with rise of income. Let me focus on the changing financial behavior that we observe. The financial behavior of retail investors in India is going through a phase of rapid transition. Financial attitude seems to be changing. Components of households' gross financial assets indicate that in a decade, between 2013-14 and currently 2023-24, the share of cash and bank deposits has declined from 62% to 44%, and that of bond and equity has risen from 2% to 8%. Financial saving for social security, such as in insurance, provident and pension fund, has shown a steady increase from 32% to 38%. As I mentioned earlier, the pension sector that the PFRDA regulates, covering NPS and APY, has investment of 13.8 lakh crore, out of which infrastructure investment is about 2 lakh crore and equity investment is about 2.6 lakh crore. As our income levels rise and with growing participation in the schemes, the sector is poised to grow as in advanced countries, such as in OECD countries that we have seen that the pension assets average about 87% of total GDP. In certain countries, it is even more than 100% and 200%, for example, in Scandinavian countries. When it comes to wealth accumulation, diversification becomes very important and a balanced approach is required as per the age, need, and risk appetite of individuals. In this context, NPS becomes a very good tool for disciplined saving as well as balanced investment so as to accumulate a good amount of wealth during the working life of an individual. It has robust regulatory framework and established architecture where every function is managed by professionals. It is fully digital, very flexible, and offers a wide range of choice for the investor as per the need and risk appetite. Let me briefly review the progress of NPS. I understand there's another session following me, then where you will have details on the NPS sector. NPS provides both active and auto choice for investing one's own corpus. The financially sophisticated individuals can go for active choice under NPS, where they can choose up to 75% allocation to equity and up to 100% in debt. The investor who do not want to actively involve in fund allocation may make auto choices of life cycle funds where the investment allocation automatically changes as per the age of the subscriber. There are 4 types of auto choices given, giving a predetermined mix of equity and debt, matching the requirement of varied investors. Conservative life cycle, that is LC25, moderate life cycle LC50, and aggressive life cycle LC75, and also recently we introduced a balanced life cycle fund. This 25, 50, 70 means the equity component, and obviously as you age, the equity component comes down and the fund gets rebalanced. In addition, NPS has offered a very attractive return of about 13.2% per annum in equity since its inception. NPS scheme for government employees, which is a conservative mix of both debt and equity, has given a return of 9.5% per annum since inception. NPS is also tax efficient. Both the accumulation and corpus are exempt from income tax. For corporate subscriber, 14% of salary contributed to NPS is exempt from income tax, both for the employer and the employees under the new tax regime. Of course, under the old tax regime, there is an additional deduction of contribution up to rupees 50,000. NPS Vatshalya, introduced in September 2024, is accepted well with 86,000 subscribers so far. It can be seamlessly ported to workplace pension on the child coming of age and joining the workforce, thereby providing continuity to one's retirement saving account. Thus, it has become a family product. NPS has become a family product in the sense now any member of the family from infancy to 70 years who can join NPS. As the vesting period is enlarged, one could harness the power of compounding to accumulate substantial corpus, ensuring adequate pension on one's retirement. The subscriber number under NPS are growing rapidly with an active subscriber base of 1.6 crore. However, the NPS subscriber under the private sector, both corporate and individual, at 64 lakh suggest ample scope for further expansion. While NPS has made pension accessible to all, there is a need for greater adoption. Appreciating the need for post-retirement financial security, it is important to bear in mind the imperatives of our demography and economic trajectory. Let me conclude. India currently is the fastest growing large economy in the world. At the same time, it also projected to age rapidly. Currently, every 10th person is over the age of 60 years. By the middle of the century, every 5th Indian is expected to be over 60 years of age. Further, the older dependency ratio is expected to increase from 18% in 2020 to 30% by 2050. exerting pressure not only on our younger generation, but also on our financial resources. Longevity of present and future generation Indian would be much higher. The longevity of women is more than men, underscoring the need for better gender balance in pension coverage. NPS subscriber data from the private sector, including individuals, suggests that only a quarter are women. So this is largely the nature of organized labor force, where there are less women than men in the workforce. Living longer implies that one needs money for a longer period to take care of oneself when one is not able to work, to earn for oneself. The retirement phase becomes more challenging because of the rise in medical expenses, increasing nuclear family structure, and limited access to formal credit facilities. Thus, with every passing year after superannuation, one gets exposed to financial risk unless adequate provision has been made to take care of retirement. The issue of pension coverage, adequacy, and sustainability is not limited to us. It is a global challenge in the face of aging and countries are grappling with. NPS has emerged as a well-regulated, digitally enabled, low-cost pension scheme for all with competitive returns. We at PFRDA are committed to protecting the interest of subscriber and fostering trust in the pension ecosystem through continuous improvement in security, transparency, and operational efficiency. Once again, I thank Hindustan Times Group for inviting me to interact with you. So thank you very much.
Mr. Mohanty, thank you so much, sir, for joining us and giving us some key updates. I'm going to request you to please stay back with me. And Ravi, may I invite you on stage to present a token of our gratitude to Mr. Mohanty. Thank you so much, sir, for keeping us up to date as far as pension is concerned in India. Ladies and gentlemen, one more thunderous round of applause. Thank you once again. After Mr. Mohanty's address, it is time to look at some data and also some strategic thoughts around NPS. And for that, let me welcome Mr. Sriram Iyer, CEO, HDFC Pension Management Company Limited, to tell us how this new system works and well is it working.
It's a privilege to be here. Thank you to the HT Media Group and to Mint for giving me this opportunity to talk about something that's very close to my heart. I'm going to, over the next 10 minutes, and I think the chairman has really sort of laid the foundation and made my job a lot more easier in terms of really talking about the broader pension ecosystem in India and then NPS a little bit. So what I'm going to do over the next 10 minutes or so is to try and make sure that each one of you sitting in this room is absolutely clear about what this product can do for you, what this product can do for your employees. I'm sure a number of you sitting in this room and those of you watching this are opinion makers and opinion leaders in your respective industries. And there is a very strong case that I'm going to make, hopefully, for you to embrace this product and implement it in your respective companies, and of course, as individuals, sign up for this product in case you haven't done so already. Without further ado, let me start. So I think this is known to most of you in the room. I think Indians are financializing their savings. I think the chairman spoke about the fact that the amount of financial assets as a percentage of the overall, let's say, portfolio of an individual Indian has increased substantially over the last 5-6 years. Some of them are, policy nudges. Some of them are technology-driven. Specifically, mutual funds and insurance, I think, has been driven significantly by the advancement in technology and the ease with which you can buy a product, evaluate a product, compare products. And I think that's true for, various other products as well, including stocks, cryptocurrency, though there may be a lot of, not so clear guidelines around how you can buy it and what are the risks associated. but I think there is a significant amount of understanding that is sort of picked up pace. F&O trading, which SEBI keeps flagging off as an area of concern, all said and done, Indians have become a lot more financially literate. Though the financial literacy ratio at this point of time is still at 25%, as Chairman Sir pointed out, it's still significantly better than what it was, maybe 3 decades back when I started my career in banking and financial services. Now, there's a difference between buying products, being aware of products, and planning your finances. And I think there is a huge gap in India when it comes to the two. I see a lot of people, Indians, who want to know what's the tip for the day. There is a fair bit of noise in the media around, what's going to go up next day and what's the, call for the day and call for the next week and call for the next month and so on and so forth. Financial planning, unfortunately, hasn't really kept pace. And if you look at the number of registered investment advisors, this was a category that SEBI introduced, I think, 8 or 9 years back, maybe more. There are only 1,400 registered investment advisors in India. And these are the individuals who are expected to deliver advice without charging or through products which doesn't have embedded commission, distribution commission. And imagine 1,400 RIAs are expected to service a country of our size. Similarly, the number of certified financial planners, this again is a gold standard when it comes to helping people plan their financial lives. There are only 2,700 certified financial planners in India. This is a certificate, there's a global certificate. FPSB gives out these certificates, but there are only 2,700 CFPs in India. 54% of the people don't even know what the CAGR, essentially the IRR or the CAGR or whatever you choose to refer to. In my own experience, anecdotally, there are a number of customers that I have met, who are keen to know about the next fancy product, the next PMS, the next stock, but don't really know how their portfolio is done over the last, let's say, 5 years, 10 years. Is it geared to get them to where they want to get to? They don't even have a goal. Financial fitness score, again, is a sort of a reflection of whether these financial products that have been bought and sold, are they doing what they're expected to do? And I think the jury is out on this. So to that extent, retirement planning and, the subject that I'm going to talk about for the next few minutes really sort of, fades in comparison to amidst all of this noise. So retirement planning as a subject is something that has taken a backseat. And I think as India, we must, while we are enjoying the demographic dividend, as we like to keep talking about. Indians' median age is 29, which means that, over 70 crore Indians are below the age of 29, which I think is a huge opportunity, but therein lies the challenge as well. If you look at the estimates, there was a McKinsey report on aging, which was released earlier this week actually, and it talks about how by 2050, India will actually become an old country. The kind of growth that we are seeing in terms of, the overall population, you're going to start seeing that declining. In fact, India's fertility rate is now below the replacement rate. What does it mean? It simply means that in a few years from now, India's population will stop growing. It is likely to peak at 170 crores and thereafter decline. I think the other thing that's happened is that the social fabric of this country has changed significantly. I mean, gone are the days when parents used to consider their child as the portfolio for retirement. That's quite common. In our society, taking care of one's parents is something that was always the case. But I think increasingly what's happening is that because of rapid urbanization, families are getting smaller, and the needs of the families that are getting smaller are getting bigger. And therefore, this whole investment in the next generation as the retirement plan is no longer going to work. I spoke about the fertility rate and, of course, the old age dependency ratio, which essentially says how many people are going to be dependent on the earning member. And that number is also likely to go up. And as a backdrop, if you look at all of these changes that are actually India by 2050 will have a population equal to the size of United States today, which will be above the age of 60, which I think is a huge challenge if we don't take this head on at this point of time itself. And how are we doing in terms of retirement preparedness? Chairman spoke about, pension assets to GDP being at 16%, abysmally low, huge opportunity for us to grow that. Even countries like Chile, which are a middle income country, are at upwards of 60%. You'll see that some of the, Scandinavian countries and some of the more developed countries are above 100%. So a country, for it to be called a pensioned society, needs to be above 75%, and we are at 16% at this point of time. Long way to go. In fact, there was a Mercer survey that was done in 2023. 48 countries were ranked. India stood 47th out of the 48th country in terms of its retirement preparedness. So there's a long way to go in terms of the opportunity that is there, and therefore I look at it as an opportunity. While it can turn into a threat if we don't address it adequately over the next few years, there's a huge opportunity that presents itself to us. Now, this is something that I think must gain top priority and attention amongst employers, amongst individuals. You need to take charge of it may look like a goalpost or a goal which is 20, 30 years away for some of you who are quite young in the audience. But I think this is something that one must be, and in our own experience, being working with HDFC Pension, and of course having worked with HDFC Life earlier, in my interactions with people who are upwards of the age of 50, a number of them actually talk about starting to plan for retirement at the age of 50. Way too late. And of course, at the time of retirement, there are a number of challenges that they deal with, right? And the biggest challenge is that do they have adequate money, to actually live the next 20, 25 years? It is quite likely that the number of years that one will survive post-retirement may be longer than the number of years that you actually worked. So your income-producing life may actually be shorter than the life beyond the age of 60, which I think is a scary thought, given the fact that inflation for us, for what we consume is growing at 7, 8, 9, 10%. Discretionary expenditure will grow at that rate in terms of inflation. Medical expenses are going at the rate of 12 to 14 to 15%, which means that if we don't adequately prepare for this, this is going to hit us like a ton of bricks. And I would urge each one of you to really pay attention for this. So what I'm going to do really is spend the next few slides talking about a product which I genuinely believe, after having spent 30 years in the financial services space and having seen a multitude of products, here is one product which I genuinely believe it's mostly misunderstood. This is something that, and the chairman spoke about numerous features of the NPS product. I will try and build on some of those points that he made. But more often than not, this is known as the 50,000 rupee tax saving product. How many of you agree with this statement? This is a 50,000, show of hands. This is a 50,000 rupee tax saving product. That's what it is known as, right? But in reality, there is a lot more to this product, and I'm going to, over the next few minutes, talk about 5 myths that are there in people's minds about national pension system. And hopefully at the end of those 5 points, I hope to have convinced you to sign up for NPS if you haven't already, because it's as simple as 1, 2, 3. It takes less than 5 minutes to sign up for a permanent retirement account number. And that's something that I hope to achieve at the end of this. And those of you who are opinion makers and leaders in your organizations, I hope to make sure that you go back to your HR and create enough advocacy to be able to roll it out to your employees. Myth number 1, NPS delivers middling returns. And this is data that's been extracted from from Financial Daily. Now, more often than not, the reason why this is the case is most people think that NPS does something similar to EPFO. While the objective is similar, which is to help you build a healthy retirement corpus, but if you look at the mechanics of this product, it is a comparison between chalk and cheese. So in terms of returns, you will see that, of course, these are returns which are slightly dated, April 2024. But even if you sort of true it up to December 2024, it is not going to look very different. So since inception, returns, actually, the chairman mentioned that in equity is upwards of 13.5% per annum. In fact, NPS Trust, which is an intermediary that has been appointed by PFRDA to monitor the performance of NPS pension fund managers, reviews performance on a quarterly basis. And in fact, they also publish a report which actually compares performance of NPS equity tier 1 funds, compares them to large cap mutual funds. And I'm happy to report to you that as per the last report, life to date returns on NPS equity tier 1 funds are higher than large cap mutual funds. And this is a statement that I'm making with I'm making it with a lot of conscience because this is not known to most people. Also on the corporate bonds and the government securities side, the returns are upwards of 8.5% per annum, which means that this is a product which has got all the benefits, and I'll talk about the tax benefits in some time, but in terms of just sheer performance, it shines through and actually has delivered exceptionally well over the last 10 odd years, 11 years that most pension fund managers have been around. In fact, I would urge you to get onto the NPS Trust website, which is a fantastic website which talks about pension fund managers' performance across different tenures, different schemes, different asset classes. It's very, very, very transparent. So it's actually low cost and high returns and not middling returns. NPS has limited tax benefits, and this is one of the biggest challenges that I see. Most people that I talk to, these could be very senior folks in financial services companies as well, who are expected to know more about some of these products. But I've had numerous instances where I've met people who are very senior in the hierarchy who believe that NPS is a 50,000 rupee tax deduction product. Usme kya hoga, right? What's the big deal about 50,000 rupees? Actually, there are 3 stages of exemption that's available in NPS. In fact, the most powerful feature of NPS is the fact that you can actually set aside up to 14% of your basic under the new tax regime, and this is the only deduction that is available under the new tax regime. There is nothing else that you can do in the new tax regime. As you will know, there are no deductions available. You can actually set aside up to 14% of your basic and basic plus DA, if that is a component in your salary structure, and enjoy the benefit of exemption right at the stage of investment. And of course, there is a 50,000 that's available under the old tax regime under 80CCD 1B. But this 14% is a very, very large. In fact, this was something that the finance minister announced in the last budget, and it's a fairly meaningfully large amount. The second exemption comes at the time of accrual, unlike in case of employee provident fund, where any interest that accrues to your account beyond 2.5 lakhs is charged to tax at marginal rates, which means that if you're at the 20% tax slab, beyond 2.5 lakhs of interest that you make on your account, on the EPF account, you get charged to tax. This is a market-linked product. NPS is a market-linked product. There is no tax on accruals that happen in your account, and obviously these are unitized. This is a unitized product, and there is an NAV of the product as well, and therefore it gets treated akin to how a mutual fund gets treated. Finally, I think this is something that is much ignored, which is the fact that at the time of maturity of the product, this product is completely tax-free. Right? So there is no incidence of capital gain tax at the time of maturity, which means that if you were to invest a similar amount over a 25-30 year time horizon, and there's an example that's been taken with a certain amount of money that has been invested on a monthly basis, you actually stand to gain a bonus of 1.35 lakhs of pension per month over and above the corpus that you would have created of close to 11 crores. So I think, and there are some assumptions that I can share with you as to how we've come to this number, but at a higher rate of return by an actively managed fund vis-a-vis an NPS, you can actually make more given the fact that you're getting tax exemption at the time of investment, and you're getting an exemption from 12.5%, which is the capital gains tax that you pay on equity funds. No flexibility. This is something that I keep hearing about, saying that this is a very inflexible product. In fact, in my opinion, there is no other product which has so much flexibility, and it is across multiple things, in terms of multiple parameters, not just in the form of flexible contribution. You can start with as low as 1,000. You can start, stop, pause at any point of time. There are 4 asset classes that you can invest in: equity, corporate bond, government securities, and alternate asset classes. The allocation, which is between these asset classes, and Chairman referred to auto choice and active choice. Essentially, for a sophisticated investor who wants to make a choice of asset class and asset allocation on his or her own wealth, you can actually go ahead and choose up to 75% in equity as an asset class, and build a portfolio which can give you really meaningful returns over the long period of time. In fact, not just that, under NPS, you can actually choose a different fund manager for every type of asset class, which means that for equity, you could choose fund manager A, for corporate bonds, you could choose fund manager B, and for government securities, you could choose fund manager C. So there is that level of flexibility that is available, and you can change the fund manager once every financial year, right? So which means that if you're not happy with the way the fund manager is done, you can actually change the fund manager, choice of fund manager, and of course change the asset allocation actually 4 times a year without any tax, without any charge. Yet another product, yet another feature which I think is not very well understood is the fact that this is a product which, this is probably the only product which comes with auto rebalancing, right? There are some vehicles in the mutual fund space and insurance space which do offer this capability. But this is the product which actually readjusts your asset allocation at your birth anniversary, which means that on your birthday, every birthday of yours, it will bring back the asset allocation to what you have chosen, be it in the auto choice scheme, as per whatever, in the active choice scheme, as per your choice, or in the auto choice scheme based on the choice that you've made of, the moderate, aggressive, or the conservative scheme. And of course, finally, it's very portable, which means that for you to move the scheme from, if you're employed with company A and you move to company B, as long as both of these companies have empaneled with NPS as an offering, changing your employer status from employer A to employer B is a matter of 5 days, right? So it just takes 4 or 5 days for this change to happen. Entirely digital, right? There is absolutely no, there's no requirement for you to submit papers and documents. Number 4, this is something that I keep hearing about. NPS is illiquid. Once I put in the money, I can't get out. Therein lies the opportunity. Therein lies the opportunity to actually make 78% more than what you would make in a product which would have liquidity. If you had liquidity, if you had an ability to exit the product whenever you wanted to, you would end up doing that, and you would therefore compromise on making returns. This product actually can give you significantly higher returns given the fact that it is a locked-in product. Finally, this is yet another thing that I hear from HNIs, the high earners, that there is a 40% that has to go to annuity. Let me tell you, there is no other product which can guarantee you a fixed rate of return for your lifetime, right? Annuity is the only product that can do it. Optically, the rates may sound a little lower, but the reality is that 20 years from now, you will get the same rate of return on annuity as at the time of sign up. So with that, I just want to sort of sum up. This is really a very powerful product. I would urge you to sort of get into the pension companies. I mean, HDFC Pension's website is fairly educative. NPS Trust, as I told you, is also fairly educative. And you'll be able to pick up more details from there. Some of you here, those of you who are, you must go back to your HR and speak to them about signing up for NPS, corporate NPS. Those of you who can influence and advocate, you must push for advocacy around opt-out. In fact, there is no compulsion for you to invest beyond 12% of 15,000 in EPF. The rest of it should go to a market-linked product like NPS, where the opportunity for you to make returns are significantly higher. And of course, there is tier 2, which I don't want to go down the path because I'm already out of time. So I'm going to end here. HDFC Pension is the largest private sector pension fund manager, managing over 1 lakh crores. And we work with over 3,000 companies and over 4 lakh subscribers, and helping them, have held over 4 lakh subscribers get on board the internet. It's time that you join us. Thank you so much. Thank you.
Thank you. Thank you so much, Mr. Ayer. Please stay with me. I'd like to invite Alokesh Bhattacharya, Deputy Managing Editor, Mint, to kindly present a token of our gratitude to Mr. Ayer. Gentlemen, please take center stage. Center stage, please. Mr. Ayer, thank you so much for sharing with us your deep understanding of the pension ecosystem, for taking us through the current framework. Thank you very much, sir. Thank you. All right, let's talk about bull markets. A time when everyone's portfolio is glowing, optimism is high, and it feels like these are good times that are going to last forever. But seasoned investors know, understand, and agree that markets are cyclical, and protecting gains during good times is very important as seizing opportunities during the tougher ones. This, ladies and gentlemen, is where hybrid funds come into play, acting like that financial multivitamin that balances both risk and reward. In 2024, not too long ago, let me remind you that India's stock markets continued their stellar run with Nifty 50 delivering over 15% annual returns. Retail investor participation hit an absolute record high, and AUM in hybrid funds grew by 20%. These funds, which blend equity, debt, are very uniquely positioned to navigate volatile markets, offering both growth potential and stability. So the question is, how do fund managers decide when to pivot from aggressive to conservative strategies? To talk about all of this and more, we're going to invite our next panelists who are going to decode both the art and the science behind hybrid fund strategies. We, of course, have a stellar lineup. Meanwhile, I must remind you and invite you once again to please join us on your social media platforms to share these conversations with the larger community out there. And when you do that, please use hashtag Mint BFSI 2025. Okay, here we go. Let's first invite our moderator for the panel, Neil Borate, editor, Personal Finance, Mint. And our panelists, Kalpen Parekh, Managing Director and CEO, DSP Mutual Fund, Navneet Manoj, CEO, HDFC Asset Management Company Limited, Sankaran Narain, ED and Chief Investment Officer, ICICI Prudential Mutual Fund.
It is very rare to have such a power-packed panel, and it's quite a privilege to have folks who, control the vast majority of India's mutual fund industry's assets. So we're going to talk about an issue I think that is foremost in people's minds, which is hybrid funds and the role of debt. But before we get to that, first, I'm going to just go around my panel asking them about what the equity market prospects look like. We've all made a lot of money in the past couple of years from equity markets, but valuations in some pockets are arguably stretched. So if I can begin with Narain.
Actually, over the last 18 months or so, we've been cautious on small and mid caps, but they never corrected. Whereas large caps have corrected more, primarily because of the fact that FIs have sold a lot of large caps, whereas the mid and small caps have basically been invested by the domestics. Currently, if you look at the exuberance, I would say that the exuberance is in SIM, small caps, IPOs and mid caps, and the level of exuberance in large caps have come down significantly. That I would say that large caps are marginally overvalued and no longer significant at this point of time after the correction. And overall, there's no problem with the macro, there's no problem with the banking system. Maybe there is some slowdown in growth, but that can easily be reversed. So, but the challenge is really coming out of the investor exuberance in small caps, IPOs and mid caps at this point of time. And what worries me is that what we've seen in the past is when there is exuberance, sometimes there's a period of underperformance also, because exuberance is replaced with apathy, and that's my biggest worry at this point of time. So I would say systematic investing in large caps, there would not be a problem. Systematic investing in flexi caps would not be a problem. But that's where we stand at this point of time.
Navneet?
Thanks, Neil, for having me. So we have seen 9 consecutive years of market rise in India. And in last 4 years in this bull market, this is the first time we have seen a meaningful correction. Otherwise, people got used to an environment where equity markets only give positive returns quarter after quarter. I think this is a healthy correction. This is also led by the moderation in the economic growth and corporate profit growth, which both have come lower than the market expectations. And of course, foreigners have been continuously been selling in the secondary market. We've also seen a large supply of primary paper, and which has absorbed a good part of the domestic liquidity that we have witnessed. But I agree with Naren. I think the long-term structural bull story of India has not ended. The corrections are part and parcel of that story. And I think once we have some bit of, after this price correction and some bit of time correction, again, markets become healthy, and would advise investors to remain disciplined, continue with their SIPs, look at their asset allocation, and don't get swayed by the volatility, but take advantage of it by remaining disciplined in their investing.
Do you broadly share Naren's assessment on mid and small caps, or a differing view?
You asking me? Or?
Both of you.
First.
I'll answer in two ways. I think all of us have mentioned over the last several quarters that there is part of market where there has been a lot of fraud, stocks where there is less floating stock, huge retail interest, driven by the narrative more than the numbers, have seen significant rise in price, running far ahead of fundamentals. They had to get corrected. Some of those have got corrected, but still there is part of market where our fund managers believe there is still some fraud. Investors need to be cautious on that front. Having said that, I wouldn't put in, of course, at the index level, and the large caps are, are trading at a premium, which has the premium compared to longer term average has come down. While in mid and small cap, they are still much higher than the longer term averages. But I've mentioned this several times over the last several years that given the changes and given the transformations that are underway on many spheres, we are in a world where nimbleness and agility would trade at a premium to size and stability. And that is what we have witnessed in the last couple of years. But investors need to look at each and every company from a bottom-up perspective.
So we express our views and opinions through the products we launch or promote. And while we speak, we are launching a nifty private bank ETF fund. So that's an indication that where we see some comfort, relative comfort. Or, few weeks back, we launched the largest 10 stocks of India, just a 10 stock, largest cap index. Now, what does that indicate from a viewpoint of view? That the rest of the market has run far ahead of what its fair value should be. And I think nothing new that I'm adding, that we find large caps relatively more, I won't use the word safer, because in equity, saying safer is not technically correct. Secondly, to the first question, historically over 30, 40 years of equity markets, 25% of times annual returns of equity can be either negative or less than fixed income. And that's the broad framework of equity, that while in the long term it earns 1.5 to 2 times of fixed income, but there are periods when it underperforms fixed income or even doesn't give capital back. So after...
So you said 25% of the time?
20 to 25% times annual returns are either negative or less than 7-8%. So this is one of the year, Nifty returns are just around 5% right now. Nifty 500 would be just in line with bonds or even gold. So while long-term returns, 30-year returns of Indian equity markets are 12 to 13% CAGR. But last 10-year returns are very high, because 10 years back, the last 5-year returns were 0. And we started at 12p. Today we are starting at 22p. So with that context, we need to align back to very long-term median rates of returns that the equity asset class has given, which are always superior to fixed income. But in between, the path can be unknown or uncertain or volatile.
So it's a somewhat downcast note. The path is going to get tougher going ahead. But are there particular themes that stand out? Naren, you could elaborate on that?
The theme that actually we did last year was that volatility in the global markets are bound to increase, and in Indian markets are bound to increase. We show off actually for the first 9 months last year. But if you look at the way the global economy is at this point of time, you have a situation where there is a fair amount of
parts of the world. So I think one of the clear themes over the future will certainly be, I think you'll have much more volatile markets than what we have seen. And it's not that we haven't seen volatile markets in 2007, 8, 9, 10, 11 and all that. But for some period of time now, people have got used to the fact that equities have always delivered positive returns. I think that phase is likely to be challenged, and you're going to see both up moves and down moves. I think that is a clear theme at this point of time. Clearly, I think also that thanks to an area where possibly we all understand less, how artificial intelligence and various other things, how they're going to disrupt the world economy and how are they going to disrupt businesses is something which we're going to see over the next decade. But possibly we are not aware of how it is up now. So if you go back and think when the mobile phone came, we didn't know we'll be hostage to the mobile phone on WhatsApp and YouTube and Instagram, and how the mobile phone has taken over our lives. Like that, how artificial intelligence is going to change the way we live and think. We won't know today what will happen over a period of time. When did we know that mobile phone will take over our lives? We didn't know. But like that, things will happen, and that will be another trend. And clearly, I mean, the rise of what policies US is going to follow over the next 3 to 5 years, 4 years is going to be something which none of us know, actually. And I think the whole world is eagerly looking forward to the policies, or eagerly worried about policies. What is going to happen? None of us know. And I think that is something which again is a theme, because end of the day, if you're going to have such huge tariffs in a country which has never had tariffs, it's going to be a very, very different world. And that will be a clear theme. These are some of the themes we are looking at this point of time. And we'll move on, because the stock markets in India and in the US, these are the only two stock markets, and that too in US are the two markets which are actually costly. Almost all of the markets are easily valued. So the implied assumptions are very low in all the other markets. So these are the two markets where we actually need to think what can happen. In all the other markets, growth is not implied at all in the share prices.
So Navneet, in a scenario like this, are hybrid funds the way to go?
Not only in a scenario like this, but always, it's a lesser known fact that concrete is the second most used material by humanity after water. And the reason is that concrete is a very strong material because it has the sand, cement, gravel and water in a right proportion. That's true for portfolio also. The only difference is that it's the same proportion for the concrete, I mean all these four underlying materials, but each investor to fortify their portfolio, the asset class mix would be different, but it's very, very important to pay attention to it that different asset classes play a different role in achieving your financial goals. And the industry, I think what we have done a good job as a mutual fund industry is to provide products where you can match your asset allocation need through one product itself. So right from, let's say, a hybrid debt fund where you have equity up to 25% and remaining in fixed income, to equity savings, to a dynamic asset allocation fund, a balanced advantage fund, to an hybrid equity which is 65-35, so on and so forth. And we have made it far easier for the investor to, instead of choosing many funds, to put one fund and then take allocation to different asset classes. Kalpan rightly mentioned earlier, there are different periods where different asset classes do well. And I think this is how you fortify your portfolio. And I'm sure whether it's this time period only highlights the importance of having that kind of a portfolio.
Kalpin, I'm going to throw probably the most two difficult questions at you that generally get asked about hybrid funds. So number one, the counter to hybrid funds from distributors, advisors, etc. is we will do the asset allocation. Why should the mutual fund do it? Because we want control. Second is expense ratios are higher. So what is your view on both these points?
Both are valid points because you can't deny that, yes, you can do asset allocation. Of course, please do it. No doubt, slightly expenses are high, but there is a huge advantage of timely rebalancing, number one. So I'll give you an example of March 2020, 23rd March, which was the lowest point. On that day, in hindsight today, was the best day to invest. But on that day, almost all of us didn't know whether we would survive or not to come on this panel again, right? Because lockdowns were announced, COVID was just firing at its peak. If I would have gone to an investor and said that, rebalance from your debt component to equity today, the odds are most would have said no, including myself. So on that day, I myself did not move anything in equity, but my dynamic asset allocation fund moved almost 20% from debt to equity. So the emotion is taken away in an hybrid fund because your mandate is to rebalance just because asset allocation has got skewed. And I think the power of automation or automated disciplined rebalancing is foremost over anything else. And that is why I have myself given up my own ego to say that these funds will do a better job than what I can do. In my personal, today in fact, we are releasing a report card for all investors invested in DSP, so I was just seeing my own report card. Around 22% is in hybrid funds. So I have personally felt that the need to rebalance, the need to worry about tomorrow what will look good, what will not look good, is taken away by hybrid fund. The price to pay here is that it may earn, in the very long run, lower returns than equity if we are a market like India and US. There are many markets globally. In fact, when we did our multi-asset fund, and more than hybrid fund, one step ahead is multi-asset, which introduces gold and global stocks also. In most markets, a multi-asset product has done better than the equity market of that country, including developed markets, including growth countries like China, including blowing up countries like Pakistan. So that's what data shows, that the power of collective asset classes with relatively low correlation has lower volatility. And I believe that investing is not as much just data and numbers, but a huge role of emotions. So what happens is in volatility, our emotions make us, misbehave. In bull markets, we like to buy the smallest of small caps, which have given the highest return. And in bear markets, we want to go to government bonds. Multi-asset funds, hybrid funds do the opposite, do what is right to do. And I think that's why I succumb to the power of sensible investing that automated funds bring in. Last point, if volatility is less in the path of the NAV, odds are we will stay invested for longer. If we stay invested for longer, automatically the power of time ensures compounding takes place. So to my mind, multi-asset funds or hybrid funds are great vehicles for compounding and not for tactical returns.
I'll just mention one point, that it's not that distributors don't allocate to that. If you look at some of the largest funds in the mutual fund industry, they are asset allocation products, right? The largest actively managed fund in India is HDFC Balance Advantage Fund. And a larger proportion of that has come through the distributors.
Before I go to Naren, Kalpin, just one point on your multi-asset fund. Do you have leeway to invest in foreign stocks, or that's under the RBI limit?
So broad limits are full, we all know. But at a house level, we have seen some outflows from our gold mining fund, selectively from our US fund, which, as Naren mentioned, is also at the peak of valuations. So that has freed up some limits. So right now, no one is queuing up anyways to fill up that limit. So currently, we still have small limits, and we are happy to continue to invest globally. 16% of the portfolio is global at this point in time.
Fantastic. Now, Naren, there is a bewildering variety of hybrid funds, everything from conservative hybrid to balanced, aggressive, ESF. Do you have a favorite at this point of time?
No, actually, what happens is if people are very positive, we tell them invest in aggressive hybrid. People are moderately positive, we tell them invest in multi-asset, particularly people who want some amount of gold, silver, etc. People are neutral, we tell them invest in either balanced advantage or asset allocator fund kind of thing. People are negative, we tell them invest in equity savings. So this is how we structure the conversation, because sometimes, when we meet people, there are people who today the entire market is so positive on equity, to get them to invest even in an aggressive hybrid category sometimes is difficult. Because they have seen only equities and only positive returns. So that's why we
if I had a choice, I would be in the middle rather than most aggressive. But if the market were to correct a little bit more, I would go into the most aggressive hybrid categories.
Navneet, one other interesting thing that's happened after the last budget, two budgets earlier, is hybrid funds being a replacement for debt given the taxation on debt. So to what extent is the industry able to design funds that mimic debt, minimizing the risk but delivering tax efficiency?
No, of course. I mean, efficiency has been inbuilt in all of those products. As I mentioned that if you go for a hybrid debt, 75% in debt, 25% in equity, and depending on your own asset allocation preference, you can choose a product. In fact, you asked about like one product, and which is a product. A simple product is like an hybrid equity, which is 65-35. It's a automatic allocation, right? So he mentioned about when equity markets are not doing well, automatically you will be selling fixed income and buying more equity. When equity markets are at an all-time high, automatically you will be booking profit and reallocating that too. So even the fund manager is not doing the market timing. It's so automated there. The father of the modern portfolio theory, who gave us all the concepts about asset allocation, efficient frontier, how to optimize asset allocation, was Harry Markovich, who expired in 2023. But the legend has it that he used to, for his personal money, used to allocate 50-50, 50 to equity and 50 to fixed income, and keep it like very simplified. People have won Nobel Prizes, people have done so much, I don't know, hundreds of people would have done so many PhDs with so many sophisticated models in last 50 years on that. But the father of that theory was keeping it so simple. And I think keeping it simple through a product like that would be the best way.
We'll now turn to an area that's quite exciting, which is GIFT City, especially in light of the RBI restriction on future flows into international feeder funds. So, Kalpin, if you can tell us about the product that you intend to launch there.
So, currently, we've operationalized our GIFT City operations around a year back, and we have some global investors who invest in India through our GIFT City platform. Maybe my data says we are at this point in time the largest real money deployed on GIFT City. For Indian investors, we are working on an LRS fund where the investor, like I have my LRS limit every year. I have to go and separately invest. Instead, I can now go to DSP's LRS fund. I think by March we should be able to launch it, and through that we will be building a global portfolio. Currently, we are in the process of building the portfolio. We've hired a 2-member team which analyzes global stocks. It will be a global fund investing across the world around the same principles of good companies at good prices. It's agnostic to geography, market caps. The thought process will be where do we find good cash flows at good prices. And like Naren mentioned, most parts of the world are I won't use the word cheap, but they don't have great expectations. So in that sense, it will also give some diversification to investors who want to have some bit of dollar assets via equity as an asset class.
Just to clarify one point, you said retail fund, right? So it will not be an AIF. Minimum will be not.
So we are working on both the options. So we have an AIF option and we have a retail option. We'll start with the 1.5 lakh option, and then we'll start with the retail fund.
And in terms of inbound, what do you currently?
In terms of inbound, again, like the Indian investors who are excited about our equity market prospects, now a lot of NRIs. I don't know after this recent correction if that trend changes, but there is demand that, okay, we want to, in dollar terms, invest back into the Indian stock market. We all have the benefit of now funds with 20, 30-year history. So we are putting one or two of our very old funds on the GIFT City platform as fund of funds, feeder funds. So an NRI can buy into that fund in dollars, and that fund will convert the dollar into rupee and invest in our DSP Tiger Fund or DSP Equity Ops Fund. These are funds with very old history. So that also we will enable mostly in a month or so.
In a month or so. Navneet, you have approval for 6 inbound funds. So
Yeah, so at SDFC AMC, we have been deeply committed to using the Gift City as a platform, both for the inbound as well as outbound investment, but more on the inbound side to support India's capital formation and also to onshore what has been offshore historically. And we have 3 products live with an AUM of around $150 million. These 3 funds feed into the domestic mutual funds, which have a long-term track record like SDFC Balanced Advantage Fund, SDFC Flexi Cap Fund, and SDFC Mid Cap Fund. Flexi Cap Fund, as you know, has a 30-year track record of wealth creation, and it's easier to present that product to whether it's NRIs or global institutions or the other global investors to invest into India through the Gift City route. And we think that over a period of time, we will get more interest from global investors who want to invest in India. And I think the Gift City authorities have done a wonderful job in making that seamless and easier for global investors to access Indian markets.
You said $50 million, right? Already?
150.
150. Oh, that's fantastic. Okay, I'm going to probably go to everyone's favorite question at this point of time, and then we'll open up for audience questions. So please be prepared, which is budget expectations. Kalpen, can we start from you?
Not thought about it, to be honest. And, I'm 52. Every year budgets come and go. And I have to do what I have to do, earn my salary and invest that sensibly for 10, 20, 30 years. I keep it very simple. I have no idea. Sorry to say that I don't have an answer.
And in short, supporting growth, but I think from an industry perspective, we would urge a favorable view towards debt fund taxation. I think, India is going through an early stage of financialization of savings, but it should not be an equitization of savings. I think we need to look at broader asset classes. It's very important to develop the corporate bond market in India. It's very important that we create retirement security for 1 billion Indians, and that's why a favorable tax treatment on the bond funds should be looked at from a more larger prism than only the revenue maximization.
Thoughts?
I don't know how to convey that everyone expects that the budget will be path-breaking. It's not possible because you've already brought the customs duty down. You've taken GST out of the budget. You've brought income tax to more reasonable levels. So how much change can be done? All that can be done is this year what we are hoping they'll give some incentives to the lowest level of income tax bracket. And what Navneet mentioned, that you can't have all the incentives only for equity investments. You need to have some incentives for long-term investment in debt. But to expect that the budget can be such a transformational is not possible. No government can do it today in India at this point of time.
Fantastic. Any questions from the audience? Please raise your hands and we'll probably get a mic to you. If not, we'll go to concluding thoughts. Anyone, last couple of seconds, you can raise your hands and we'll pass the mic. And in case I can't see you, maybe you'll have to stand up because there's a lot of lights glare. All right, we have just 2 minutes left. So, okay. Is that? No, okay. Kalpen, can we start with you? Concluding thoughts.
So I think investing is very personal and each investor has to invest basis his risk appetite. Over very long periods of time, different asset classes behave differently. So if you're doing SIPs, equity is still a great asset class. Flexi cap funds are superlative because only one installment is getting deployed today. Most money will come over a period of time. If you are nervous with fluctuations and volatility, then hybrid funds are great. Typically, in the past, when valuations have been high, in the next 5 or 10 years, hybrid fund returns and equity fund returns are not too different. People equity and debt, it's not that the debt component earns zero. It will still earn 7 to 8%. And there are times equity has earned, modest 8 to 10%. So these are better times, with more uncertainty around us. Actually, uncertainty is there always. And somewhere in Intelligent Investor, I have read that if you want to, focus on your life and, just focus on increasing your salaries and earnings, invest in yourself and forget. And if you don't want to track market sectors, market caps every day and want to just say, I don't know and I don't care, invest in multi-asset funds. If gold does well, your portfolio will have it. If global stocks do well, your portfolio will have it. If equities does well in India, you will have it. If they don't do well, bonds do well, you will have it. That is a better way to avoid distraction and, be a very long-term disciplined investor. Last point, last 3-4 years, the lessons learned and maybe influenced by one of the TV series was, I think there was this very popular line people use, risk hai to ishq hai. But I think my message would be risk hai to sirf risk hai. Ishq apne paise se aur family se karo. Don't, try to, there's no need to be too brave about these things. Movies, it's fine. But when it comes to investing, be disciplined, be humble. Markets can surprise us. Most often we don't know. We just we aim to make honest, intelligent guesses. But the world is highly uncertain. So acknowledge that and stay disciplined.
Index funds, and how do you see them performing?
Who are you directing the question to? Anyone? Okay, anyone?
I mean, as I mentioned earlier, India is at a very early stage of financialization of savings. We have a long way to go. Large number of people are yet to meet the market, and there would be both ways. They can do passive, they can do active. Active fund managers have done a phenomenal job over the last 30 years. I mean, I just talked about 30 years of HDFC Flexi Cap Fund. You can see many other funds in the industry like that. And I see the same for a long time to come. Having said that, I think industry offers all kinds of opportunities to investors to participate in the market. So in India, the debate is unlikely to be active versus passive. It will be active and passive coexisting to provide opportunities to investors to participate in the market. Participation in the market is a bigger thing that all of us need to solve than it's kind of like at the products.
Right. I think this concept of future of passive is no longer relevant because passive is also present. So while active, passive, both will do well. Both are ultimately giving you exposure to the underlying asset class. The only difference is one is more rules-based, the other is more judgment-based. And the rules are also in a way formed based on some judgment. Passive is already in the present because even as we speak today, 20-25% of flows are going into passive. Passive products are becoming more mainstream across retail as well as high net worth individuals. And the beauty about our industry, why mutual funds sahi hai, is that it allows anything and everything that you want to do through active, through passive, through equity, fixed income, commodities, global, India. So I think the industry has already, built a very powerful bouquet of all types of funds. And the power is in your hands today as distributors, partners, or investors to mix and match or to choose whatever are your belief systems. I think here the belief system is not about what we believe is right or wrong, but what is suitable for each investor. And the whole array of products is today ready and available to our investors.
Any quick concluding thoughts?
Yeah, so I mean, I discussed about the modern portfolio theory, which considers volatility as a key risk. But if you are a long-term patient investor and investing in a disciplined fashion, then volatility can act as an advantage, not as a risk. And that's a critical point. there is only one formula of wealth creation. There is only one formula of wealth creation, and that is, just to create an acronym, is STP. It's sound investment plus time plus patience. Sound investment plus time plus patience. And in times like these, your patience get tested. And if you remain resilient, if you remain disciplined, if you don't get swayed by the volatility but take advantage of it, I think you will create wealth in the long run, given that we are in a country like India.
So we've been continuously focusing on asset allocation. So hybrid funds completely meet the test of asset allocation, particularly multi-asset. So that's clearly the thing. One point that we want to specifically say is in the 2007, 8, 9 cycle, corporates took the decisions. Very often they made the mistakes. Banks supported them by lending. Investors lost sometimes by the mistakes made by banks or corporates. In this cycle, corporates are not making the mistakes because when corporates take any decision, they actually raise equity through IPOs or qualified institutional placements. So the role of the investor is very important because the investor is taking the decision to invest in these corporates today, because the investor is the person financing everything today. So I would say the investor and the wealth manager today is very important at this point of time, and they have to recognize that they are taking the risk on the investment. That's why asset allocation turns out to be the best and hybrid is the best, because you're not taking all the risk. But otherwise, actually, the entire decision making has moved in such a way that the risk is being taken by the investor and not by the corporate and not by the bank in this cycle.
Thank you so much. We've got a nice overview on hybrid funds and also Gift City and some of the exciting launches that are happening there. Thank you so much for joining us today and for listening to us so patiently.
Thank you.
Neil, thank you so much for moderating this panel. I'm going to request you to please offer a token of our gratitude to all of our panelists. And ladies and gentlemen, can we have a huge round of applause for our power panelists for not just sparing their time, but for giving us some incredible insights on the world of hybrid funds. While our panelists do their thing on stage, I'm going to invite all of you to join us for lunch. We will reconvene with the summit at 2 p.m. sharp. See you all on the other side of the break. Ladies and gentlemen, these were our amazing partners who make events like these possible. A huge thank you and shout out to Zafin, GSA Advocates and Solicitors, Airtel Payment Bank, PhonePe Insurance, HDFC Pension, NetApp, Equirus, Capital, Axis Max Life Insurance, IndiaLives.com, and Fisdom. Thank you so much for your partnership. I absolutely love the buzz in the room, and I seriously hate interrupting your conversations, but actually I'm not interrupting them. I'm just redirecting them towards the stage, ladies and gentlemen, because our next panelists are all set to give us their wisdom today. So may I have all your attention towards the stage. As we're going to start by begin by talking about startups. Because regulatory-wise, they are walking a tightrope. Should fintechs have more freedom, or should regulators ensure stability? We're going to discuss how India can strike the absolutely right balance between innovation and regulation. And to do that, we have just the right power panel. Before I invite them on stage, I'm going to remind you all to kindly place your cell phones on the silent. And international business transactions, banking and knowledge units, Yes Bank. Naveen Surya, co-founder of Beams Venture Capital. Anuj Kakkad, co-founder of Frio. Anish Mashruwala, partner banking and co-chair, finance practice at JSA Advocates and Solicitors. That makes up a wonderful panel. Over to you, Gopika.
Good afternoon, everyone. We really have a very challenging task before us to keep you all awake, but I'm sure I have a very exciting panelists. So just like the vibe that you feel when you meet fintechs, I'm sure this panel also promises to keep you awake. So good afternoon and welcome to this panel. Indian fintech balancing disruption and innovation, balancing regulation and innovation. Clearly, Indian fintech industry has grown into one of the largest ecosystem, the world's largest ecosystem. And this is all because of the numerous innovations that are happening, and that has made payments and financial services accessible to millions. But clearly, this transformation comes with a lot of challenges. The Reserve Bank's annual report for FY24 shows that internet and mobile frauds have quadrupled. And clearly, regulatory crackdown on fintechs have also increased over the last 1 year. While some believe that RBI's approach has been quite heavy-handed, it has also paved the way for self-governance of fintechs. Well, so the question is, how do we strike a fine balance between innovation and regulation? And to answer this, let me first get across to the only fintech in the panel today, Anuj from Frio. Anuj, you're into credit, you're into investments, you're into insurance, you're into payments, which means you have to handle multiple regulators. How do you do that? You think your business model has changed over the years, handling all these regulators and also staying on top of innovation?
Yeah. First of all, thank you for having me on this panel. I can see that since it's a fintech versus the regulation innovation balancing act, I'm right in the center of this panel. I don't know if that was planned or not, Gopika, but seems like it. Yeah, I think, listen, we do have multiple regulated entities like NBFC, we are regulated by the RBI. We have our insurance corporate license, so IRDA comes in play. We are getting into wealth side, so there's something on the SEBI. Not just that, in fact, non-financial, for example, we have to work with a lot of guidance with the TRAI because we do a lot of communication. And whatever else is remaining, I'm sure we'll take those as well. So it seems like that's the way to go. But I think the entire regulation piece is, I think it's pretty sense. There is no, it's either a 0 or a 1. So either you're compliant or you're non-compliant, right? So it doesn't matter, I think, in the eyes of the regulator, and rightly so. And we all, as we make business decisions, all of us, you can't just say that, for you guys this is okay, for you guys this is not okay. It's very difficult to otherwise have very clear communication and clarity down the road. So this is wrong and this is right. As simple as that. Now, it is so large, it's wrong or right, so that's where the gray areas come around, and that's where you end up seeing that a lot of businesses either do start and then they have to shut shop or whatever else, or change the models. So the evolution of this binary risk of whether it is 1 or 0 is this entire thing of letter and spirit. So you may be right in letter, and if you are not right in spirit, then that also is over a period of time will become a problem for you. So I think in given the way like you mentioned, the frauds have quadrupled and so many other things that are happening, we don't have an option but to be compliant in letter and in spirit. Now, I must say that it's not that we were like this, say, 5-7 years ago, and maybe Naveen will add to that. But I do think all of us, when we started off our journeys as fintech founders, we found what were the arbitrage areas and say, hey, this is a great way, maybe we can play there. Maybe that was a superpower back then, to find that arbitrage. Unfortunately, you can find pricing arbitrage, you can find customer arbitrage, you can find product arbitrage. But a lot of us, and I'm equally to blame here, we found regulatory arbitrage. And that caused a problem. And suddenly you see that because a lot of action that's happening is because it's been building up for the last 5-7 years, that slowly the regulatory arbitrage became so big that probably it becomes a little bit of a larger risk, and frauds have increased and so on and so forth. So today, I think that the people who have gone through this journey know how to work in a place where there is regulatory arbitrage. Now, the smart guys have said, we will not work in the regulatory arbitrage space. People who have worked in the letter but not in spirit have now realized that I should be in letter and in spirit. So I think new folks who have come in, it's very simple for them. These are the guardrails. Please walk. Here is the way you do it. Now find innovative ways to do it. If you can't find innovative ways, maybe you should go somewhere else. That's fine. But this is what the guardrails are. Earlier on, the reason why we're facing a lot of heartbreak is that we've gone all over the place, and now we're being forced to put in guardrails, so now that's tough. So I think that's where we are all evolving towards. Good, bad is a little bit subjective. I have enough grouses in terms of to say that what can be done better, and that'll come from a very selfish, my company, my fintech view, and I may or not understand a lot of the macro aspects, which I'm sure there are reasons for, but I have suggestions of how it can be handled better. And that dialogue with the regulator will keep continuing. I don't think that's a problem. But how do we manage compliance? It's now not an option for us. Our compliance team has increased, and our compliance cost has also increased. We are, in fact, adding more people to it. But that is just the nature of the beast now. And people who do not accept that bit will today or tomorrow have a problem. So if innovation is getting stifled, then you need to think harder. That's the bottom line, essentially.
Right. Let me come to the banker, Ajay. Yes Bank has a lot of relationships, tie-ups with fintechs. You've worked with a lot of fintechs yourself. How has this bank fintech relationship matured over these years, and especially at a time when regulatory tightness has also increased? Of course, the Reserve Bank catches the throat of a banker to ensure that the fintechs toe the line. So, how have you seen this evolution?
Yeah, is it working? Yeah. So, Gopika, before I come to that, I think, it's pertinent that I mentioned, we are at a very fascinating, intersection right now where financial innovation has absolutely, disrupted the whole ecosystem. I think the way in India, especially, we interact, we save, we borrow, we lend, everything has seen a transformation, from a consumer perspective, right? And when I say consumer, not only individual consumer, but also businesses, especially MSMEs. We've seen a massive transformation here. Needless to say, it is a combination of fintechs powered by banks, which have actually carpe diem this opportunity and have created this positive disruption. So I think that's first setting the context here. But we've heard you talk about the regulatory part, so I just want to maybe mention this here, that none of this innovation would have ever happened but for the proactiveness or the progressive thought process of the government in creating this whole digital public infrastructure, which is at the backbone of innovation in India, and a very progressive regulator who has made sure that there is a fine balance which is being stricken between innovation, especially financial innovation, and security in terms of the public at large. Because again, we should be cognizant that India has a spectrum of people, right? You have people who are digital native, yet you have a lot of people, who do not understand or, see a risk in digital. So it is always a fine balance that you need to strike between how do you include everyone, because you don't see the benefits unless there is a true financial inclusion, bringing everyone into a financial or a credit inclusion, right? So that has been extremely important, right? So coming to your point in terms of the fintech and bank collaboration. So earlier on, I think a decade back, if you ask me, there used to be, in similar forums, I think the question was always, will fintech eat up the banks? Will banks eat up the fintechs, etc., etc.? I'm very glad that, we have evolved over a period where I don't think those questions are asked at all. It is now, I think, very well ingrained that it's all about co-optation. Each one has to play their role. Each one has to understand and, of course, then play the role. Innovation is fostered only when both of them work together, right? And, of course, they understand that which entity needs to play what role. So a bank inherently, has to be, is the to play the role where, governance, control, cybersecurity, all of those predominantly, the response. It's not that it's only the bank who needs to take care and the fintech can just, concentrate on the innovation part. Of course, it has to be mirrored. Whatever is the control which the bank is expected to ensure needs to be mirrored in the way the fintech is also building their business. So hence that intertwined responsibility always remains. And I think that has been the secret of success, in my view, over a decade. If we have seen, the Indian fintech ecosystem becoming the third largest, or in terms of valuation, a 3 trillion valuation, which is expected to go to 11 trillion by 28, is only happening because I think the sweet spot of collaboration has been identified between banks and fintechs, and a very, very progressive regulation in terms of creating that governing framework of growth in a controlled environment. I think that is really what is fostering the Indian fintech ecosystem. I think it's on the right track. That is what I would believe.
Let me come to Naveen. No, I know these two are registered bank and non-bank, so they will all be praised for the regulator. You are more open to speak your mind. You've worn several hats as somebody who run a startup, to an investor, and to somebody who's the chair of the association, one of the founders of GFF. So I think the list will go on for Naveen. So you have a very, very broad perspective on the industry. Also, you've dealt with the regulators. How do you see fintechs now balancing this innovation, disruption, customer centricity, and governance, which are the two key words for the Reserve Bank? Your take.
Sure. So disruptors are getting disrupted. That's what you're trying to say. It's a good thing, right? So let's see, how did we reach here? If you look at probably 2.5 decades, that's at least been my journey initially we were called non-banks, then at some stage digital financial services provider, fintech, etc. Fintech word I think is just about 1.5 decades, if I'm not wrong, right? Or probably less. Broadly, what's the ecosystem today? You're talking about 10,000 plus entities. I think one of the largest, neck to neck with any other entire ecosystem of startups. This is the largest system. Obviously, in terms of 2015, just one unicorn, if I'm not wrong. You guys have a lot more data. Today, over 26. I think I saw some data of September last year. and expected to be over 100 in 30, right? So which means the wealth has been created. Interestingly, also now listed space, there are close to 10 companies. If I'm not wrong, probably whatever rough estimate I did, $20 billion worth of market cap you're talking. So growth has happened. It has happened on back of especially innovation, especially all the things that fintech had done. And if you look at the overall impact, I just want to remind us all of two big events, which probably we wouldn't have been able to handle unless fintechs took a backseat, and obviously not front seat, with a lot of support from all the other institutions like bank. One, of course, is demonetization, right? We saw what happened with digital payments, that time being there at the right time, and how we could kind of survive that phase. And the entire COVID. It's not just payments, look at trading accounts, the way it opened, look at wealth, look at lending. I mean, everything, wasn't for digital processes, probably that would have been a huge crisis that time. So we've seen and we are beneficiary of all of that, right? Now, you're right that there are two parts, which is what has eventually caused all this disruption, especially from regulator, which is customer centricity and governance. So let me first briefly talk about customer centricity. See, if you see fintech from a perspective, and if you look at the data, banks are and growing, right? So if you see again, probably from 30-40% adult banking population to now 75% plus, again in a short period of time. You look at insurance, probably less than 1%, 1.5%, today probably 4-5%. Look at lending, probably very single digit of a GDP percentage today, and probably Anuj will have a better data, probably 10-20%, still probably 10 times behind China's numbers. But reality is you have grown still from a leaps and bounds in last 10, let's say 15 years especially, if not the entire 25 years. And probably fintechs can take some credit that access and financial inclusion definitely won with the collaborative approach that Ajay was talking about. That we have seen these are the outcomes, you can't deny it. The challenge comes, Gopika, when you talk about the entire customer life cycle management. There are three broad buckets. One is acquire customers. That's where probably most of the work has been done, and amazingly well done, and we are seeing how it is improving every day, right? Your 24/7 mobility, anytime, anywhere, low cost, all kind of models, all possible because of that. Transaction, I think it's kind of a work in progress. The maximum time a customer spends with all the institution is during transaction. Pre, post, this is your continuous engagement, right? There have been challenges, there are continuously challenges, but reality is that is one area where the improvements are being focused now. The new area that will eventually come, and I was chatting with even Ajay offline, is one area which is exiting the customer. There are certain processes where a customer also has to exit gracefully. And that's one area probably is not just for fintech, but I will call out entire sector. It's been even personal experience, fails miserably. I mean, there are instances where, let's say, loans you have taken, not updated, still reflects in your... So, and it's not the intention. It's the complexity of the system, it's the processes, the pace at which we are growing. So these are three buckets. The last two buckets, and especially the second bucket, where the RBI is putting more and more focus at how do we make sure that the focus on the transacting, and if there is a money at risk, gets, let's say, into focus and fixed. And that's how you saw many policy frameworks, and I'm sure Anish will talk about it, is about new regulation that came around, the resolution of complaints, grievances, the committees required, etc. And it's continuously growing. More and more norms are coming. One thing I can tell proudly that in the ecosystem, and again credit to the ecosystem and the regulator and the government, we have not seen in a regulated space licensed players the frauds. The instances will be, at least I am not aware from the fintech, that people have lost money from a regulated and known fintechs. At least that has not happened. So that's a good part. The issue is in experience, in the behavior, what is happening at that time. That's getting under fix now. And like I said, exit remains a problem. Governance. I think that's the last point which I would say. That is one area, I think, which is a big mindset issue. And probably it's not just about fintech. I think as a country, if you see governance per se, whether you're in a listed space, whether you're in any industry, traditionally, historically, has not been very good. In fact, we should be proud that because financial services are regulated, the sensitivity is higher. Challenge happened, Gopika, where, let's say there is a fintech, and like I gave you the scale data, the number data, the values. Let's say there are 20 fintechs which are probably as big as some mid-sized bank or a small bank. And probably you find that probably in their board you have just two founders and maybe one director, somebody else, right? Who's again not sure whether he's independent or what caliber he is. You have a committees, right? So partly it's a wake-up call for the fintechs also, that if you want empowerment, if you want to behave like a bank or want to do more, then please look at larger NBFCs, systemically important entities, banks, how they behave, how they are governed. So larger you get, you need to have a proportionate compliances, framework, etc. coming into play. Fortunately, I think post-COVID time, last 5 years, a lot has changed. Today, most of the fintech I meet, they have 1 or 2 expert directors on their board, most of them. And most of them at least have advisory board, and now increasingly they're inducting new independent board members. The challenge remains on this large number of new ecosystems still coming in. And that's where probably the entire ecosystem has to work together in a newer entrepreneurs coming in, who come from a product and a demand supply mindset, who needs to understand in financial services, compliance, transparency. It's a fiduciary business, kind of responsibility business. It's not just you become larger, then your responsibility drastically changes. If you're going to start becoming important, especially above a few thousand crores, it is going to impact the economy and you will be looked at very, very seriously. So that mindset, awakening, etc. is required. Probably we are getting there, but that's an area I think we all need to work. So that's the initial views.
But you've seen that change in the mindset among fintechs.
Absolutely. I mean, Anuj who's talking about he's right. They know that the compliances will increase costs, but they're prepared for it because they see the benefits also against that, right?
Gopika, when you hear a fintech say that regulation has to be followed in spirit, not in right, your mindset has changed. I don't think.
I wonder what spirit you're talking about. I wonder what spirit you're talking about. But let's come to Anish, because I'm sure all the fintechs come to you for getting legal view either before a regulation come in or after a regulation come in.
Correct. No, so this is good. This is when he says spirit, right? In the last 2 years, right, the number of fintechs, whether just service providers or in the regulated space, right, whether NBFCs, they are now coming for the governance model, right? And I think that is the real shift that has happened, where the RBI is now very clearly set out that this is what we are trying to focus on. We want customer centricity and we want governance, right? And this balance between innovation and whether this is a good disruption or a bad disruption, right? That is what sort of the regulator has really come out with. And the fintechs are catching up, right? I mean, this is about first get the buildings done. We have now about 3,000 plus fintechs, 10,000 probably. The ones which are known are, sort of in that market. But all of these have now got models, they've got innovative ideas, they're now in, right? Now this is the beautification of that, right? So in terms of governance, in terms of good governance and customers' trust, and centricity that is there, the ones that will now move towards that. And we have seen that in the last, as I said, 2 years, of course, post-COVID, there was a rush of trying to take, first mover advantage, which was sort of lost in the middle. But after that, this is where, governance has come in. It's also been a sort of a journey, right? From the RBI earlier, if you take P2P lending, it was rampant. There was no regulation, there was nothing around it, till it became a disruptor that the regulator thought we don't want to sort of just go over the board, right? And that's where you had the first sort of regulatory bits coming about.
Same
right?
with FLDG.
Exactly, right? So this is where, and I think the regulator has also come out as, as Ajay said, that this is a very, very bold regulator who's also very progressive, right? And is saying, we don't want to take away innovation. We want to take the balancing factor here, but also please be cautious. Let's do good governance at the same time when it is impinging on the larger sort of customer base.
So innovation is clearly good for the system, that is well agreed upon. Anuj, what are the immediate challenges and opportunities that you're seeing from innovation?
I think this is a little bit of a broader topic in terms of what are the opportunities. The opportunities, that is just immense. And with new technology coming in...
Where do you see now? You can...
No, I think Naveen pointed out the under-penetration of financial services in India is tremendous as compared to other emerging markets. Whether you look at... we are very good at savings, although even the savings rate drop was now has been corrected. I think in the FY25 now it's up to 7% of net savings. But other than that, whether you look at insurance, whether you look at wealth, whether you look at lending, payments is the only thing that's actually done very well in terms of, and I've probably gone into 300 million or more customers only because, UPI has been there and it is, it's free for the customers at least to do it and it's rampant and a lot of people have put money behind it. But every other financial product as such is underpenetrated. I mean, we are not the segment here that is, I'm sure everybody in this room has 2 or 3 bank accounts and they have relationship managers who, if they call, they will come and say, what do you want? But that is not true when the minute you go out to the next tier of cities for that matter. Even outside of, little bit outside of Bombay for that matter, you will not find that happening to the customers. So financial services products are very underpenetrated. Credit cards, maybe unique credit cards are still under 50 million for that matter. When people are doing QR code payments over 300 million, why should credit cards be so less? Credit is itself very low. Insurance penetration is very low. Wealth is very low. So the opportunities are immense across the board. Technologies are coming in which are constantly disrupting it, whether you look at AI or a lot of other technologies that everybody's trying to build, whether it's across fraud or not, facial recognition. A lot of these things were not there earlier on. The one call out actually I do want to make is, I think what Ajay was also alluding to, is that with DPI, what's happened is that the entire process is now standardized. So 5 years ago, or maybe pre-COVID, maybe in 2017, 18, I would say my process is better, customer, come to me. I can do it in 5 minutes, I have this technology, my design will be better, I will do facial recognition, I will do this penny drop, I will do this, I will do that. Ekdam fatafat 5 minutes mein ho jayega, whatever you want. Today, everybody is doing the same thing, including the banks. So the process part actually that innovation has been made standardized. Everybody is saying that you have to do this, you have to do this, you have to do this. Just pick and choose between these 2, 3 things, pick one. So the process part has become standardized. So now everybody has to work hard on what the value proposition has to be to the customer. Because the innovation that happened in the past now cannot be the innovation of the future, right? And I think the challenges part, I think, is very clear. I think that also, the world of finance, unfortunately, is very sovereign to the country and to the land, right? So you have to be a little bit careful. It's not like, say, quick commerce, or it's not like, selling shoes, or it's not like FMCG, which is very, you can do what you want kind of stuff as long as you broadly follow the rules of the land. Financial services is people's money, people's trust. There's a regulator whose job is to keep it secure. Our job is to keep it secure. So it's always going to be challenging to do the next level of innovation, lest it does not become it does not become a problem for everybody else. A lot of fraud that you're seeing with this digital arrest or whatever else that you see is all happening because people are able to quickly take the money out of that. That should not be the case. How should anybody be able to take money out of my bank account? And it's also not fair to say that the people who are unaware are doing this. People who are educated, people who work in the sector, who are working in a good job, probably in IT, they are getting defrauded. So it's pretty sophisticated, or we just don't pay attention to it. So I think that the challenges are probably a lot, and if I have to put it in context of the regulatory aspect, the innovation curve will be a little bit slow. Because I think the unbridled innovation that we did, maybe those days are probably gone, so you have to be a little bit careful about what your next step is. So that is going to be the challenge. If you want to come in and you want to just disrupt everything that's happening and do a completely new way, especially in this sector, that might be difficult to do. But you will have to bide your time and keep finding the bright spots as you go along, and then over a period of time it will cascade or it will compound into something bigger, which is probably not true in some of the other sectors. Other sectors you can say, I've completely new way of doing business, completely different. Here's what I'm launching. If I put in the adequate capital and my value proposition is good, I can suddenly create a complete new industry, which you will probably not see in the world of finance because it's very sovereign to the country. So I think those are the challenges that you're seeing in innovation.
Ajay, what do you think? It often, fintechs are always a step ahead of banks when it comes to innovation. Banks do the catch up. But going forward, how would you sort of look at optimizing this relationship to look at newer ways of doing things?
I have a fundamental disconnect with your statement itself, but give it a pass.
No, you are free to.
I will tell you what.
So, Gopika, see, again, I think, it is, you have to first also see that if there is an innovation which is being fostered by any fintech, right, it is eventually being hosted on the back of the rails, which, the bank is providing. So the whole, and I'll maybe, say it as a startup bank itself. So we are India's only greenfield startup bank. We globally pioneered the corporatization of API banking, 2015. That powered the whole payment ecosystem getting flourished, right? So UPI as an infrastructure was there. How does the UPI go into the public? API banking was which completed the whole offering, right? Which was being used by the fintech ecosystem. So I think it's a bit unfair to say that it's lagging and so on and so forth. So I've given you the masala you wanted now. But having said which, let me come back on specifics, right? So again, see, 1.4 billion people, crores of MSMEs, opportunities immense everywhere. But since you wanted specifics, I'll give you three, as a practitioner point of view, I'll give you three specifics where I believe there is a lot of, opportunity still to innovate and probably do more. One is on lending. India is largely under-penetrated on lending. So I think lending will continue to remain very critical. And with more and more information now available through surrogate ways, ULI being a classic example, right? What is ULI really, will achieve in its due course is it will get API access to all information, all ways of collecting surrogate financial and non-financial information, bring it to a common platform, democratize for use across the ecosystem, right? So that could propel the next wave of innovation. So banks, institutions who are here in terms of their digital innovation are already using it. But institutions which are not as adept today can use a common platform, democratized platform like ULI, and all come up to speed in terms of really including credit, right? That is one. Second, I believe payments, while on the domestic side we're really doing well, continues to grow. Cross-border payments still, I think, is a holy grail which needs to be needs to have a lot of innovation. Again, from a regulatory perspective, PA, CB guidelines, will go, I think, a next step in terms of formalizing innovation around cross-border. CBDC, in my view, will, propel on the domestic side, inclusion of payments in areas which are low internet, no connectivity. So where digital is not penetrated because of various reasons, offline CBDC could be the way ahead in terms of fostering innovation, and same with cross-border, right? So that's second. And third, I strongly believe that B2B SaaS is where a lot of innovation can happen because the way DPI is getting developed, the way volumes are scaling up, banks' own infrastructure also needs to be brought up to scale, right? Now, this whole question of build or buy will always come into play. And this is where I would believe that a lot of banks would benefit by taking the partnership approach and partnering with companies who are building in a very agile manner the technology, and bank brings it into their fold. So that I think could be a next opportunity. It would have been very cool for me to have talked about AI and other things, but I just wanted to give a practitioner's view and not go
we already had a panel on AI.
Exactly.
So, when it came, you spoke about ULI. Just a quick question. But ULI can also lead to unbridled lending. Will that be a challenge?
Why would you say that?
You have access, fintechs, banks, NBFCs have access to so much data. Do you fear?
No. So ULI is at this stage, is only creating those access points for you to get information. So today what happens is, when I look at lending, we are looking at it in a very traditional way. So you are looking at maybe collateralized lending or, some forms of lending. What ULI is doing is it's giving you access to data points which in normal course today you may not have, used. So you are getting that access. Now what you do with that access continues to be, in terms of your business rule engines, your scorecards, which you have to create as per your own policies, right? So, the access creation right now should be segmented from how you are using that access. I think over a due course, the two may converge. But eventually it's all about how you use those access points to, foster more, including more credit lending. I think that's really where the point is.
Naveen, you want to jump in on this, or should we move?
No, so I would just talk about challenge very quickly, just very one. So there's one fundamental issue when it comes to challenge, and rest are symptoms according to me. See, you are successful in DPI because you had a top to bottom, everybody clear. What are the key drivers and you're creating to solve what? Whether it was access to identity, whether access to payments, etc., right? Unfortunately, when it comes to fintech, there is no single integrated framework or vision or approach. You have a fragmented regulators, you have a fragmented policies, you have a fragmented products. While, I keep giving this example that today, the whole KYC process originates from PMLA. But the way it gets implemented across the regulators, across the sector, within the same entity for different products, it's very complicated, right? While we've solved for time, but complexity, cost, I don't think we have solved. It's just an example. So fundamentally, we need to have one clear vision about this segment. We are already third largest ecosystem. We could be first, right? Given the opportunity. But we need to have clarity as to how do we want to regulate it? What needs to come? Because in absence of that, other than payments, we have not seen a common, clear vision and a roadmap, right, from the regulators also, as to what they are saying, which again leads to this whole roller coaster journey that we were talking about. The things are scaling up, suddenly halfway through, suddenly something is getting stopped. So the experience to the customers, again, they don't know. On the other hand, P2P, for an example, one example, we're supposed to disintermediate, customer is benefiting, for an example. Regulated, scaled, suddenly stopped, right? So how do you have a better approach when to de-risk, when not to de-risk? Rather than from 100 to 0, 0 to 100, can we have a better approach? And this comes to the roadmap, lot broad thought. Opportunity side, I think most of the points already covered by both of them. The only additional point is that one has to look at from a maybe 5 to 10 year perspective, not immediate, is the combined effect of AI, and one thing that I again deliberately repeat is quantum computing, which we are missing. I think people are not realizing what will happen. You'll be in a very different world. So that AI, blockchain, CBDC is going to be a different world, and that's going to create very different opportunities. Yeah.
Actually, just jumping in, heartening to hear that, from a very legal perspective, coming from a practitioner's perspective, is that, you have the data privacy, the DPDP rules that are coming, and this, especially for fintechs, right? It's a huge infra play also to develop systems, because as data fiduciaries, we are looking at, at least from a legal practitioners, right? It's definitely a challenge that's going to come across, where all of these, fintech companies, especially in the whole ecosystem, right? They will have to look at how they change and safeguard data, the leakage of data, both, where the data is placed. I'm not a data expert, but that is where a lot of the current fintechs coming to us, right, are looking at those challenges and how we are going to deal with them. So that is one. And I think the other bit very quickly on the opportunity is, this interplay between insurance, right, and the fintech sector. We have now, if you look at new innovation, it's interesting for us also because these new fintechs are coming into the place where they want financial inclusion to go into another industry, right? So where, you're looking at trying to finance which banks, as other regulated bodies couldn't do. But fintechs are in that space where they're trying to push that envelope and enter that inclusive space. So the great part is that, it has great opportunities. Question is, will it go into that regulatory realm, which then requires some sort of, policies around it. And this is especially, we have products that are going into health insurance. Those bits are something that are opportunities, but also...
I know time is running out, but...
Upika, on a lighter note, the fourth biggest opportunity is open a legal firm.
Yeah, before we wind up, I have one question and I can't let them go without asking that. Self-governance, the self-regulatory, the SRO model which has now come into being. Anuj, is that a good thing, bad thing? You think fintechs can police themselves better?
Police is the right word here. The SRO, in my personal view, I am part of various forums that have debated this SRO thing. We were part of some forums that had requested for an SRO for that matter. The SRO has to play a very key role in making information run both sides. If you look at the SRO as only information flow from one side, that's not good. on either side. It cannot be from the regulator down, say, this is what it is, just do it. Of course, we'll take feedback, but then I'm just telling you what to do. And SRO, dear SRO, go implement it. That's, in my opinion, that's a waste of an opportunity. And the other way also is not good. That this is just to say that, let me combine everybody and keep giving feedback, saying this is not working, that's not working, and you will not be able to have any regulatory authority. So both are not good. I know even though without an SRO, for example, some of these industry bodies that I am part of at least, whenever anybody else looked at that company and said, are you a member of this association, means you are following some basic code of conduct. We have we have signed code of conducts for all these companies, and if you don't follow the code of conduct, you not become a member. I can't enforce that code of conduct. I have no legal right to do it. But even then, we're just saying it's just a right thing to do. So people have found benefit in that. Investors have found benefit when they're looking and evaluating and doing a diligence on that company. So the SRO is very good if it really works independently and works both ways. If not, I don't think the SRO will help, at least in my personal view.
Ajay, what do you think?
Gopika, from I think a banker perspective, it is reassuring. It makes sure that there is a certain framework and standardization. But beyond that, in terms of our approach towards a specific company or in terms of the business model, I don't think SRO it is going to really impact the ways that we would look at things, right? So if today I evaluate a certain company or a business model in terms of its risk parameters or other things in a certain manner, I don't think I will change that, even if SRO comes in between, because end of the day, as a bank, as a fiduciary institution, I am responsible to the regulator, and we need to make sure that they fit within the bank's overall risk acceptance guidelines.
Naveen, SRO, is there an alternative otherwise?
I think you are talking, when you're talking SRO, primarily RBI SROs, right? Because if you look at other sectors, I think things are a lot simpler, less complex. Clearly, end-to-end ecosystem is already regulated. And you're again talking 3 new SROs. Now, again, there are examples where without being SRO, industry has been working fine, which is banking. IBA has been playing that role, even without being SRO, right? So fundamentally, the SRO became relevant when the ecosystem grew too large. And the institutional capacity for regulators to, let's say, interact, deal with the nuances, dynamics started becoming challenge. And again, you needed to take policy decisions faster. But again, you don't have adequate data at that point in time. So idea was to solve these problems. And since you were looking at, for me, being open on the RBI, I personally believe current 3 new entities or 3 new, not entities, but 3 new policies for 3 new SROs. I see some gaps there or some, let's say, some thought still need to. For an example, I see that, let's take an example, if you are a NBFC, right? You will be regulated, or you're already regulated by one department of RBI. SRO, there will also be SRO of NBFCI within that department. Now you're suddenly talking LSPs and DSAs, etc., right, who are not regulated. They will likely to be not part of that forum. They will be part of, let's say, a different department's SRO forum. I personally see this as a slight bit of a fractured approach. And similar examples exist in payments and everything else. So I think while it's a good thing, it's required. In one time, industry has been asking. Today, I see some industry players being divided. Some of them think we're too big. Why should we even be regulated? So that's a different thing. Nobody wants one more person to regulate them. But reality is it's required, but needs to be done properly. And I think we're losing too much of time. Actually need to act versus discussion.
No, I actually have a slightly different take on things. I think SRO is the alternative currently, and I think it's nascent. We don't know how it is. Fragmented bit will go, but I think it is impossible for the RBI to balance, as a regulator. And I think, therefore, having an SRO to create some sort of industry standards in processes, not in the regulatory bit. And I think, as Ajay also said that this is something that may not change from a banking perspective. But if you look at Anuj, he says it is correct. It has to be both ways. If you want processes to become standardized, you need some industry representation for that. And I think that time will tell. I think the SRO is a way for the RBI to sort of decentralize it rather than regulate it.
No, just clarification. I didn't say SRO is not required. We were the ones, in fact, I was the chair in all the associations and running voluntary SRO. I'm saying the way the current policy framework and the reason is not getting implemented is these are fundamental challenges, this whole approach, and how are we going about it.
Standardization, creating the framework, and the tracking, ongoing tracking, I think is what is going to give a lot of reassurance to A, the regulator, and B, the ecosystem, say banks, etc., in terms of what the SRO is really giving. Now, beyond that, if the regulator thinks of empowering the SROs more, of course, as and when that happens, then we will have to figure out what role the SRO is playing, and hence how much impact it has in the.
Okay, thank you, gentlemen, for joining us. I hope all of them have kept you all awake with this really insightful discussion. So clearly, innovation will always do a catch-up with regulation. Regulation will do a catch-up with innovation. This debate is going to continue, but for now, thank you all for joining us.
Thank you so much, Gopika. Gopika, please present a token of our appreciation to all of our panelists. Conversations like these, we wish we had more time, but thank you all for panelists for making the most of every moment. Our panels once again. Gopika, thank you so much for moderating that conversation. NBFCs have been crucial in expanding credit access, especially in the underserved areas. But should they be allowed to raise public deposits like banks? Is the question. In 2024, NBFC credit grew by 15%. However, high-profile defaults also raised concerns. Should India follow global models like the US, or shall we just talk and create our own path? To answer all of these questions and many more, we have an upcoming panel discussion, ladies and gentlemen. And while we turn the stage around, I want to remind you once again, in fact, I can see a lot of new faces, so you surely joined us later in the day. I'd like to invite all of you, make sure you visit your WhatsApp, and when you registered today, you would have received a WhatsApp message from Mint BFSI Summit that invites you to network, but just to do it more strategically and purposefully and easily and effortlessly. So if you look at that message and you hit join now at the bottom, you will be given with options of several profiles and subjects of conversation that you can have with the rest of our delegates over here. Choosing one of them will then allow you to network with someone that shares a similar interest, and that's how we can make things easier for you. So I hope you all are making the most of it. Without any further ado, let's invite our panelists on stage, beginning with our moderator for the discussion, Shayan Ghosh, editor BFSI Mint, who will be joined by Jairam Sridharan, managing director, Pyramid Capital and Housing Finance Limited, Manish Shah, managing director and CEO, Godrej Capital, and Jinay Gala, director, India Ratings and Research. Ladies and gentlemen, we really need to up the quotient of applause. Come on. It's an exchange of energy and ideas, so let's play our part. Thank you very much.
So very good afternoon, everyone. The theme of this panel is something that many NBFC executives have very strong opinions on, at least in private. So the Reserve Bank of India is not very keen on allowing more number of NBFCs access to public deposits. That's something that banks clearly have, and banks have an edge there. So NBFCs argue, of course, that while the regulations are being tightened and they are said to be at par with banks, why not have access to deposits? So with that, I'll start with Jairam. The first question is, if you could just broadly lay out how important are deposits to an NBFC?
Thank you for having us, Shayan. Great to be here. And congratulations to Mint for another great awards session. If you talk about NBFCs and the liability strategy of NBFCs, right? Like you got to, let's think about what are the different ways NBFCs can fund themselves. The largest portion of how NBFCs fund themselves is loans from banks. That's like half of how funding happens, or a little bit more than half. There's a little bit you can borrow from the Indian domestic bond market. But that's only available largely to AAA and AA plus names. Below that, is almost no availability, but you can do a little bit of that. You can do some securitization. You can do some international borrowing, right? That is pretty much it. If you don't have deposits. Deposits, for those who do have deposits, it can become a sizable portion. Let's say 10-15% of your borrowings can actually come from there. For those of us who don't, that's a big sort of gap in your liability strategy. In an environment in which the regulator is worried about banks lending to NBFCs and what the regulator talks as issues of there being a conflation of risks between the two industries, right? So if the regulator feels, hey, banks should step back a little bit from this whole NBFC lending opportunity, then for us as NBFCs, there are precious little avenues available on what to do. And hence you're seeing a lot of NBFCs go to the international markets in recent times, try and raise money in international markets. But of course, that worsens the external debt to GDP ratio of the country. And there is a dollar USD INR issue which comes up, etc. But that's really the big path available. And hence you see every large name NBFC in the last 6 months has gone to the dollar market to raise money, even though it's so much more expensive to do that today, right? And if the same NBFCs that have been in the country for a very long time and have very deep reputations, you see Godrej here, you see Piramal here. Tata raised money last week in the international market. These names, these institutions that have been around for many decades in the country.
Taking the answer forward, when he talked about international funding, I don't think the RBI is also very happy with the amount of ECBs that NBFCs are raising, maybe calling it an over-reliance on one kind of funding, moving away from banks, of course. What are your thoughts on that?
Sorry, is your question, is the regulator...
No, the regulator... So what we heard from RBI Deputy Governor this morning is, about this over-reliance on external funding abroad. Is that something that you're also, seeing in industry?
Yeah, I mean, I couldn't agree more with shouldn't have over-reliance on any one source. And with that in mind, to the question, to the group and the topic for the panel, is should we be allowed to look at deposits? Easy short answer is yes. Obviously we are an interested party in being allowed to, but I think from so many angles, one, banks and non-banks are intertwined, the risks are sometimes common. So it's logically from so one, looking at it from the country's point of view, it makes sense to not have non-banks and housing finance companies dependent only on banks. So you should have alternate sources. ECB is clearly one of them. We did a couple of raises. It sometimes works out, where the primary purpose is bringing down your cost of funds. Sometimes the primary purpose is a mix of that and or diversifying your liability mix. But very often I think we've overlooked the consumer. I think I can speak for a lot of ourselves and our parents here, mine for sure, that this was an important source of income, right? Where you get deposits, where you get interest from a trusted name, oftentimes higher interest rates than banks do, but very similar risk profile, especially when you look at trusted names, where you can get the premium without taking the incremental risk. So I definitely think it's worth looking at a broader range of liability mix for us as an industry. External, for mix. Not my place to say that, is the amount, is it very high right now? Should it be brought down? It's probably as a participant, we view it as saying it's a beneficial component to have. I don't see it becoming a very large part of any of our mixes. In our case, it's under 5%. I suspect that's true of most players, where you use it as a source, but you're not over-dependent on it.
Coming to Jinay, I mean, we heard both of them, but where do NBFCs then go? You're not supposed to be over-reliant on one instrument. You're not supposed to have too much of loans from banks. What are the other avenues that are available right now that are also cost-effective?
Yeah, so thanks Shan, for having me. If you look at the NBFCs, the way they have evolved, right now the size is quite material for a lot of NBFCs, and it's very much comparable to a lot of mid-sized banks. And that is the key area, I think, so the regulator is also focused on, where the rising systemic importance of non-banks in overall lending space has been driving them to contain the risk which could come through because of the interconnectedness between the banks and the NBFCs. As it was rightly discussed, the banks forms a substantial part of the funding. And if you look at the collaborate that data, that it has largely been around 55 to 60% during FY24 or FY23. Of late, it has come down. But non-banks cannot shy away, or even banks cannot shy away from lending to non-banks because it forms a crucial part of their strategy. It's largely that few banks have hit their limits and have been bringing it down to a certain extent. But we see again the Q4 of last year was lull. This Q4 would again be a little bit better. So there would be again pullback on the bank funding to NBFCs. Coming to the key element, what are the different sources for these NBFCs? You need to bifurcate NBFCs into different rating spectrum. If you look at the higher rated spectrum of NBFCs, there the Reliance, they have a plethora of availability of funds where you can go and raise ECBs, you can do securitization. There are few deposit taking NBFCs also. But all this has to be mined with the kind of an ALM risk you are taking at. Coming to the mid-sized NBFCs is the area where we see there could be some amount of build-up which needs to be there as they are over-dependent on the bank funding, where incrementally there needs to be an alternative source which could come in. Right now there is securitization which is largely playing at that space. Also we are seeing that a lot of the non-banks have gone ahead and done co-lending in that particular space. It's the key challenging area is the A-rated and the below entities, where we see there is an over-dependence on the promoter funding. Also, they are largely supported by the DFIs who have come into the market, and a lot of them are also exploring the co-lending route. But that is the area where we see there could be some amount of effort which needs to be built on ground, largely to bring new age NBFCs to the market, where right now the funding environment remains quite tighter, and largely it's more for the unsecured players compared to the secured players.
But otherwise, does it also impact the cost of funds?
Yeah. So coming on the cost of funds, if you look at, that's a completely different ball of game. You need to look at what's the arbitrage available between different instruments of funding available to you. Right now, as it was rightly discussed, the ECB has been more flavor of the season for higher rated NBFCs, largely because it's coming at the same rate compared to what the NCD would be there on the domestic market. Even if you look at the deposits, deposits also, if you add the cost of the government securities you need to keep in around 15% odd, that adds a 20 basis point cost to that. And technically you also need to do a lot of ground level effort to raise deposits and manage it. So on totality, you need to look at how the cost plays out between different instruments, and that would largely drive the cost of funding for an NBFC. Right now we are seeing that there has been some amount of cost of funds which is on the elevated side. But the NBFCs have been judicially managing their cost of funds right now in the market, where they have also gone through securitization route, where if you look at the overall funding mix, 20 to 25% of the overall funding largely comes from securitization right now.
Right. Manish, so see, hypothetically, if you had a deposit license, the customers would benefit because they would get a higher rate of return compared to, say, what they get at banks. I mean, I'm not just Godrej anywhere, I mean, in terms of NBFCs. But would the borrowers also benefit in that case?
You mean the consumer, right?
The consumer.
Sorry, the consumer of the lender or the consumer of...
No, I'm saying that your depositor would get a higher rate of interest than, say, banks. I mean, for other NBFCs, not just you. But then would your borrowers also have some benefit?
I think the main benefit is to give any consumer the choice. So, for example, if you have money or you want to put your savings to work, you should have as many options as we can give them. You have your bank, you have the bank FD, you have a corporate FD, it gives you a, in your asset allocation, you get the choice to play that risk return spectrum. So would the person giving, the deposit taking entity benefit? For sure. Is there a benefit to be had on, on the other side, which is, let's say, if the NBFC's loan customers? I suspect the more comfortable you are with your liability side of the franchise, there's that much more you have to lend. If you're fortunate enough for your deposits, to be able to take deposits and then that brings down your cost of borrowing, are you able to pass that on to the consumer? The market will push you to do so. And if that happens, your consumer will benefit. Last but not least, increasingly every large institution, any financial institution wants to do more with an existing consumer, make more products available to them. Right? So for example, if you're coming in to a, let's say, to a service provider, a financial service provider for a product, the larger your suite of products that you have to offer them, again, just open up the choice. Let them decide whether just the hook product or just the entry product is what they had. That's all they want to do with this company? Do they want more than one? Are the next set of offerings attractive enough? As long as that, you're opening up more choice for the consumer, keeping the bar high as far as your requirements from the financial service providers, making more choice available to the customer, I don't see why not. And I don't see why both sides, whether liabilities or assets customers, I don't see why they both won't benefit.
Okay. You want to add to that, Jairam?
I think the question is less about the cost of the service and a lot more about the availability of it. See, NBFCs today are about a quarter of all the lending in the country, right? Give or take about 25% share of lending, and this 25% just happens to be the lower end of the consumer segment. It's not the same consumers that the top 75% is serving, right? Banks are serving the more urban, slightly more affluent, more white collar, more salaried type of customers. A lot of the rest is actually being attended to by NBFCs. When you think about that self-employed individuals who runs one small puchke ki dukan on the main street of some tier 3 town, 5 people aren't lining up to give that guy credit, right? The guy who's going to give that guy credit is a guy who's comfortable with actually doing that last mile credit access, take a little bit of extra risk, go into underwriting that guy's business, that guy's income directly, etc. And more often than not, it's going to be an NBFC, right? That's going to offer that. The question is, does that consumer get access to credit, formal credit, or do they not? The only way to keep giving them access to credit is to keep sectors like NBFC thriving. It doesn't need to get than what it is from a proportionate standpoint, but for sectors like NBFC to even remain at about 25% of the banking sector, it is important that there be a corresponding liabilities base, which is also growing. Your liabilities base cannot be degrowing and you are trying to grow the asset side. That is not possible. So when you say, hey, NBFCs shouldn't depend that much on banks, hey, bond markets aren't open to most NBFCs, except the top few that are rated AAA. Then you add on top of that the USD INR type issues and essentially say, hey, ECBs as well, beyond a point, one shouldn't expose. Then the rhetorical question that you asked a little bit earlier is a very valid question, which is where are NBFCs to go to raise the liability side, and at what point does that liability side growth become a binding constraint for providing access to credit to those segments that only NBFCs end up serving?
Okay. I had a question slightly different from the deposit franchise, but on the regulation per se. Not just NBFCs, even for HFCs, the regulations have tightened after it moved from NHB to RBI. How do you deal with these tightening regulations? And what would be your suggestion?
See, that's not just an India phenomenon. Like, this is globally, financial services, particularly lending businesses, have become more and more heavily regulated. That's just the nature of the beast. Financial services do work with public money and are highly leveraged businesses, so margins of safety are low. So it is natural that oversight needs to be really tight. I don't think, as practitioners of the industry, you will hear a lot of people complain too much about regulations becoming too tight. Yeah, regulations are tight and they are getting tighter, but that's the nature of the beast. It doesn't bother us too much. What I think one looks for, and what thankfully we do have in India, is consistency, a transparent rule of law, right? The RBI, however much you might talk about whether they are very strict or too strict or whatever, they are transparent. You know what they stand for. They articulate what their top priorities are, what are they worried about, etc. You might or might not agree with whether those specific things they should be worried about, but there's no surprise about they are worried about X, right? So I think as regulated entities, we need to find ways to provide solutions to our customers while remaining within the ambit of whatever is the law of the land and the regulation as put forth by our regulator. I don't think too tough or too lenient is really a worthwhile. I don't try to ask my children whether I'm being too strict a parent. And if I did, I don't think I trust their answers.
To you, Jinay. We spoke about deposits earlier, and do you think there should be some sort of grading? I mean, RBI already has an upper layer, middle.
The regulator has largely put in which are the entities are more crucial or systematic important to them. Where there are few deposit-taking NBFCs also into that. What this largely does is that the frameworks are largely getting aligned between the banks and the NBFCs. But incrementally, as the entities mature enough in terms of their size and scale, and also their ability to demonstrate those regulations which have been laid down last 2 years back, I think so it would largely give the regulator comfort to think of what could be the additional benefits which could be passed on. But coming to the point of deposits, I think so just wanted to highlight one more piece on that, is that deposit for an NBFC needs to be dealt with little bit caution in terms of the way they manage their ALM. Because deposits can see a faster withdrawal. The persons who are investing in the deposit may not be that much matured, who would be largely coming in the NCD route, or the HNIs who would be coming in the NCD route. So you need to have a fine balance between the both, the way it gets managed on the ALM front. Otherwise, since the NBFCs do tend to lend to a mid to a longer duration kind of an asset size, this could lead to a short-term volatility in their ALMs, and that could pose a risk to the overall system and the liquidity. So the regulator is also grappling the way that they want to manage this ALM of the NBFCs. The deposits, if they pass through, that has to come through with other mechanisms and other risk folding arrangements which needs to be come through. Then I think so that could be a way out to bring deposits for NBFCs. So it has to be matched with the way the ALM gets managed, because in the past instances we have seen crisis play out because of the ALM risk. And that is something which is far more crucial, and it's in the top of the mind of the regulator.
Okay, please the larger ones.
Standpoint. But just to give us some sense on that, see, regulator has been aligning a lot of stuff between the two. If you read the draft of the scale-based regulation, it has done a lot of stuffs which has largely brought in line. When we talk with the industry ask is always to give a kind of a liquidity line, which would largely deepen up the debt markets for the NBFCs. So I think so that could be the first solution which could come in terms of the way AA or a AA with the GSEC rates. That spreads are largely somewhere on the higher side. That has to bring in the confidence in the debt markets so that it gets percolated into other instruments of the liability side. So it's a tough thing to answer from my side, but I think so the regulator is also exploring the way on the behavior standpoint the NBFC stand, And post that, I think so there could be some call which could be taken.
One last question to both of you, to Manish and to Jairam, before we try to get some audience questions. To Manish first, how badly do you want a deposit license?
If we ask you to dance right now, would you?
Good thing you didn't ask, scale of 1 to 10 or stuff like that.
You could do that.
No, look, I think we've learned to live without it. It's not so much how badly do you want it. I think it is a lot more to do with. So, simple question. If given, would you want it? Yes. If given, would you take it? Very much so, yes. Are there safeguards that you need to have? You need to be very, very clear about what happens when you're allowed to touch it. Jairam was making. You're dealing with public money, whether you take deposits or no. If you're going to borrow from the banks, that is also depositor money, and therefore completely understand the need to be tightly regulated. And I think there is a case to be made for deepening liability in the pool. There is a very clear case to be made to saying this is one of the instruments available. There's equally a case to be made for saying keep the benchmark high, keep the expectations, requirements high enough.
There's plenty of reason to to keep the bar high, hold that bar consistently high for everyone, and then sort of on both sides, whether it's on the asset side or the liability side, expect all of us to toe the line and respect both letter and spirit.
Had you known your mic wasn't working, you would have said a lot more by now, right?
I was just wondering and saying, now I've got to go back and think about.
Jairam.
I think I largely, in Mumbai we get used to the roads and everything is dug up. Like, would I like much better roads? Of course I would, but I'm still living here, aren't I? I'm not leaving the city. So it's similarly, like if I get a deposit taking license, of course I'd love it to hell and back. But if we don't have it, we don't have it. Like we'll just continue on. The current business model works. It has a particular potential. With that enabler, it'll have a different level of potential. So you'd be able to do more. But we are not going to leave the city just because the roads are dug up.
We'll just go to the audience if there are any questions. Don't think so. Right. None.
It's tough this part of the afternoon.
But thank you so much. The verdict seems to be clear that NBFCs do want a deposit license. So that's it.
Thank you so much to our panelists. Ladies and gentlemen, a huge round of applause. Shan, I'm going to request you to please present a token of our gratitude to all of our panelists. And ladies and gentlemen, stay glued to your seats. We're going to move into a fireside chat very, very shortly. Thank you, gentlemen. Thank you so much. Enjoy the rest of your day. In the grand story of India's journey to becoming a developed nation, or Viksit Bharat, financial inclusion is a cornerstone, and banks as custodians of capital and facilitators of this kind of growth, they play a very pivotal part in building this resilient economy that we are already. But the big question really remains, where will the next wave of banks come from, and how are they preparing to address the unique challenges of India's very diverse populations? India's financial landscape has witnessed immense transformation in the last decade. In fact, in 2024 alone, we saw a surge of nearly 42% digital transactions, with payment banks and small finance banks leading the charge in serving underbanked and even the unbanked communities. Do we need more traditional banks, or should we just go digital first? Lean models like payment banks, will they really lead the way? How do we balance profitability with patience required to nurture banking solutions in remote areas where the returns will surely be there, but certainly not immediate? To shed light on all of these pressing issues, we are very thrilled to welcome on stage our next speaker for today, Anubrata Biswas, Managing Director and CEO of Airtel Payments Bank, who will be in conversation with Alokesh Bhattacharya, Deputy Managing Editor, Mint. Ladies and gentlemen, come on, some energy here. Put your hands together, everybody. Thank you. And Alokesh, over to you. Timer set to 15, please.
(2014), right? Your bank was established 2014?
It was 2016.
16.
We
Yeah.
got the license. That's
License
when all payment banks got their license.
Yeah. So it's a question of whether specialists work or generalists who specialize in multiple things work better, right? From our experience, both have worked, but to get you here on stage and speak with you is a privilege. Thank you very much, Anubrata, for coming. Payments banks as well as small finance banks were sort of brought in by the RBI in 2014 to offer solutions in areas where our traditional banks have not done very well so far. So let us now find out from Anubrata whether that experiment, whether that purpose for which this initiative was taken has at all worked or not. So maybe you can tell us now that 2016 means a good 8-9 years in this area, right? So has it worked? What has worked and what has not?
So short answer is yes. And let me step back and talk about specialized licenses and what it actually meant in terms of a thought process. Essentially, it was absolutely two ends of the spectrum. Small finance banks were set up for specialized credit, targeted at a certain section of population. And payment banks were at the opposite end of the spectrum, really thinking and talking about using technology for distributed scale. And the context of the country, of course, was this was pre-Jan Dhan, pre-UPI. And if we take this forward and look at today, small finance banks are give or take around 2 lakh crores of deposits, highly profitable. I mean, I think this year it's going to be close to, let's say, give or take around $1 billion of profit. So that experiment has been quite successful. Payment banks, just by pure financial metrics, the entire industry is profitable. Of course, it's got a set of investments in terms of accumulated losses over the years. But what is important to look at for both industries is the fact that the small finance bank industry touches broadly 20 million consumers. 20 million consumers who would not have got credit from traditional banks in the traditional sense of the word. And payment banks today touch 250 million users monthly.
That's a lot.
So that's quite staggering in terms of numbers. And if you look at, therefore, this end, small finance banks, you've driven financial inclusion in a meaningful way. More importantly, you've created a funnel for small finance banks to be eligible for becoming larger banks, and equally a path for many other institutions to become small finance banks. As you know, the license is on tap. On the payment bank side, you really have pioneered this concept, which is now echoed almost everywhere, of digital financial inclusion, where consumers are using you digitally, transacting. Just Airtel Payments Bank alone processes billions and billions of transactions every month. So we've got a very viable set of two industries which were experiments which have taken scale and potentially now starting to add momentum to the country.
So you'd say that payment banks and small finance banks should continue, or should they all be converted into SCBs?
No, again, as I said, and I'll take a step back on this. Let's take the, sort of example and theme which you started with, Alokesh, of our 2047 goals of 30 trillion. If you just break up the numbers, you're broadly looking at $7 trillion of GDP as an economy size by 2030. This means that the GDP needs to grow at around 10 to 11%. Today, the CAGR of the GDP over the last 7 years is around 8%. So you need an incremental 2% GDP growth rate. If you reverse it, banking capital is growing at a rate of 8.8% every year. And the linear linkage between banking capital and GDP means that there is a $10 billion gap in banking capital requirements by 2030 for us to get to the GDP growth rate of 10%. This $10 billion cannot come unless you have more banks. Let's say half of that. So $5 billion is going to come from more bank licenses. And half of the half, which is $2.5 billion, should really come from credible, viable changes in the model which makes it much more exciting for fresh capital to come in. Let me give you an example. Let's say that the payment bank industry touches 250 million consumers. Assuming $10 of capital per consumer, you have a viable industry able to take in $2.5 billion of capital over the next 5 years, simply if payment banks were allowed to micro-lend and drive digital financial inclusion at scale. So simple tweaks will broadly mean that you are able to accelerate GDP growth rate, get to around 9 to 10%, and have incremental banking capital raise of $5 to $7.5 billion.
So what are some of the tweaks in the payment bank
The most obvious tweak
model?
is, of course, that of payment banks being allowed to micro-lend. I think this is a long starting position.
Put the mic a little closer.
This is a long starting position, not just because of financial viability, but also let's reverse the issue and look at India as a consumer space today. You broadly have a labor workforce of around 800 million. You've got digital banking users of 350 million. It's quite startling because that means that 350 million digital banking users are actually driving economic velocity in the country. Imagine a situation where you're able to suddenly lend to an incremental 100 to 150 million consumers through payment banks. You've suddenly not only driven economic momentum, but you've also actually driven formal inclusion at a very significant scale compared to what is happening today. So that in my mind is the one simple model which can really transform what is a very, very good wicket for India today.
So who are these consumers that you're talking about, and how do they benefit from
So let me sort of, this is a matter I'm passionate about and I personally feel very privileged. And I'll talk a little bit about Airtel Payments Bank because Airtel Payments Bank allows me personally to almost, if you will, have a ringside seat into what is happening in India today in terms of social change. When we started our model, of course, there were some theses and there were some consumer segments which we had to really build out and offer propositions to. But over the last 3 years, we saw a very strange, interesting fact. 4, 5, 6, suddenly a percentage of women applying for accounts started increasing. Today, a third of all our accounts opened in deep rural is by women. And it just made us a little quizzical. We started sort of looking at the data. And we started realizing that the woman in tier 4, 5, 6, 30 to 40 years of age, is now, based on the first smartphone of her life, suddenly starting to want a bank account separate from her husband and her family. And I want to let this sink in for a while. This is a fundamentally different expression of identity compared to what has been our normal perception. This is on the rural side. let me pick up another example on the urban side. Our argument has always been that banking is no different from any consumer goods industry. Just look at what happened to fast-moving consumer goods before, and I know the company has several question marks, but let me just put it as an example. When Patanjali came with Ayurvedic products, suddenly the market was taken by storm. It started getting credible market share in the FMCG space. The fact is it was a latent need, and the fact is that no large company was actually providing for that need. Today, with the ubiquitous presence of UPI payments, in urban consumers, there's an almost, if you will, powerful subliminal need to actually separate their main account, their large account with money, bulks of money, and have a separate account for digital payments because they're deeply worried about digital frauds. It's called a safe second account. Right. So what we see is that urban consumers are actually flocking to payment banks to open a second account for their digital payments. And Airtel Payments Bank is now India's first choice for a safe second account. So the point, Alokesh, is that as the economic heft of the country increases, per capita income increases, consumer needs are going to splinter and emerge in ways which it is going to be difficult to predict for us. But those consumers will need more and more banks and bank licenses to offer and cater products and solutions.
Right. So they're going to need more banks. Now, where are these banks going to come from? You have a prescription for like you said, $30 trillion by 2047, $7 trillion by 2030. We have to grow our GDP very fast. We need more banks. Do we necessarily need more specialized banks? Do we need more general commercial banks? And where are these banks going to come from? Do you see more consolidation happening?
I think the framework is now fairly simple. You obviously from the lending side have various sources of supply. So you have small finance banks moving into universal banks. There is, the panel before us was just talking about NBFCs getting access to public deposits, which in itself is a very strong source for the next cycle of banks and bank licenses to emerge. But I want to sort of position a third idea. Payment banks are banks, and of course we have our own journey. But imagine this for a moment, and this is staggering. Broadly, the Indian economy has been doubling every 10 years. So 2000 to 2010, the economy doubled. 2010 to 2020, it doubled again. And now in 7 years, we need to double again, which means the growth rate has to go up. It's around 3.8, 3.9 trillion. We are targeting 7.2 trillion in the next 7 years. Interestingly, digital transactions has been growing at a far higher multiple than the GDP growth rate. To give you a sense, in 2000 to 2010, if the the digital transactions were X, it grew 10X between 2010 to 2020. So digital transactions are what I would say are the modern equivalent of physical infrastructure and the economic multiplier of physical infrastructure. 1 rupee of physical infrastructure on roads, ports, and airports is equivalent to 3 rupees of GDP impact. Digital transactions are an even more powerful economic multiplier. And here is the staggering fact. There are 750 million smartphones in the country and 350 million digital banking users, which means a 400 million gap in terms of people using digital banking. Airtel Payments Bank is the third largest digital bank in the country. It's ICICI Bank, State Bank of India, and Airtel Payments Bank. We have 21 million savings bank account users. But imagine for a moment that 200 million of the non-digital bank users become digital and started doing digital transactions. Our sense is that would actually add another $500 billion to the GDP by 2030, which means another 2% growth rate, purely if there was a concept of pioneering digital banks in the country with a fresh set of licenses. Of course, we would argue that payment banks by design and definition, no branches, pure India stack, only technology, are equally India's new digital banks. So this is the third category of licenses, which could potentially be very exciting and again be a big fillip for India's growth.
And you are number 3 after SBI, ICICI in terms of what?
SBI, ICICI, and so, it's actually
in terms
published
of the
by
number
RBI. There's a monthly report published by RBI on mobile banking users in the country. Basis that report, we are the third largest bank.
That's terrific. And so there's a lot of innovation and technology behind what's going on. Because a lot of the commercial banks are also getting into this concept of opening digital banks without a branch.
Yeah, I think if you really, this is again a matter I'm quite passionate about. If you look at it, every single large emerging economy, take Brazil, you have Nubank, take UK, you have Revolut. India still does not have that one digital bank of fame. And we believe Airtel Payments Bank is very well positioned, right regulation, right technology infrastructure, distributed scale, fully leveraging on what we call not world class, but world benchmark digital infrastructure of India.
Yeah.
And become, therefore, a worthy contender of the claim to be India's premier digital bank.
Let's hope that works out very well for you, Anubrata. Thank you so very much for coming and speaking with us. At some other time, I'll sit with you and go into much greater depth on what we have discussed here.
Thank you very much.
Thank you very much.
Thank you.
Thank you so much, Alokesh. I'm going to request you to kindly present a token of our gratitude on behalf of all of us in the room and Mint to Anubrata Biswas. Thank you so much, sir, for joining us here at the Mint BFSI Summit. Thank you. Thank you, gentlemen. Thank you. A lot of food for thought there. Insurance is undergoing a digital revolution. Platforms like Bima Sugam offering convenience and even transparency. But can it navigate complex regulations and also a diverse customer need and landscape? That is the burning question that we aim to answer in our next conversation. This session also explores the potential and the challenges of a unified digital insurance platform. While we turn the stage around to welcome our next panelists, ladies and gentlemen, I want to remind you and once again invite you to please join us in taking all the conversations happening inside this room onto your social media platforms. So please feel free to share your thoughts, your takeaways, and when you do that, don't forget to use hashtag MintBFSI 2025 and also tag us at LiveMint so that we know where to find you. Okay, we're almost there. In fact, earlier today in another panel, we heard our panelists talking about how in 2024 insurance saw a penetration of 4.7%, but customer grievances and fragmented services still remain some key challenges. Enter Bima Sugam, which aims to streamline processes for both consumers and insurers alike. Can this platform handle the complex web of regulations, customer needs, and even tech adoption challenges is what we'll aim to answer in our next conversation. And I think our stage is ready, and so are we. Let's welcome Shipra Singh, Special Correspondent Mint, who will be moderating this panel, and our panelists, Mayank Batwal, CEO, Aditya Birla Health Insurance Company Limited, Rajiv Gupta, President, PB Fintech Limited, and Vishal Gupta, CEO, PhonePe Insurance. Everybody, please put your hands together in a huge round of applause. Thank you. Shipra?
Thank you for setting the context. Hello, everyone. So Today's session is about a rather revolutionary innovation in the insurance sector, which has historically been dominated by an offline distribution system and even claim settlement. So with the launch of Bima Sugam, we will have a single window marketplace which prospective buyers can use to compare and buy policies, and existing policyholders can manage their policies through it. However, that said, online marketplace is not a new concept to insurance. So let me start by asking Rajiv. Online distribution platforms like Policy Bazaar are doing exactly what Bima Sugam aims to do and more. So how does it impact your business?
I'll come to the impact later, but I'm sure Bima Sugam, in my view, is certainly going to help increase awareness about digital insurance, which will certainly support all insurtech players in the country. So I think it's a welcome move, in my opinion. It's a very transformative move in terms of having Bima Sugam, launching a platform supported by the regulator, because that will instill confidence about buying insurance policies through a platform. Policy Bazaar has been built over more than 18 years now. It has got strong legacy systems offering great value-added services. The technology which we have created and built will continue to support our growth, what we have been doing all these years. I think the value-added services like claims assistance which we provide, we have physical person in 235 cities assisting with claims both for health and motor. I think we offer renewal reminders. We assist people in setting reminders. So I think that is certainly going to continue. So in terms of impact, I think if you consider the population of this country, 150 crore people, and on one side we are saying Viksit Bharat 2047 insurance for all. How is this going to happen? Look at the health insurance penetration today, or look at the overall insurance penetration today. I think it's low single digit number, right? And you need players to be able to give access to those people who today don't have an access. And the only way the access can reach to tier 2, tier 3 cities is through digital, and Bima Sugam will certainly help, to have agents across the country access a platform which is easier for them to offer comparative plans to tier 2, tier 3 cities, low cost products which are more affordable, for these people. And let me give you an example to support my statement. Today India takes the pride in saying that we are a younger population, right? And 10% of our population is senior citizens. 2045, this number is going to scale to 30%. So we're talking about 70 crore people in this country who are going to be senior citizens. And 65 to 70% of them have zero income, no health insurance plan. Now imagine the social impact this is going to create on the country. So it is today's 40-year-old, which I call as a missing middle. Missing middle is defined as various ways, who need to be targeted to tell them why taking a health insurance or why buying a term insurance is equally important. I think that certainly will get facilitated by Bima Sugam. So Bima Sugam honestly will only transform the way digital insurance is being like that, build the trust which is required, in the economy. And I think it's certainly going to help all of us. And we will continue our growth story because we believe we will continue to invest in this business. There is big opportunity space in this country. So Policy Bazaar honestly is not worried, but it's happy that Bima Sugam is coming.
Right. Vishal, I want to ask you how the business of online distribution will change.
See, I think probably we are, one of the lucky set of people who have been, part of lots of transition in India. Right, over the last decade or so, if you think about how public digital infrastructure has evolved, has been phenomenal. And if you think about, that's one of the major reasons where India has leapfrogged many of the developed nations in kind of, evolution of the entire financial services. To me, Bima Sugam is one such opportunity where they should actually think about building a, be a part of digital public infrastructure and become the facilitator to open up the market. Right? They need to basically, if you think about, in order to reach to every nook and corner of India, which is a very, very diverse country and such a populous country with so underpenetrated insurance cover, you need enablers so that basically more and more distribution parties or more and more distributors come and participate into this. Take example of UPI, where NPCI built the entire payment infrastructure. And now everybody, basically, if you think about, can come and basically innovate on top of it, build the right kind of experience, and it is interoperable in nature. If Bima Sugam evolves into something like that, which kind of enables the entire ecosystem and expand the market, that's going to be very, very significant milestone in terms of what we want to do towards the vision of 2047. And in that process, if you think about all the participants, the online players, the new players, existing players, even the offline players, right, will be benefiting significantly on that. But the right question to ask is that, what does the digital public infrastructure form looks like? How Bima Sugam will evolve into that?
I think the first year, once it rolls out, will be interesting to see how it builds up. So, Mayank, when is it slated to finally be launched? It was floated in 2020 and we're already in 2025.
I think the final answer to this now can be given by the Bima Sugam Foundation team. The good news is that the entity is in place. The good news is that the CEO is in place. The good news is that the team is being formed. I think the good news is that the whole blueprint of that whole process, I think there's a lot of conversation which has gone into getting to that stage. Because something like this does take time, Shipra, because this is not something that, there are multiple stakeholders involved here to make sure that, people are brought on board in terms of the thought process of how it will evolve. Because, as you heard Vishal say that, what form will it take finally? Because the ultimate objective is to create something like, if you remember, Chairman Idea has mentioned multiple times that can we create the UPI kind of moment of insurance. And I think if it's going to be a DPI kind of a platform for insurance, then many stakeholders get involved in that. And I think there is clearly an expectation that sometime around mid next year, we should see, this year, 2025. I always forget that we are already in 2025. So mid this year, we should be, I think, in a position to launch that. That's what we hear as an industry. And I think Prasoon and team who are now working very actively with the guidance from the board that has been fully in place, I think we're very close to getting started.
And as an insurance company, how is your preparedness to be a part of it?
See, the thought process is that this platform will get all stakeholders onto the platform. Now, finally, what will be executed here and what will be executed at the end of different platforms, all of that are things that we'll kind of understand as the first kind of version of the platform gets launched. But for us, it's a platform that we have to be there. I mean, we have to have our products available. We have to get our servicing available, depending on what else is being planned in terms of distribution, etc. I mean, ultimately, it's the insurer which will provide all the offerings and the services, etc. So, for us, it's a very important platform because it gives us an ability to reach out to both segments, geographies, kind of offerings, which otherwise would have been extremely difficult for us to reach. For example, rural. Assuming that there are rural kind of distribution opportunities that are available, but the fact that there'll be a digital platform which gives us access to get there. Or consumer segments. Rajiv spoke about the fact that there is this whole missing middle. We have not found a solution, and that 40 crore, 45 crore Indians who need insurance but can't because of the fact that we have to keep distribution costs low, we have to find a way to make the health costs low, etc. Though the solution to the latter is going to be different. I think we are looking forward to this getting launched ASAP because this does help us in growing our business in a right, with the right economics associated with it, as is important.
Right. So the next question is open to all of you, so each one of you can take turns to answer it. It aims to get all the stakeholders in the value chain on the platform, your agents, hospitals, repair centers in the case of motor insurance, of course the insurance companies. So what according to you are the challenges which all the stakeholders face in coordination, and how does this platform how will it facilitate in easing those challenges and improving the coordination?
So I think, as you rightly said, what is Bima Sugam going to do? It is going to offer a centralized platform. Now, if you take health insurance, today there is an agent, there is an insurance company, and there are TPAs, there are hospitals, and I think a lot of coordination happens between these arms to be able to, admit a patient or, accept a cashless, admission. I guess this platform will remove the silos and all those challenges which a customer faces when he enters an hospital. Certainly, I think the platform will offer that facility. Number two, I think streamlined processes. So if you want to file your claims, it's far more easier, for you to file a claim irrespective of which company you take a policy from, And I think that claim management will become far more simpler and easier. I think a platform like this will help a lot of individual agents who don't have platforms, who don't have platforms like Policy Bazaar or a PhonePe or XYZ or the insurance company itself. So that problem of coordinating with an individual agent or agents who have run away, can also be very, very highly supported by this. Certainly, I think the other area is empowering, the agents and distributors. Today, the knowledge the agents have is limited. And very often, this problem of mis-selling is something which we all face in the industry. But a platform like this will certainly help agents to be more knowledgeable, use the platform to convey the right, USPs of each product before they actually decide which product suits which customer the best, and bringing in more transparency to the system. So I think overall, it's a win-win situation, and I think this is required because today it will support lakhs of agents who are, selling policies across the country, be it life, be it health, or be it GI.
Right. Vishal?
Yeah, so I think let's be very honest about, where do we stand as an industry, right? There's one particular thing which must be addressed if you have to kind of reach the goal of 2047, which is the missing trust. The fact of the matter is that there is a complexity in the product. There are multiple legs of the basically product life cycle, right? And because of various reasons, and nobody's fault, honestly speaking, this is how this product is in terms of being a push product. But there are missellings, there are misdeclarations, there are servicing issues. A platform like this, actually, if you think about, can stitch it well together and probably change the industry to a customer first. Right? This is what is the need of the hour. As the moment we can basically take a stance of that we are customer first, and now everything behind the scene, which is a complex net, is not individual pieces which you need to figure out as an individual, but platform is basically giving you as a well-stitched piece. I think that's going to be phenomenal. And if that stitching can happen, I think everybody, entire industry will benefit, and most importantly, customer will benefit.
Yeah, and if I can just add to what Vishal said, see, in the whole journey, there is this whole issue of awareness, consideration, and then fulfillment. Let's say the customer decides to buy, right? I think because this platform will be an independent platform coming from an independent body, the element of trust that consumers will have on this is, I think it's a given, right? The role it can play in increasing awareness across the different segments, geographies, etc., as I said earlier. The role it can play in, converting that, awareness to consideration, to serious consideration to kind of explore the offerings. And then to the extent the whole fulfillment, whether it's buying, service, claims, etc., all of that to happen, that all of this is extremely powerful because of the fact that there is an element of independence, transparency, and therefore trust that consumers can have on this open platform coming from an independent entity. And I think if that can happen, that can play an extremely, extremely large role in kind of helping solve many of the issues or the puzzles that are required to be solved to really make insurance for all by 2047, as is the expectation from all stakeholders, including regulator and the government.
Right. Now, as you rightly pointed out that mis-selling is one area which will definitely see some kind of combating with Bima Sugam. The other, pain point for policyholders is, how rapidly the premiums can go up. Do you think there can be any tech innovation which can kind of solve this? And apart from this, also, of course, you get the option to compare and choose policies to buy. But then what are the tech innovations we need so that the prospective policyholder is, made aware to the point that they get no surprises at all at the time of making claims?
I think any tech innovation will certainly bring in efficiency, right? I don't think there is a direct correlation between saying that there are premiums going up for the customers. That has various factors. It could be his age, it could be when he is entering, the ecosystem. But certainly, technology will help you to reduce processing cost, bring in more efficiency, offer more personalized products that suit the customer more. So in a way, certainly there is a cost-benefit analysis. I mean, if I look at a motor insurance premium today, my colleague sitting here will also tell you that you go to a dealership, the same premium will cost you 40% more than probably when you go and buy online. Whereas the dealer will tell you, if you don't buy insurance through me, then your claims will have always a challenge. So most customers realize when they buy a new car, why get into this panga, so they want to buy a insurance from a dealer. So certainly there are cost differentials even today, available. So I believe that efficiency in terms of comparing products, getting more personalized products in the offering is certainly going to be one of the advantages which we see, through tech platforms. The other aspect which I wanted to cover quickly is financial literacy is something which is missing in this country, right? I mean, if you go beyond tier 1, we all talk about everybody having a Jan Dhan bank account. But more than 100 crore people don't even know where to borrow and why they should buy an insurance, right? So while we can have physical people present in these pin codes, these platforms will enable these people to show videos in the local lingual language, telling them the importance of why buying a health insurance is important, why buying a term insurance is important. So building financial literacy in this country is going to be the next big challenge. And that's something which I think certainly, tech platforms will help.
Yes. Vishal?
So I think technology, this is a technology era, and if you think about, how AI is exploding in the last 1.5 years, and I think how you can imagine in terms of it will explode in the next 3 to 4 years, I think it will change the paradigm in multiple facets. But if you think about technology, generally typically solves for 3 major problems, right? One is largely around in terms of, what is your distribution like? Are you distributing it very efficiently, right? The efficiencies of distribution bring in straight away cost advantages, and those cost advantages can be passed to the customers eventually, right? Second one is, if you think about, is the entire thing around what he talked about, financial literacy, or basically the reach. Can consumer reach out to the right information at the right point in time in the right language or right format, what he or she can understand? Right? Now with the basically consumption, today if you look at, I think we can definitely say that in India, probably electricity might not be there, but mobile data is there, right? So I think internet access is pretty much now ubiquitous, which means people can reach the information. Can you disseminate this information in a meaningful way? And now with basically lots of, content being kind of, created, innovated upon, and with AI, all those, chats and conversational AIs, there's a very, very huge chance of basically someone should be able to simplify and land that what this particular product is without basically solving for the complexity. And the third one, which is the most important one, right, and Mayank can probably, add more to it, is about in terms of that when you're building for population, right, many times you're trying to do error correction. Now, technology can actually bring in data in a way where basically you don't need to do error correction at a population level. Now, you're building so personalized products where actually you can price it right. You're not pricing for what can go wrong because you are pricing for those small cohorts and building those products in a way which is far more efficient from an overall underwriting point of view, and basically you can deliver profitability and at a reduced cost. So I think these 3 aspects put together, distribution, literacy around in terms of, to be able to understand this thing and to be able to create products which are sharp and profitable. All 3 of them will lead to actually consumer benefiting in terms of the price going cheaper.
I have one question, Vishal. So once the platform is rolled out, do you think it's going to be a big task, for both the regulators and all the stakeholders in the industry to ensure that the platform reaches, the right customers so that it also helps with penetration?
See, again, that's where basically I'm talking about, right? If you think about, I think platform should be thought as a digital public infrastructure. I think I'll give you one simple example, right? With the technology advancements, the experience channels are evolving very fast, right? Most of the people have not seen desktop and straight away jumped onto the mobile. I'm not surprised that 5 years from here, people will be using different interfaces. The VR interfaces, the AR interfaces, right? Those goggles where basically you're kind of interacting with those. So there will be lots of interfaces. I think the right value for a digital public infrastructure, if you think about, is to create that API infrastructure and enable innovation, just open up the innovation. You give the right tools to the people, there is enough young blood in the country and enough entrepreneurs who are budding and evolving with the right business models now, where they can actually latch onto that and actually end up innovating far more. So instead of trying to reach everywhere, I think the right question to ask is that will this platform enable variety of players, right from a small player who's basically, let's say, for example, trying to innovate on a very, very specific problem in a very, very specific geographical area, right? And that person should be able to solve for insurance problem in that domain, subdomain, sub-area. If you can open up that and you can basically enable that kind of innovation, which is channel agnostic and reach agnostic.
Rightly said. Mayank, what would you like to add?
Yeah, I mean, see, let's kind of peel the in health insurance cost, right? And there's a cost of distribution, there's a cost of healthcare service used, and there's an operating cost, which is for whatever else is required in that process, right? I think a platform like Bima Sugam can do many things. One is which is becoming a friction and therefore a cost because of information asymmetry from a consumer perspective can be eliminated to a very large extent. Information asymmetry in terms of what's the best offering for me for what my current need is, right? And therefore can I get the most efficient product, including because Bima Sugam will have connections to all potential existing DPI platforms like, of course, UIDI and but even ABDM and etc. The information can actually help insurance companies like us create and provide offerings to the consumer for what exactly is required, and that itself can remove, as Vishal very rightly said, population level kind of inefficiency costs that you tend to build in any offering because of the risk of anti-selection, etc. The other thing is that distribution cost itself. If because of the awareness, consideration, etc., can I bring down the distribution cost? It's a large component because a lot of friction in the whole process and the cost that would be borne in a traditional sales process is removed in this thing. Ultimately, maybe not in the short term, but ultimately the big part of the problem to be solved is the cost. I'm talking of health insurance here, so the cost of healthcare delivery itself. And there, ultimately because of ABDM, etc., all of that coming in, can that help solve that problem if ultimately you can even bring in that set of stakeholders onto the platform in some way and reduce the inefficiency or eliminate what extent I don't know the efficiency which of fraud, waste, abuse, etc. I think that's probably in step 2, step 3 that we'll look at. But of course, it should ultimately end up. Cost will go up because of various reasons, but can you reduce the cost increase to what is more efficient is definitely possible.
Right, agreed. So since the time is almost up, I want to open the floor to the audience for questions before we move to final thoughts from all the panelists. I can see one hand at the back. Can somebody please pass the mic?
Hello. Good evening, sir. So you have emphasized a lot on platform tech, but considering the major chunk of potential customers will be rural India. So how will Bima Sugam ensure that it will be easily accessible as well as efficient for people in rural India who are comparatively less tech savvy?
Do you want to specifically ask from one of the
Anyone?
Probably I'll take this. See, if you think about, there are enough platforms which are already reaching rural India. To give you some statistics, today 80% of our sales are coming from T2 and below, right? In fact, on the motor side, if you think about 70% of that has been basically to start with, came in from break-in, right? Which means the customers who were not buying insurance started buying. If you think about the technology, once you open it up, right? Let's say, for example, Bima Sugam interface or whatever, basically the technology in terms of the API being used and other partners basically using those APIs to kind of open up the interfaces. Once it is digitized, digital has no limits, right? Digital has no boundaries. So once you've created the right digital interface, it will reach. So if you ask me, it is going to happen. And if it is not happening, trust me, we will not be able to meet 2047 vision. So that is the primary purpose of around Bima Sugam, that where we should kind of enable the expansion in a full throttle.
Thank you.
Any other questions? All right. Any final thoughts anybody would like to share before we wind up? Because the time is up. So
I think we are all, as you heard from the from even my colleagues here, that everyone is kind of excited to have this platform up. I'm extremely optimistic that we are getting very, very close to having this big platform become a reality. I know because of the fact that the team is there, the board is there, and with the support from IRDA and the IRDA chairman is extremely optimistic about it. We'll see this very, very soon. And my only request to all stakeholders who are in the insurance space, that please be prepared to kind of leverage this opportunity fullest.
At PhonePe, our vision is to basically solve for the trust, right? We want to be, and I think Bima Sugam is going to help us very, very big way towards that vision. I genuinely believe that, as Mayank said, that all stakeholders come together with a single purpose, that let's go and basically change the industry or basically expand the industry in a very, very big way. I think Bima Sugam is going to be a very, very big enabler on that.
Right, right.
When I fully agree with both Mayank and Vishal. More access. Individuals will get more savvy, they'll have more knowledge. So we'll have better financial advisors than what we have today, in the country. And certainly, a lot of changes are going to happen in the years to come, right? I was other day participating in a program in which the Transport Minister, Mr. Nitin Gadkari, was launching GNSS, which is the Global Navigation Satellite System program. And I can assure you that such programs, when integrated with platforms like Bima Sugam, will offer more transparency, because today motor insurance, everybody doesn't buy a motor insurance, right? But here you will have products which will be pay as you drive, pay how you drive, protect frauds like staged collisions which you see on the road place, so bringing down premium costs. I think, in my view, overall, for all of us who are part of the ecosystem which is running the companies, and for people sitting here who are customers, and for people who are distributing these products across the country.
Yes, agree. So hopefully next year's Mint BFSI Summit, we'll be discussing the impact that Bima Sugam has made on ground already. All right, thank you very much for joining us today and listening to us, and thank you to our speakers as well.
And Shipra, thank you. Thank you for asking the most pertinent questions on behalf of all of us in the room. May I please request you to present a token of appreciation to all of our panelists. Give us one quick second. Ladies and gentlemen, a round of applause is in order for all of our panelists. Thank you for giving us some wonderful insights this afternoon. Thank you. Stay glued to your seats as we're going to turn the stage around and have a very important conversation about the dual role that Indian banks have at hand, funding green projects while transitioning from their existing portfolios to low-carbon alternatives. But are we equipped to handle this competency challenge? Losses from extreme weather, transitioning and transforming are the only options. But how well are we really doing? Is it happening? And is it happening enough? Well, let's find out by inviting our next power panelists on stage. Our moderator for this discussion is in fact making a comeback. Alokesh Bhattacharya, Deputy Managing Editor, Mint, will be joined by a power panelist, Rohit Inamdar, CEO, CareEdge ESG Ratings. Executive Director, Sustainable Finance, Standard Chartered Bank, and Vivek Iyer, Partner and National Leader, Financial Services, Risk Advisory at Grant Thornton Bharat LLP. Ladies and gentlemen, let's welcome them with a warm round of applause.
To the panelists for coming, and to all of you. Hope you're having a good time listening to all the gyan emanating from the stage, and hopefully we can take away some interesting takeaways from here. Climate finance is a big deal these days, right? There's a lot of discussion around climate change, sustainability, projects is a big issue worldwide. Lots of global conferences happen, as you know. The COP29 happened very recently. Not very good news coming from there, as with the previous COP conferences as well. So today we will discuss the competency challenge, climate financing by Indian banks, and whether we are equipped to do what is needed, and what else needs to be done to make us equipped to do that, right? So let me start with a question to all of you, which I basically want everybody to just pitch in a little bit and give your views on this, and what we were also discussing outside a little bit on this, and what is a sustainable, climate financing model in the Indian context, right? So what are we doing right? Because the kind of financing that we need, we at Mint also write a lot about renewable energy projects getting financed, but most of that money seems to be coming from private equity and private money. Whether the banking system is able to do it right, and what is the correct sort of ideal model for Indian banks and system to adopt. So you want to start, Vivek?
So, as you rightly mentioned, the reason, of course, in the climate financing space, you actually see a lot of private equity capital coming in the first place is because whenever commercial viability is something that is yet evolving, and as a result of that, risk appetite is not clear, private capital through equity essentially is usually the way people go. For a debt to come in, you genuinely need a very sound understanding of the business and the journey and where it is for the financing to come in. I mean, a broader sense is that foreign banks have a good sense and a sound understanding because of access to global knowledge capital, as well as a deep understanding of experience that they actually can leverage, having done it globally, to be applied. The Indian banking space is more so evolving in terms of how they are looking at those risks. At least that's the sense.
You're being diplomatic. Vivek, okay. Well, I'll take you up on that later. Shobna?
Yeah. I'd like to kind of talk a little bit about how the market has evolved. So if you look at some of the data points put out by RBI, for example, RBI says in order to finance the climate gap in India, we need about 2.5% of GDP annually. That's the money that's required to support. And I was just looking at some data, again published by RBI, which says that last year, the total financing to the energy sector, which is non-conventional energy, so talking about renewables, etc., is about 8% of the total financing by banks for the energy sector and about 0.5% of total bank credit. So the amount of financing that is being committed to this sector in India today is still very, very small compared to the demand, right? And another data point, if I looked at the total amount that has been raised as sustainable finance in India to support climate agenda through green loans or bonds, etc., last year was about $25 billion. So this is not just bank credit. This would also be, say, capital market activity where Indian companies have raised money either domestically or have gone to the international markets and raised financing. Okay. So it's about 1% of the global green finance market. So point I'm making is it's still very small and it still has a long way to scale, right? And as an international bank operating in India, I think a couple of things, and we've seen the transformation in the local market. One, the government did the sovereign green bonds, and that has built more awareness around the green finance market in India. RBI has come out with certain consultation papers around sustainable finance and green finance. And so the awareness is building up. So if you need to kind of scale this further, I think a couple of things. And again, I will draw upon the experience of what we have seen in other markets. So for example, if I take the UK example, in UK, the regulator, the PRA, basically offers certain incentives for banks to support climate finance. So for example, a project finance deal which aligns with public sector or essential public active contribution to the public sector would typically get a capital relief of about 25%, which makes the commercials more attractive. And if the bank needed to choose between lending to brown vis-a-vis lending to green, then the choice is quite obvious. See, if I take Japan as another example, Bank of Japan has a concessional line of credit for its banks for climate financing, right? So there are these kind of incentives that are provided. If I took the example of, say, MAS, the Monetary Authority of Singapore, or Hong Kong Monetary Authority, both of them have certain concessions, in grants as they call it, which support an issuer who's coming in and raising green finance in the market for the first time. So whatever are the costs of compliance, etc., is subsidized by the regulator. So I think some of these is something we can learn from and draw upon and adapt to the Indian context, which can help drive the market further.
Right. Thank you. Rohit, what's your view?
Yeah, see, we need to look at what is sustainable finance, right? Sustainable finance or climate finance.
Raise the volume, please, of his mic.
This is gone.
It's gone red. Take a different one. Thanks. Take the mic.
So simply put, sustainable finance or climate finance is flow of funds to sustainable projects. So it can happen in two ways. One is two main criteria one needs to look at when one is looking at sustainable finance. One is reducing your greenhouse gas financed emissions, reducing the financed emissions on one hand, and second is lending more to sustainable projects. Now in India, a lot of work is happening in terms of lending to renewables, in terms of lending to energy efficiency projects, green mobility, green buildings, etc. It's just the beginning. We are just scratching the surface. A lot needs to be done on that front. And there are a couple of impediments there. One is nobody in the system is tracking financed emissions. So if you don't track the financed emissions, how will you reduce them? And when will you reduce them? That is one. Second aspect is we don't have a green taxonomy or sustainable taxonomy. So how are banks supposed to know which is a sustainable project and which is not a sustainable project? Which energy mitigation, climate mitigation project should I fund and which I should let go? So that basic level understanding is still not there. But yes, a lot of work is happening on biomass side, ethanol blending and so on and so forth. But we are still it's just a beginning now.
Yeah, I think probably there's also some feeling of an emotional thing of, so much losses being run up by our power distributors, distribution companies, and whether the model is viable at all, and banks will also want to lend money to a viable project that they can get the money back, right, with interest. So I think there are several issues there, and renewable is completely new area. But Shobna, you pointed out some very interesting steps that other regulators have taken. Maybe you can tell us a little bit about from learning from like Vivek was saying that foreign banks have the about what Standard Chartered Bank has done, Standard Chartered, in terms of green financing, climate financing. Sanjeev, can you please fix the mics?
So we are an emerging markets bank, and climate change is extremely visible in all the markets that we operate in. So as a bank, we've taken a position of committing to net zero in our own operations by 2025 and in our client financed emissions by 2050. So in order to achieve this, we first set out what we call as our green and sustainable product framework, which is basically our own taxonomy to define what is green. And we also extended that to cover what we call as the transition finance framework, which basically defines all the transition activities in the hard-to-abate sectors, how they will decarbonize. We've made a public commitment of mobilizing about $300 billion for supporting green and transition finance by 2030. If I looked at India itself, in the last 2 years, we have mobilized almost $5 billion through green, social, sustainable loans and bonds for our clients for deploying for sustainable end use. Okay. We financed almost 4 gigawatt of renewable projects. We did the first green finance in the electric mobility space in India. We did the first transition finance for a compressed biogas project for one of our clients last year. So very recently also the bank has announced a partnership with Apollo where we are committing $3 billion of financing for private credit for supporting sustainable finance and working with our clients in our key markets, whether it's India or globally, and we will continue to do so.
Hopefully, some of our banks will start taking up on those initiatives and start their own stuff here because India needs a lot of. So, Vivek, Donald Trump has come in screaming that climate change is a hoax, right? All this is bullshit. Aisa kuch ho nahi raha hai. There is nothing called climate change and all that. So there is a lot of uncertainty, or rather fear, around what he's going to do to all these initiatives around the climate change, and that global climate alliance in which all the banks were there. There, I think 5 or 6 banks have pulled out from that, right? What kind of signal does this give, for climate financing, both by, and we are just 3 days away from Trump's, taking over, right? Tell us your view. You and Rohit maybe can enlighten us a little bit on this.
So, see, interestingly, I mean, it's the way I see it is that Trump's statements are more directed towards creating a sentiment that in a way has an effect on destabilizing China. China has made significant investments in renewable energy. Yeah. And, electric vehicles, solar panels, critical materials, rare earths, there's a lot of investments they have made in a economy of tomorrow. These sentiments kind of really have a way of impacting sentiment. And Trump's basically in terms of using that to destabilize and kind of use it as a leverage later. So I personally feel in terms of it's a geopolitical strategy that he's utilizing to kind of leverage later on his negotiations from a whole alliances standpoint in the future.
More posturing than reality.
No, it's more posturing.
You agree on that, Rohit? You got a better mic now, I think.
Yeah. I think this is a better mic. Alokesh, if you allow me, I will read out a couple of quotes which I had written down here.
Yeah, please.
When you're quoting someone, today it's very risky to misquote anyone in public, on a public platform. So let me read them out. So this was one interesting quote I came across, which says, "We are the first generation to feel the effects of climate change and the last one to do something about it." So this quote statement was popularized by Barack Obama. It's not his statement. He just popularized it at a speech on climate finance at United Nations. This was way back in 2014 or 2015. 10 years down the line, you have Trump echoing through slogans, campaigns, and Twitters, "Drill, baby, drill." So, which meant encouraging more increased use of fossil fuel. So the world's largest economy is somewhere between these two, thought processes, perspectives. Drill, baby, drill versus let's do something about climate change. We are the last generation who can do something about it. Back home, our Prime Minister, Mr. Narendra Modi, stated again in one of the COP summits, or I think one of the UN speeches, that climate change is not of our making, yet we in India have taken many steps to mitigate it, which clearly shows India's proactive stance and its resolve towards climate change, right? Now, coming back even closer to what RBI is, our regulator for the banking sector, is saying. So in fact, these are the thoughts of Deputy Governor of RBI, Mr. Rajesh Rao, who delivered keynote address today morning. He is of the opinion that climate change poses a very major risk to financial system, economy, and society at large. And the financial system can play a very key and pivotal role in addressing these climate changes. Now, this in nutshell tells you where US currently is, where we are on climate change, and what is the path forward. So just because US is backtracking a little bit, US always had a lot of dissenting voices on ESG and sustainability for quite some time now. And now a lot of banks are quitting that space. Even BlackRock has moved out of net zero commitments and so on and so forth. But having said that, in India, if government is focused on this agenda, and if the regulator is also going to push the banking sector towards mitigating climate change, then things will progress. Without any push, regulatory or governmental push, nothing will happen.
Yeah, in fact, and you did speak about green bonds, right, that was brought in. And the RBI has also taken some steps like, including this energy projects under priority sector loans and green deposits and disclosure framework for climate-related financial risks and all. The question is, have these helped? Because ultimately, like you said, it's only 8% of the entire energy loans given out by banks is for renewables, which is actually quite low. So no wonder they are depending on private equity for money. What about these initiatives? Are they helping? What tweaks do they need to? We're doing a merry-go-round with mics here.
So RBI has been very proactive in terms of whatever steps that they have taken as a regulator in terms of balancing the national priorities of both growth as well as supporting climate. So, for example, you take what they did on priority sector lending, right? You included renewables into priority sector, which basically allowed a lot of these small distributed size scale solar kind of projects to actually avail financing. Then you take the green deposits, for example. I think it's a good initiative in order to help banks raise deposits for deploying into green end use. Now, a number of banks have already set up, and it requires banks to set up a framework for lending, requires the banks to have an assurance mechanism in place to ensure how the money is getting deployed, etc., etc. So there are a fair amount of compliances required on the banks, and the cost of those, there is a certain cost to those compliance as well. So while a number of banks have already launched, a number of banks are in the process of launching this, these deposits are being offered at a rate lower than conventional deposits. So the appetite to invest in a green deposit obviously is much lower, because from a person who's parking that liability with a bank, they're obviously looking to maximize the rate or the return that they get. And therefore, it has not taken off as much as it should have, plus the cost of compliance is on top of it as well. Having said that, if I take the risk on climate risk and sustainable finance, the paper that they came out with, we are just getting into Davos, WEF happening shortly. There is the annual Global Risk Perception Survey, which is done ahead every year. And what is the topmost concern or risk in the global scale? Extreme weather events. Right? There are a whole lot of others, but this figure is right up there in the top. And it has in the last couple of years. So climate change and impact of climate events on banks is very real, right? And businesses, it is very, very real. And therefore, the climate risk, which is still a discussion paper, yet to be formally notified by RBI, therefore, is a good step to bring in that awareness around climate risk, have banks mainstream climate risk into the risk assessment processes of banks, and take investment decisions keeping the contours of, you know, the impact of climate impact as well, which is extremely important.
Yeah.
So I think the regulator has been very, very progressive in terms of the various steps that have been taken. I think given all the challenges of an emerging market, I think we're doing a good job, absolutely.
You think we are doing okay?
I think we're doing a good job. I said from a regulatory standpoint.
From a regulatory standpoint, we are doing a good job. So we are out of time, but I'll still, I'll irritate Zinia a little bit and I'll take one more question, which is the risk management models of banks, considering that the RBI is also taking such proactive steps. You know, do they need some tweaking in terms of climate financing? Because long-term, long gestation projects like energy and roads and all are anyway very long gestation, right? So getting returns from them is a long-drawn process. But the risk management models of banks towards climate financing, do we need to move away a little bit from our conventional models and do a bit of innovative thinking on that?
So I do know that there are a couple of banks who are actually, in terms of have climate finance models that they're actually building and utilizing for the purpose of from a risk management standpoint. But good innovation. But the biggest challenge also is that in terms of creating, so any risk management models, when you want to, it's based on a set of variables, and the behavior of each one of those variables is based on what is your experience with respect to each one of the events.
Yeah.
The database of events is where a lot of the banks struggle and make a lot of assumptions. But the good part is that there is innovation that started there, and it's evolving and progressing. But that is more so, they're using actually that, so the whole impact of climate events, integrating climate risk, measuring the impact, that's where a lot of the risk management models are focused today. If you were to ask me, are those risk management models focused on creating those right kind of risk assessments from a lending standpoint? No, the answer is not. That's not where where a lot of risk management focus is today. It's more in terms of saying that, okay, if this is my exposure to the agri sector and as a result of these climate changes, what's going to be the potential impact on the crops, and are there going to be the impact from a delinquency standpoint. That's really some thoughts people are trying to look and play. But it's still evolving. Nobody has got it right.
Nobody has got it right. Rohit?
Yeah. So the question is whether risk management models of current banks are adequate right now, or do they need to be relooked at?
Especially considering the extreme weather events that are increasing
frequency. In the context of climate change and weather events, banks are not going to have any option but to have their new models in place. Because if you look at the draft disclosure framework issued by RBI about a year ago, and final will come out anytime soon. We are expecting it maybe in a month or so. We'll have a final framework on disclosures. Now that makes it mandatory for the banks or the regulated entities, is what RBI calls them, for all REs to disclose, start making disclosures from FY26 onwards itself on 3 pillars, which is risk and strategy. How the board is looking at that. Governance and risk management. So they have to have a governance framework around it, and public sector banks, even private sector banks, have done enough work have already started doing something there. Second most important aspect is quantitative targets and metrics. So it will become mandatory from FY28 onwards to disclose the quantitative targets and metrics also. Now RBI does not stop at that. They are saying you have to assess the climate risk, and you have to integrate into your credit decision-making process, and you have to price it appropriately. There are many impediments which Vivek has talked about. I don't want to get into it. There are impediments, but there is no choice. You will have to do it. And banking sector has always stepped up to challenges. This is a new challenge which is coming in, which is staring us in the eyes. And we have to do something about, we have to figure out, because at the end of the day, what happens to your retail portfolio as well as to your wholesale portfolio if there is a disastrous climate event. And these so-called black swan effects seem to be happening every year. Now, to what extent your loan portfolios will get impacted, because if your probability of that happening may be very, very low, but if it happens, your loss given default is huge. So from that perspective, to bring in stability within the system, the regulator has taken proactive measures. It has to be now supplemented with a good regulatory framework. Banks don't know what is their RBI's expectations of them on this front. So that is one area they need to crack. And second is green taxonomy. Time and again, I'm coming back to green taxonomy, because whatever we say on climate change is meaningless unless as a nation we have a green taxonomy. Because we have set net zero targets, and the green taxonomy has to align with that, and RBI's disclosure framework has to dovetail into that. Then as a system, we will be able to address these changes effectively and efficiently.
Yeah, you're right. In fact, we have no choice, right? Because developing economies apparently need $2.4 trillion annually in renewable investments, in climate financing investments, and that big number has to somehow flow down to the banking level when individual banks are financing different kinds of projects. So a lot has still to be done, but thank you very much for coming and sharing your thoughts with us. Thank you very much.
Thank you.
Thank you so much, Alokesh, and please present a token of our appreciation to all of our panelists. And ladies and gentlemen, may I request you please to put your hands together once more in a huge round of applause for our panelists. Thank you so much for joining us here at the Mint BFSI Summit 2025. Let's take a nice quick group photograph. Everybody, please come together. And on that note, I think it's about time that we quickly re-energize ourselves with a coffee, whatever is your favorite pick. We're going to reconvene in exactly 10 minutes from now. On the other side of the break, I assure you we have some more power-packed panels, and of course, we're counting down to the grand finale with the Mint BFSI Awards 2025. See you all very soon. Thank you. All right, good evening and welcome back, everybody. Thank you so much for joining us timely. You are at the Mint BFSI Summit Awards 2025, and we are now moving into what I think safely call the final segment of today. Year 2024 saw a record surge of IPOs in the country. However, we also did witness investors making losses post-listing. Let's hear from our experts how investors can navigate between the highs and lows of IPO investments by inviting on stage our next power panel. The moderator for this discussion is Sneha Shah, Deputy Editor, Mint. Round of applause, everybody. Come on. And let's welcome Madhurima Mukherjee, Partner Capital Markets and Co-Chair, Finance Practice, JSA Advocates and Solicitors. Neerav Shah, Managing Director, Investment Banking, Equirus Capital. Amit Ramchandani, Managing Director and CEO, Motilal Oswal Investment Advisors, and Kaushal Shah, Managing Director and Head Equity Capital Markets, Kotak Mahindra Capital Company. I heard a cheerleading gang somewhere, so can we make some noise for our power panel, everyone? Come on. Thank you. All right, Sneha, go for it.
Thank you so much. Thank you, guys. I couldn't have asked for a better panel. Like Neerav put it, you've put together some competitors together. So, I think we're going to have a great brainstorming session here. Thank you so much. And please, let's have a huge round of applause for our panelists. Thank you for making time. We've been given a very broad topic, and I think the most spoken about in the investment banking industry in the last 12 months, IPOs, the capital markets has been on a surge. Just to throw in some numbers, 1.62 lakh crore were raised via IPOs in 2024, by 90 companies. That's twice as much that India Inc. raised in 2023. So, barring the largest Hyundai, which was 27,800 crore, there have been, right from small to mid to large cap companies that have tapped the IPO markets in the last 12 months. And I think the pipeline getting into the next year also looks really lucrative. So first up, if Kaushal, you can take this and talk about how is the pipeline looking, because, Kotak has been at the top of the league tables when it comes to ECM. So you're part of many of these conversations. So how is the pipeline looking getting into 2025?
Yeah. So I think last year was again a record year with the highest ever fundraising, whether it is an IPO or whether it's a QIP follow-on transaction or whether it's a sell down, around about $74 billion, the highest ever in the history of Indian capital markets, possibly contributing to 14% of the global ECM markets, right? And what we see is that this momentum is at least the way we see it's expected to continue. At this point of time, if our estimate is right, around about $35 billion of only IPOs that we are expecting over the next, in the current year, which is the current calendar year. And the interesting thing is that it is not only the quantum, but if you look at the spread of the sectors which are going to raise funds, it's quite diversified. We had years prior to 2020 where it was a lot more focused on financial services, then came the new age sectors, then the real estate, the specialty chemicals, etc. But if you look at last year, the spread has been quite diversified. Not only the new age companies were there, but also the infra companies, industrial companies, manufacturing companies. So pretty diversified set of sectors which raise funds, and even the way the pipeline is expected to do the same. And at the same time, even the larger set of companies, groups effectively will be are planning to raise funds. So it's a pretty good set of pipeline that we see at this point of time.
Right. Also a large indication of how the India Inc. thinks, the corporate loans or corporate banking has restarted in that sense. We've seen 2 quarters of corporate lending getting picked up. So that also is an indication of the animal spirits being back in the market. Is it translating into capital market activity? Nirav, what are you seeing in the small to mid cap space? Are you seeing companies getting more active in terms of raising capital, both equity and debt?
So I think one very interesting data point that we are seeing is the investors at this point in time are looking at market cap, which is very wide. There used to be a time where investor used to only chase for larger market cap companies. Today they are more open for looking at smaller entities, including market cap ranging from 1,500 crores and above. So that is, I think, 1,500 crores and above. So I think that is a very interesting thing. The second interesting data point is that if you look at the last 2-3 years, we have seen companies emerging from tier 2 cities and beyond, right? I was looking at this, full of last year. We had more than 40% of the companies which are actually beyond tier 1 cities. So things which actually started few years back in terms of Atmanirbhar Bharat, Make in India. So all of these entities which are in some of the places, we actually haven't visited those cities ever for an IPO pitch. And those are the places that we are visiting today. So there is a complete different kind of a perspective that we are seeing on ground. And some of these entities are very fantastic in terms of the profitability also. So things which we have never saw, even in metro cities, are some of these emerging ideas that are coming from those cities. So interestingly, the risk appetite of retail, HNI, AIF, PMS are actually increasing to invest in smaller and mid-cap stories more than the larger cap stories, because they do believe that from here they should be able to make like 3x, 4x and 5x kind of return, which is why there is a lot of infusion which is happening in this particular space. I do believe that's going to continue. Because that's a space where eventually people have made a lot of money, right? Tons of money. So I think a culmination of a lot of these things, right? So there is a lot of inflows coming in, SIP, etc. Risk appetite of retail individuals kind of increasing manifold over the last few years. Some of the great businesses emerging from tier 2 and beyond cities, and so on. So I think these are. And okay, one of the last very important point, if you see historically private equity investments have really not happened in the industrial space and in the real economy. And when I say real economy, basically means infra, real estate, and so on and so forth. So this has actually become a lot of an alternate platform for them to raise a lot of capital. So one is obviously I look at financial services, but financial services has seen lesser and lesser companies tapping the market compared to industrials and the real economy. And that's going to continue for the next few years. So I think to answer your question in short, yes, I do believe small and mid-cap stories is going to continue because there'll be a lot of backing from investors in that space.
Right. It's very interesting that Nirav pointed out there are a lot of, increasing number of companies that are coming from beyond tier 1 and metro market. So, Amit, what is the kind of IPO readiness of these companies? A lot has been spoken about how a lot of pipeline that flowed into the capital market was tech-led. And those companies, for whatever reason, were not IPO ready. The kind of clients that you're meeting or the companies that you're consulting with, are they IPO ready? What is your sense?
I think what has happened is because of the markets being good, right? Because of the markets being good, a lot of companies which would have probably planned an IPO maybe 2-3 years down the line, they have advanced their plans. I think post-COVID, we have seen a lot of companies achieve growth that they were not ready for, right? And consequently, the need for money. There is an increasing preference to finance growth through equity rather than debt, right? So while the companies are not ready, many of them are willing to adopt that readiness, and a period of 3 to 4 months is what typically takes for the company to get ready. So the average period to market, while it would have been, let's say 6 to 7 months for the larger companies, for smaller companies, that period is 8 to 9 months, right? Also, we have seen a lot of intermediaries who have come in and helped companies achieve this IPO preparedness. We have seen increasing amount of professionalization that has happened even in smaller and mid companies in order to go to market and achieve their dreams. So over a period of time, we feel that while the sweet spot of an IPO would continue to be 1,000 plus. A lot of companies would continue to be in that 500 to 1,000 crores bracket, which would continue to raise money.
Right. And, you did touch upon it, but a large part of that IPO readiness is with the help of lawyers like you, Madhurima. So, what has your experience been? We've seen unprecedented capital markets activity in the last 24 to 36 months, the kind of pipeline that is building up. So, if you can share some of your experience.
Thank you. As you very correctly said, I've been doing this a long time, and initially we used to have only very, very blue chip companies who were very ready, and, bankers were dealing with them over 5 years, 3 years trajectories where they were cooking the deal for a long time, and then they finally went to market. Now, as all three of the gentlemen have said, there is a need for capital, there's a need for getting companies ready quickly, and then there is a need to take these companies early, as well as, in small towns, sometimes not even English speaking, and not even sort of ready to be a mature enough company for regulation purposes. So there is a lot of that. But the good news is that I'm actually genuinely impressed with the regulator, because SEBI has really, and not only SEBI, but NSE, BSE also, they have very quickly retooled themselves. Like AI has become one of the tools that SEBI themselves are using, and they are seeing, companies, how best they can help companies reach the market quicker, because they understand that the stress on these companies is a lot and they cannot prolong the process. Secondly, from, simplifying regulation, they've tried to do that. They don't always, nobody gets it right 100% of the time. But from a rights offer point of view, from making the refunds be done, the post issue being done quicker, they have tried to get process simplified for these companies. The SME sector is seeing an unprecedented growth, even though, I personally don't do too much in that sector, so I cannot speak with authority, but I've seen the regulations, and the regulations have been quite proactive. In terms of getting companies ready, obviously the stress has come on the bankers and the lawyers, but as Amit said, we have seen a crop of advisors come up and intermediaries come up, who are coming in and trying to, even company secretaries, a lot of independent company secretaries, independent chartered accountants who are coming in and trying to get the companies IPO ready. So I think what is exciting for me personally is that, India as an economy, I can see there is a lot of excitement. It's not only about maybe the Hyundai or the LG or the Swiggy, which is fantastic. It reflects how the country has grown and matured, but it's also the sheer depth of the market. And like Nirav said, we're looking at very small companies. Like Amit said, we're looking at it very fast, making them IPO ready very fast. And it's creating jobs for so many people across the board, as lawyers, as bankers, as intermediaries, as SEBI. It's a sign of a robust economy. And we are spending a lot of time with companies. We used to earlier get, a DRHP used to take maybe a month or 2 months. I've done DRHP, the draft red herring prospectus filing, in a month or 2 months. Now it's taking us anything between 3 to 6 months to get them ready, because SEBI is becoming very vigilant, and why not? They should be. So yeah, it is. There is depth that is coming in the market. There are challenges. Of course, there are challenges. There are challenges of finding resources. There are challenges of, connecting, end to end, from start to finish, to the investors, to the marketing, to the documentation. Of course, it's become a very challenging process, but I'm excited because I think it is healthy, it is robust, and I think it's the regulation aspect of it I'm not nervous about.
Interesting. Because we are also, going to touch upon the guardrails that investors have to watch out for. One, important critique that a lot of big IPOs invited this year was that they were all P-backed, and a large portion of it was OFS. So the companies were not necessarily raising fresh capital to pump into the growth. So to that caution, a lot of these big companies are backed by these global and domestic institutional investors like private equity funds. How are you seeing that change? Are you seeing that change, or increasingly more of these companies, the Ps, have the confidence to tap the capital markets and get an exit?
Yeah. So again, from a data point perspective, last year, if you look at it, of the total fundraising, 60% was OFS, but 40% was primary fundraise, which is effectively going into the company, whether it is for capex or deleveraging. So I think that effectively also means that companies are raising fresh funds. At the same time, you have a mix of not only the private equity shareholders who are also promoters, or majority shareholders who are monetizing. But again, just to give you the statistics, last year of the $22 billion of sell downs that happened, right? 1/3 was by the PE shareholders. 1/3 was by the foreign strategics. Right? So it is not only the fact that the sponsors are selling, but even the foreign strategics are selling. And of course, the 1/3 was by the promoters. So effectively, we had an equal split in terms of the sell downs. But as far as the private equity investors are concerned, whether they can take the companies public, I think it is quite evident, and there is no doubt about it. If you look at it over a period of time, the construct of how the Ps have changed from minority investment to majority investments to effectively being promoter of the company to owning 100% of the company, I think that is something that we have already seen. I think the investors' view on investing in a particular company is less of who the shareholder is, and more in terms of what is the quality of the company, whether the company from a model perspective is showing the right economics, whether it's unit economics, the margins, the growth, the return profile, or the management is something that has a vision to take it forward over a period of time. So I think those are the fundamental aspects of the company that drive the investment decision, rather than in terms of the Ps being a promoters. In fact, what they also see is that Ps being a promoter also helps bring a lot of corporate governance in the company, organize the company, and make discipline the company in terms of the processes part of it. So that is the help that comes to the companies. The only aspect that investors look for is that post the IPO, effectively what is the sell down strategy of the Ps, of the sponsors, and as long as it is disciplined, as long as it is over a period of 3 to 5 years, I think the investors don't mind, right? So I think that way, I think it's a pretty good set of how the companies are doing, irrespective whether it's effectively a private equity backed or not.
I'll just probably add, today, if you look at the startup space, right, there are about 118 unicorns that have come. Right? Now, at some point, these unicorns were supported, these startups were given capital by PEs. So the fact that these companies have scaled so much, right, rather than retail taking the risk, PEs have taken the risk, right? And it is only right that they get their exits when the companies have scaled up. When these companies are invested by investors, retail institutions, right, they are getting scaled up place which otherwise they wouldn't have got.
Right. Just to be a devil's advocate here, it also means that, a lot of these IPOs are priced very aggressively when, the Ps are involved, because obviously, sometimes they're trying to maximize the outcomes for themselves. So in that sense, what has the experience been? Pricing discipline, has that come into IPOs?
Sure. So I think last year probably was one of the best returns in terms of IPOs. Right? There have been a few changes on the regulation side as well. So I believe in April or May 22, SEBI came out with this regulation and said that we will make HNI category a category from being proportionate to a maximum allotment of 2 lakhs. So previously, we used to see a lot of people get, put an application of 100 crores, get 1 crores, but it was a large amount came and restricted the allotment to 2 lakh rupees. A lot of people have benefited, right? So that wealth is got more distributed, and I'm sure people who are sitting here have made a lot of gains in IPOs. In fact, as a number, I think the average listing gains for the last year have been about 30%, which has been much, much higher than some of the earlier years. And the discipline of whether it's a PE or a banker or a corporate in terms of pricing the issues have been much, much better, right? Whether you look at QIPs or blocks, we see prices going down after some of these offerings. But very rarely you would see a IPO price going down after listing. So I think that discipline has been well maintained. And in some cases, PEs have actually continued to own significant stake even after selling down, right? That is ensured that the pricing has been right.
It's interesting that you pointed out about the HNI participation. Even retail has been, we've seen a retail participation in IPOs. Some of them have really struggled to get through to the retail quota. Nirav, if you can come in here and talk about, how are you seeing this entire retail participation coming in? Obviously, the DIIs, the pool has expanded where, a lot of IPOs today can sail through just because of the DII demand. But how are you seeing the retail participation and the kind of IPOs that are coming, the quality? If you can talk about that.
Rightly put across by you saying that today, at one point in time, we used to always look at FII participation. And today, actually, FIIs look up to whether there is some large couple of mutual funds coming in or not, right? And basis that there is a lot of decision they take internally saying, okay, if there are these 2-3 guys coming in is when we will participate. When we talk about the retail investors, I have always believed that retail investors are much more smarter, okay, to put in their money. Because what they do is, while on one side one may say there is a herd mentality in terms of, whatever is getting oversubscribed, they kind of put in a lot of capital. But they are also the guys saying, okay, whether will I make money on listing or not? What do I make, right, at the end of the day? So, absolutely, I personally believe that retail investors have become smarter and smarter over a period of time. And that may be also because of the reason that they've burnt a lot of money historically, right? So they have now decided saying that, hey, nobody else can kind of fool me. I will only jump in at a time when I see the rest of the guys coming in. I will also come at a time when, issue is decently getting subscribed, and hence there will be some pop. While they may decide to continue for a slightly longer period of time or midterm or so and so forth, but there is an immediate pop that is available for them. So it's I think the widespread investor base in terms of retail, the participation coming from some of the other smaller cities and town because of the getting opened over there, etc., etc. And also historically they have seen and burned their fingers. So I think that over a period of time I do believe is becoming strengthening over there.
Just to add.
So just to put it in perspective of data points again, of the total domestic capital pool of $1.4 trillion, the retail HNI is $532 billion, right? $500 billion, right? So that is the amount of money that the retail and HNI are holding in the capital markets today as part of the AUM. The second important aspect is that the retail and HNI participation, while it is direct into the markets, but they are also playing through the mutual funds. And the numbers of SIPs are only increasing. Like the last month was $3 billion on a monthly basis, right? So that is the power of the money from the retail and HNI perspective. Especially when it comes to the sizing of the IPOs. If you look at IPOs which are sub 1,000 crores, the retail and the HNI are a lot more prominent in terms of the subscription levels. And we have seen the companies also doing pretty well. So from the retail HNI perspective, I think they are a relevant capital pool. It is not only the institutions, whether it is the FIs or the DIs. They are a driving force. Also, if you look at from, again, a data point perspective, years back, the view was that after the IPO, the retail would sort of sell out, right? And that effectively will go to FIs and the DIs. But that we see as a trend changing in terms of, while they may sell off, but that process is a lot more gradual. They are happy to hold on if the company is performing.
Right. And a lot of this retail participation is also leading, I mean, SEBI is becoming overprotective of this pool. And, Madhurima, maybe you can talk about, people talk about over-regulation and SEBI is being overprotective, but what has the general sense been? Because, while there has been increasing regulation, they have, taken it upon themselves to protect these small investors. The company become smarter in that sense and put guardrails in place.
So as a lawyer, I'm always going to be overprotective. So the SEBI Act, if you look at the SEBI Act, and very few people nowadays read the SEBI Act, but whenever there's a junior person in my team, I actually tell them first, go read the SEBI Act. Why was SEBI formed? There are two mandates, and this is for everyone in the audience, little bit of general knowledge. SEBI in this country was formed. They have two mandates. One is to regulate the capital markets, and the second and the most important is investor protection. The SEBI Act itself mandates that, and that's the statute. So there was a regime in this country where there were vanishing companies. You would put in money into a company, and then ab jate the to the company's office. There was a clock on the door. There was no business, etc., etc. We have come many decades away from that regime. Today, with the kind of numbers that the three gentlemen are talking about, SEBI cannot not be overprotective, because we also, as bankers and responsible bankers and lawyers, we want overprotection because, honestly speaking, it takes that one IPO to go belly up for the entire market and the market confidence to go away. We do not want a scam. We do not want a meta in this country. Again. So therefore, to that extent, we do want overprotection. If it means that the lawyers and the bankers have to work harder, so be it. That is our job. Of course, we have to do what is right. For the regulator and for the investors' protection. That is what our game plan is. So therefore, yes, there is some criticism that SEBI, there are some media reports that SEBI is becoming overprotective, etc., etc. But as a lawyer, and I would defer to the gentleman on the stage, and as bankers, I would think that we always want to protect the interest of the promoters, the company, but most importantly, the investors.
Also, to touch upon, Neerav mentioned that, these days FIIs look up to the kind of DIIs that are coming on board for IPOs. And in that sense, Amit, if you can talk about that, a lot of these DIIs are having the pricing power for IPOs these days. A lot of road shows and, that's what we pick up from our sources. So how have DIIs emerged as, the power force here?
So, if you look at the last year figures in terms of inflows, right, there was about 3 lakh crores which was sold by FIIs, right, and DIIs bought about 5 lakh crores. Despite FIIs selling 3 lakh crores, our markets are almost at their highs. So clearly shows the decoupling that all of us have been hoping that would happen, right? Second, all the DIIs which are there, the depth of their pools has gone up. Mutual fund industry, which used to maybe have about 11 lakh crore rupees 3 years back, today is sitting on 40 lakh crore. SBI alone, which is the largest mutual fund in the country, manages 8.5 lakh crore of rupees, which practically used to be the entire mutual fund industry 3-4 years back. With the increasing inflows, you expect DIIs to continue to play a dominant role in offerings. In fact, most of the IPOs or QIPs that we see 3x of DII demand compared to FIIs. Also, what has happened is all the AIFs have only increased the pool. So we have today more than 5,000 AIFs which have 500 crores or more of the corpus, right? A lot of family offices have started providing this pre-IPO as well as IPO capital. So overall, the pool is only increased, and most of the MFs are custodians of public money. If they can get something cheaper, they always buy it cheaper, making more returns for the mutual fund. If you look at the mutual fund industry, right, it has given you a return of more than 30% in the last 3 years on a CAGR basis, right? That's, it's only correct that they do their best in terms of pricing, and that's what we see.
Right. Interesting. Madhurima, if you can quickly, talk about how, because you consult with the companies, but, you do help them with, regulations and getting past. Has the process become only tighter? Gaps that you see that over a period of time, with the help of technology and other things that SEBI is trying to address?
Yeah, so I think the process has become stricter, I would say, and more regulated.
Has it become faster?
Not really. Not really. I mean, I'm not talking about SEBI. I'm talking about the IPO process, start to finish. The NSE has recently come up with a regulation where they are actually asking us to make a repository of documents. So literally the 500-page prospectus that bankers and lawyers sort of do due diligence and sign off on, line by line, word by word, number by number, we have to have backups. Okay, so it has become stricter, it has become tighter. But if you mean that is SEBI at their end trying to move things faster? Yes, they are. They've hired a big team. They have used AI as a tool. They have brought in regulation that within 3 months, they are going to try and clear all documents. They also don't want to keep documents. Either they will return the document or they will clear the document. They are not doing any backlog at their end, but the process itself has become more rigorous, and I will defer to the 3 gentlemen to add on to what I'm saying on that.
So, see, while the process for issuers has become difficult, right, I think for investors, they have consequently come out with measures where the timelines have gone down, the ease of applications have increased. Today, you can sit at your home, do an ASBA application, the money doesn't even leave your account, right, till you are allotted shares. As I said earlier, they've tried to distribute the wealth and the returns made from these IPOs by saying that at least one allotment has to be made to all the applicants. So I think in all these measures, SEBI has ensured that ease of investor and returns for investors, especially retail investor, is only gone up.
And has the corporate governance standards in companies, Nirav, if you can bring it?
All of us can vouch that we have been working extra hours to ensure, and SEBI's made us do that. So,
no, but at the same time, if I'm seeing, I mean, what we have seen about 10 years back, the governance standards for what we had expected in some of the mid-cap companies have drastically improved. Okay. And that is also because of the fact that, see, some of these cities have seen evolvence of multiple professionals like chartered accountants. It may be, obviously, it did speak about some of the independent financial concerns, etc. But within the company also, right, they have actually now hiring teams, chartered accountants, to make sure that some of the things are in order. So that's a very, very positive move towards governance. Obviously, one has to look at, see, it can always be, the question is, can it be better than this? The answer is absolutely yes. It can be much better than this. But have we evolved from where we were about 10 years back? I have a lot of confidence when I go to the company and say, okay, can I trust these numbers? Yes, you can actually go and trust these numbers. Can I say that 10 years back when I had to look at a P&L and balance sheet saying that, okay, these are the numbers, these will be the actual numbers? The answer is no. Because there are systems, processes, some of it is actually coming from the system. So there is an ability for somebody to go into the system and check those numbers, what they are actually saying in terms of the P&L. Also the fact that some of these chartered accountants over a period of time have realized that as a professional, right, one is on the tax planning side, but at the same time, the reporting numbers have far, far better improved. right? If you even see today, some of the listed entities, and I've been looking at some of those right from 2,000 crore market cap and above. If you see the kind of detailing of the IR presentation that they have, the detailing of the information that they put out for the investors, and the accessibility to some of these IR agencies or the IR person in the organization have significantly improved on the listed space. Can I speak about those companies about 10 years back? Absolutely. I mean, there were no landline numbers, right? There were no IR contacts that I could reach out to. Many of the promoters were not accessible. So how do I really go ahead and understand the story from the founder, saying that what are you trying to do, what is the plans, etc. Today, that has evolved over a period of time. I think that's become far, far better.
Right. On that note, a vigilant regulator, bullish investors, and what it takes for 35 billion worth of IPOs to come in 2025. So thank you so much, guys, for making time and speaking to us. Let's have a huge round of applause for our speakers.
Thank you.
May I request you to please present a token of our gratitude to all of our panelists. And you'll all agree with me when I say, sir, I'm really sorry we've run out of time. In fact, we've run way over time. But I think our panelists can be found, right, for the next couple of minutes? Yes, so you could please take your question offline one-on-one, sir. Thank you so much for understanding. Thank you. Let's hear it for our panelists once again, everybody. Thank you very much once again, Sneha. Thank you for moderating that conversation. Digital transformation in banking, it's like upgrading an old reliable train to a brand new fast speed bullet train. The destination remains the same, but the journey is now going to be faster, smoother, and certainly packed with innovation. From mobile apps that let you open accounts faster than you can order, algorithms that predict our financial needs even before we can think of them, digital banking is reshaping the DNA of our industry. It's time to pause and ask ourselves, is this shift merely a shiny new app, or is it a completely brand new way of reimagining banking in our country? To help us understand where we stand in terms of digital transformation, because, I mean, come on, ask yourself, when was the last time you visited a branch? I don't remember. I'm sure you don't either. It's made banking easy for us, but is there more to be done? That is the question we're going to dive into. We're going to find out from a global expert, ladies and gentlemen. So stay glued to your seats. And of course, as we're inching towards our final panel as well and the awards this evening, I want to remind you that please continue to share your experience on social media platforms, and don't forget to use hashtag Mint BFSI 2025 and do tag us at LiveMint. Okay, we're almost good to go. Nearly there. And I also want to remind all of you, because, you know, we're inching towards the end of the summit and the awards, and then we'll open the evening for networking. And talking about networking, I hope you all are making most of the networking AI bot, I should call that you have on your WhatsApp. You would have received a WhatsApp message from Mint BFSI Summit. If you pay attention to that message, it will ask you, it will say join now, and when you do that, you will be able to network and collaborate with just the right people for the rest of the evening. Okay, the stage is set, and so am I. Inviting on stage, I think for the third time, right? Alokesh Bhattacharya of Mint, who will be in conversation with Chief Product and Technology Officer of Zafin, Shahir Daya. Everybody, please put your hands together in a huge round of applause.
Hello. Yeah. Okay. We've been doing a fair bit of merry-go-round with our mics today. When was the last time you went to a branch? Seriously. I think I go to a branch once in 3 years to give my KYC. That's all. Everything else is on the phone and on the PC, laptop, but more on the phone than anything. So, Shahir, welcome. Thank you very much for your time. Really like to hear some interesting stuff from you. You know, one of the things we were discussing the other day as well, from a digital point of view, in finance especially, we say that India is, I've heard this from a lot of people, and not necessarily only bankers, that India is far ahead of the developed world even in terms of digital transformation and the use of digital because of our India stack and, you know, the UPI and those kind of technologies which are not there in the West so much. But what about banks? Would you say it's an accurate statement to make of the developed markets? You are coming from Canada, so you know what the market is like over there and what the systems are there. Just enlighten us a bit about this.
Yeah, no, so, no, absolutely. So I think that India has undoubtedly emerged as a global leader when it comes to digital transformation, specifically because of initiatives like UPI, where it's really set the standard, right? It's set the benchmark for real-time payments from a scalability standpoint, from customer adoption standpoint, right? And it is that the India stack, you know, with UPI and Aadhaar and some of the other frameworks that have really enabled customer inclusion and scalability and innovation at a scale that is unmatched by some of the developing markets.
Right. Are there any gaps or like we're there already? Are there any gaps in the transformation journey?
Yeah, no, absolutely. I mean, when you think about payments, yeah, but if you look at some of the other areas like wealth management or lending, they're not there yet. They're lagging behind payments from a end-to-end, you know, digital journey, right? Having seamless a digital experience, they're a bit lacking, right? And look, the Indian banks and all the banks globally are very much struggling with core modernization, right? A lot of time and effort has been spent in the last few years on the user experience, on the front end, right? On the glass. And there have been some amazing advances in terms of innovative capabilities that have come out on the mobile app, on online banking and whatever the channel application is. Been significant advancements there. The experiences are very seamless, are very, very innovative, but we've kind of reached the limits of what we can do on the glass, stitched together and hacked together on the glass. And it's now a level playing field. I find that all the banks globally are almost on par with those capabilities. And for any bank to now, you know, advance that further, to have that next big step change in capabilities and innovation, they need to look under the glass. And that's where the back-end systems and the core banking platforms, which are entrenched with legacy technology for the banks that have been around for decades, there's a lot of legacy technology in the back end that is really inhibiting agility and inhibiting innovation. So core modernization is something that needs to be tackled. In India, I find also the adoption of cloud is a lot slower than some of the other developing markets. And they're being very cautious because of regulatory uncertainties, but it's something that we need to tackle and move towards the cloud because there's very significant benefits to going towards the cloud.
Right. Talking about cloud, you know, like we were discussing that cloud itself has become very complex today, right? The initial premise of cloud being simple and that you don't have to worry about the management of the IT infrastructure and all. But now there is a cloud organization inside the IT organization, right? So, and it's become very, very complex with so many cloud providers. Each bank has a set of providers, not one. So, what, in your opinion, are areas in the cloud technology that Indian banks could utilize more efficiently, considering the regulatory restraints that are there?
Yeah. Yeah, that's a good question. So when I look at the regulatory constraints, right, look, it's going to be a hybrid cloud environment. It's probably going to be a hybrid multi-cloud environment because you want to, first of all, it's hybrid because you are not going to put sensitive workloads in the cloud immediately. You're going to keep those sensitive workloads on your premises. Not sensitive that you should be in the cloud. And, you need to, obviously, the regulatory compliance needs to be looked at, especially around data residency and privacy. But the banks really need to work with these cloud providers and make sure that those requirements are addressed. What we're seeing is when there's a cloud provider in country, they have a presence in the market, they have a data center region in the market, they have deep pockets, they have large teams that look at all and the security controls that are necessary, and they ensure that those are available in their cloud environments. So moving the starting by moving the non-sensitive workloads to the cloud is a great starting point on the journey to getting to cloud. When you look at the capabilities that we are seeing that are being used a lot in the cloud analytics, right? When you have workloads that are using a significant amount of data and they're unpredictable, you're trying to do things like customer segmentation, or you're trying to do credit scoring, or you're doing fraud detection, those kinds of user scenarios, those kinds of use cases benefit significantly from cloud, right? And when you think about things like disaster recovery, you want to be more resilient. A DR system in the cloud is a lot more cost effective, for example, right? And there's ways to start. And the fintechs out there, including Zafin ourselves, we are in the cloud, we are a SaaS, and externalizing those capabilities from the bank to the SaaS providers, these fintechs, is a great way to get into the cloud as well and take advantage of the fact that the SaaS providers, those fintechs, are in the cloud, they're optimized, they're agile, they're innovative, they've taken advantage of everything that the cloud has to offer.
Right. You were talking about the front interface in which we've practically done all that's to be done. But now there is a new force in the form of AI and generative AI as well, right? So AI-driven personalization is a big thing for a lot of companies, not necessarily banks so far. But so in your view, how will this impact the product and pricing strategies of banks going forward?
Yeah. No, Alokesh, you're absolutely right, right? AI has taken us by storm. I think that, when ChatGPT came out, it was such a huge step up. And, when you look at it and you look at what it's doing and how it's doing it and the capabilities, you think, oh, okay, this is it and it's going to slow down. And it hasn't. It's, every few weeks, it's another big jump up, right? And it's going to impact not just product and pricing or bank, it's impacting every single industry. For us specifically, we have been investing in AI for almost 2 years now. We have an AI team. We have a dedicated leader on the AI front and have spent a lot of last year building the foundation for our AI platform. In terms of product and pricing, when you think about personalization, using AI to figure out what a customer needs, looking at their behaviors, their habits, and creating an offer that's hyper-personalized that the user just one turn away will definitely sign up, is something we're starting to leverage AI for. In other areas, dynamic pricing is another area where we are looking at AI very significantly, right? Dynamic pricing powered by AI, where the AI is looking at the risks, it's looking at the demand, it's looking at the customer profile, and then optimizing the price from a revenue standpoint and from a competitive standpoint. So we see AI impacting a lot of the things that we do in this product and pricing space. Now, AI needs data, and it needs a significant amount of data. It needs clean, high-quality data, and that's an area we need to focus on. And then the other area that we really need to focus on is fairness, because fairness in banking, trust, transparency, those are the cornerstones of banking. And so we need to make sure that this AI is not biased in any way, especially if we have to cater to the diverse socio-economic demographics in India.
Yeah, absolutely, you're right. The other area that banks worldwide have struggled with and is cybersecurity, right? That's another, how do they keep their accounts, how do they keep their data secure is an issue that they're continually working on. In your experience, where do you see the gaps are in terms of cybersecurity? What are the best practices globally that are there that should be adopted by banks in India and even in other economies?
Yeah, cybersecurity is really a global issue, right? And there's significantly more awareness, and there's a focus on cybersecurity, especially when we've pushed into the digital era and everyone's now using phones and devices. Cybersecurity is very important, and we've seen incidents, right? We've seen fraud, we've seen phishing attacks, and so on. So there's a heightened focus on cybersecurity. Collaboration is important, right? The banks need to collaborate with the cloud providers, with the fintechs, with cybersecurity professionals, so that we can all together on being aware of the threats and keeping those threats away. Now, there's quantum. I had quantum in one of the sessions earlier today. Quantum computing, there's going to be a lot of good that comes out of quantum computing, but we have to be aware that quantum computing is very good at solving very complex mathematical problems. And these complex mathematical problems are what underpin some of our current encryption technologies.
Correct.
And so when you think about a quantum computer being able to break some of our existing encryption in a matter of minutes and seconds, that is a significant threat to financial data. And banks need to start looking at quantum-safe approaches, right? And quantum-safe approaches do exist, right? There's many alternatives to get a quantum-safe algorithm in place, including ourselves. We do hold data that comes from the banks to us, and that's something we are looking at as well, and that's something that the bank should start. Overall, it's the exact same. A zero-trust architecture is important. Doing regular penetration testing is important. Collaborating with the cloud providers and the fintechs and so on is important. And then obviously working through and getting ready for that post-quantum era is going to be extremely important.
And all of this is going to... So, quantum safe does that mean that to counter a quantum computing, algorithm, you need another quantum computer yourself?
That's right. One quantum computer can break the other. It doesn't work quite like that, but yeah, it's a thought.
Okay. But all of this, there's new things that are emerging, quantum computing, the emergence of AI in personalization and pricing. They are also going to need a lot of new skills, which are not necessarily there in huge numbers in the market, right? So tell us a little bit about what are the skill sets really of the future in terms of the banking ecosystem, apart from the teller counter person giving you the money, which has practically become, extinct now.
Right. No, this is a question I struggle with as well. And many of you have little kids at home. I've got little kids, and they're getting ready for high school, and they're like, okay, what should I study? And I'm like, you know what? I haven't got the slightest clue, right? But when we look at all the work that we're doing and where we believe that the technology is going, AI is clearly, the next decade is going to be humans using AI, right? It's going to be defined by humans that are using AI. And, we at Zafin use AI in pretty much everything that we do to gain productivity gains and so on. But AI requires data, right? So data skills, data engineers, data scientists, anybody that's trained on machine learning and AI is a very important skill for us. And then when you look at modernization, because we have to modernize, to be able to use AI and all of the other technologies that are coming that can give us a step, the next big step up, we need cloud, we need DevSec things. Cybersecurity is the other one that's absolutely needed, right? And product managers that have deep domain knowledge, but also that have technical fluency are going to be important. And then designers that, can bridge the gap between design to leveraging the technology and so on. Now, I think India is very well positioned with a large pool of talent. The schooling system here is top-notch. The engineering schools are top-notch. As long as we continue to, sustain our investment in upskilling, we have to upskill. There's no way we're going to keep getting new talent out of the universities that are trained in the new technologies that come up. We need to upskill our existing talent and make sure that they're ready for the future.
Yeah, you're right. And even if they are trained in new technologies, they're not necessarily going to be able to work for you immediately after stepping out of college.
Absolutely.
You'll have to train them for 6 months, 12 months or something and get them ready for it. Right, so Shahid, thank you so very much for coming and sharing your thoughts with us. It's a pleasure having you with us.
Thank you so much. Thank you for having me.
Thank you so much, Shahid and Alokesh. And Alokesh, you know the drill. Can we have the plant on stage, please? Shahid, thank you so much for joining us here at the Mint BFSI Summit and for having a very candid conversation. Let's clap, everybody. Come on. Thank you. Thank you very much. We're seconds away from one of the most, I think, the most awaited power panels of the day. But before that, I'm going to remind you one last time to please join us and take the conversation from the room onto your social media platforms using hashtag MintBFSI 2025 and do tag us at LiveMint. Stay glued to your seats because while 2024 has been a year of navigating uncharted waters from global inflationary pressures to rising geopolitical tensions, Indian banks, you'll agree with me, had to walk a pretty tightrope balancing the local and the global, the predictable and the absolutely volatile. Domestically, banks face challenges in managing liquidity amongst RBI regulations that are changing, while on the international stage, we contended with fluctuating currency rates, supply chain disruptions, and even new trade policies. Banking today is not just about balance sheets. It is in fact about balancing everything, everywhere, all at once. Here's the question. How do banks prepare for the unpredictable? How do they maintain customer trust at home while competing on a global stage where the rules of the game are constantly changing? And most importantly, how do they innovate and adapt without losing sight of the fundamentals? I'm pretty certain these are some of the questions that our moderator is going to pose to our panelists. But besides that, there's going to be a lot of food for thought and action that will be shared. So everyone, please stay seated. And a gentle reminder once again to place your cell phones on the silent mode. And while we're actually turning the stage around to welcome our panelists, I want to remind you, because I can see a lot of you have just joined us now, possibly for the awards evening, that when you register, upon registration, you would have received a WhatsApp message from Mint BFSI Summit that will invite you, give you opportunities to network, to collaborate, to have a meaningful conversation today with a person of your choice. So please make sure that you click join now on that message. When you do, it's going to open up it's going to pop up another message that's going to allow you to choose your area of your subject of conversation, your area of interest. Upon choosing that, you will then be provided with a connection, a possible connection, someone that you can have that conversation with. And then, of course, upon accepting it, the two of you will be further connected. And that is when you can exchange numbers and meet right outside for a chat much later in the evening, the time that we've reserved for drinks and dinner. Well, we have an all-star panel who've been at the helm of steering their banks through uncertainty. They have actually been at the Speakers Lounge waiting to share their insights and years of experience with all of us. Shayan Ghosh, who's the editor of BFSI Mint, is going to make a comeback, I'm not sure for the third or the fourth time, on stage to ask some pertinent questions on behalf of all of us. And while I have observed throughout the day, we've been a relatively quiet audience. Please don't hesitate to participate in this one, all right? This is the panel that you need to ask all your questions to. Our panelists, okay, only one panelist is smiling at that. The rest are like, no. But yeah, if you have any questions, please reserve them. I've told Shayan already to keep some time for audience questions later. And I think we're still waiting for one panelist to join us. Who is? Yes, Mr. Vaidyanathan. He's in fact here already. If we could just find Mr. Vaidyanathan so that... Okay, so we're going to kick off with the panel, and if you could also please get Shayan in the rooms, because he's the man who has all the million-dollar questions for our panelists. All right. Should we call this the calm before the storm of the CEO panel? Okay. Let's get going, ladies and gentlemen, and please prepare to welcome our panelists on stage. Hitendra Dave, CEO of HSBC India. Pranav Chawda, CEO of JP Morgan Chase India. Prashant Kumar, Managing Director and CEO Yes Bank. Mr. Vaidyanathan will be found and will join us eventually in the course of the conversation. And Shayan, please join us. It's your chat, and we're really looking forward to it. Check.
Hi, very good evening, everyone. So before we start, I'd just like to give a brief introduction of what the topic is. So, with India's economic growth, lack of a broader consumption slowdown, the banking industry is unlikely to remain insulated from that. So we also have a lot of geopolitical changes happening. We have Trump coming in. We don't know what is going to happen with the tariffs, etc. There seems to be a lot of uncertainty on that front. While India is resilient compared to its peers right now, things are quite fluid. So, we have a set of panelists we have seen multiple such cycles. I'd just like to start with a small question. You can take a few minutes on that, each of you, to talk about over the years how you have seen banking itself change. Now there's a lot of new things. There's climate finance, there's AI. Things are different when you guys all started in the banking industry. So maybe a brief introduction on how things have changed for good, for bad. Briefly, if you could just all touch upon.
Thank you, and good evening, everyone. And thank you to the Mint team for inviting us to be a part of this panel. We'll try and make it as lively as it is possible to be at 6 p.m. at the end of a long day. And but I think few things. Clearly, technology plays a much bigger role today than it did in the past, and that's a good thing. That's why the country can handle whatever 110 crore accounts and still be up and running. It's not so straightforward. I think that's clearly one. I think financial inclusion, people with very small amounts of banking needs or banking deposits, that wasn't the case here as even I would say 15-20 years back or so. That's one. I think on the negative side, some of the personal touch has gone away. Too many young people who are joining the industry are joining it just literally to sell X, earn Y, and then move on. That's not what banking traditionally has been about. Banking traditionally has been about you build a relationship with an individual, your branch manager, your teller, your whoever. So, and that's a challenge for the industry today. The sheer level of attrition. It's not even if you go to the same branch and every time you see different people, it is a little off. is a little off-putting, right? That different people are there. But the digital public infrastructure, the fact that we don't carry cash anymore, the fact that all we need is your mobile number to make payments, all that is on the positive side or so. And finally, before I pause, very clearly, certainly till very, very recently, I would say the strength of the balance sheet of the banks had been as good as it had been going back many, many years from a capital adequacy perspective, provisioning perspective, liquidity perspective, just improvement in governance and other perspective, etc. So as with any other industry, there are more positives than negatives. But as an industry, we need to address definitely the people issue. If there is a challenge, I think it's on the people side, I think, where we need to invest a lot more.
Pranav, if you could.
Yes, good evening, everyone. So I think most of the points that you mentioned, that's true. We've seen this transition or the change evolution happening in the banking segment across products, people, the way clients deal with banks and the way the banks move money. Apart from that, I think a couple of changes that I have seen over a period is that the companies or the clients or the individuals, when they deal with banks, now their expectation is beyond products and services. I think they expect the banks to also be part of their strategic advisor, give them a lot of insights in terms of what's happening globally, what's happening locally, how are the businesses evolving. So to that extent, I would say that, different for different segment of customers, but customers do expect that apart from the capital, there is an intellectual capital also that comes on the table. And that's where I think the differentiation or the distinction comes about from a customer's mindset point of view. What's changed, not for good, is exactly what Mr. Dave mentioned. I think the personal touch is missing. The continuity factor is missing. Banking has always been something that, most of the entrepreneurs, used to cherish the relationship managers, and they would say that, they would always take them as their advisors and mentors apart from only the banking. I think to some extent that is a little bit eroded, and that's the only negative part of it. But I would say that, that is also something that will come back eventually, because that's not going to be lost forever. The new generation who's taking over the mantle from the old generation entrepreneurs have also started realizing that the continuity factor of the relationship with the banks is going to be an important factor in the long run.
Prashant, sir.
I think fundamentally the banking has remained the same. But if we see in the Indian context, I think the challenge and the opportunity is about to take care of the banking needs of 1.4 billion Indian people. And when we are talking about banking needs, this is more in terms of access to banking and also providing the credit. I think this is something which banking in India has to see the opportunity and how to meet this demand. And definitely when we are talking about a 1.4 billion, or maybe you talk about a 1 billion, which can be lendable, it cannot happen without a very extensive use of technology. So I think this is something which is changing very fast, that in the banking you use technology to take care of your customer, but at the same time how you can also safeguard from any possible misuses of technology and safeguard the interest of the customer. Customers are also becoming definitely very demanding in terms of the kind of service which is expected. Touch for 1 billion or 1.4 billion would be very, very difficult. I think over a period of time we need to evolve where there is a frictionless banking access is available. So there is very little cause for reaching out to the bank in a personal way. But I think the fundamental change which has happened, especially I would be saying in last debacle which happened in the banking like 2018-19, so many issues on the NBFC and the bank side which happened. After that, the understanding in terms of importance of governance, importance of doing the right thing, and also in terms of how we can sustain this momentum. I think this understanding has come both within the banks as well as in the customer segment.
Interesting. Mr. Vaidyanathan?
Well, lots have been said. My quick comment is that, gentlemen before, banking had some old world charm and personal touch and all that. But remember, that is available only to some 1% of India. Until 10 years ago, 500 million people did not have bank account only. Where are we talking about really good personal touch and all that? So I really feel that the big change that has happened is that more segments have opened up. And like we all know the numbers about accounts opened. I believe similar lending side, nobody got credit. So what personal touch we were giving? We're not giving money only in the first place. So I think it's all changed massively for the better. And now, I was just checking the other day that there are 600 million trade lines on the bureau. Close to about 273 million are live today. So all those things were possible only. So my key takeaway from this is expansion of the system and increased availability is the biggest takeaway to me. And as far as personalization is concerned, I would say that now it's digital personalization or hyper personalization. At least our bank is always attempting to be on the cutting edge of technology. And it's not human personalization, it's digital hyper personalization.
You spoke about financial inclusion. Now, it is said that, more than opening accounts, it's also about allowing the flow of credit to people who have opened those accounts. At one, we have, say, these many accounts. These are the people who might not be able to access secured credit. We are also clamping down on this over-exuberance, quote unquote, on unsecured credit. Do you think these two are working at cross purposes?
Well,
Vaidyanathan and then Mr. Kumar.
Sorry, you want to go?
No, both of you.
No, well, it's very simple. End of the day, like I said before, people are not getting access to credit. So, apart from the physical security, if you have a plant or a machinery or something as security, how much security is that really a security in that sense? While cash flow is real security, you can see the money in the bank. So I therefore feel that if we want to do financial inclusion, then alternative forms of security, which are oftentimes more powerful, are to be explored and powered up. We do have the control of a powerful bureau system today. You can really see, you can have a look through of a customer's finances by seeing the digital statements. You can have a look through, you can have access to GST, you can have access to the QR code and the money in the bank, more digitization. So all these are really powerful means, and we should be considering them when we think of financial inclusion. Really, if we sometimes talk of new to credit. So oftentimes we tend to say, oh, new to credit, risky, but someone has to do it. Everyone has to only lend to big Gen Z ecosystem. 28% of India's population is today Gen Z, or will become soon. Now within 4-5 years, all of them will become eligible for credit. If you tell all of them become new to credit, who's the first person to bell the cat? So therefore, this is all important part, and we should think about expanding the ecosystem, not giving more and more credit to the same people who have been lent before.
I would like to see in a slightly different way when we talk of a secured or unsecured. I don't think security is so much of a concern. It is more about when we are giving the loan, this is for consumption purpose or this is for a creation of asset. Even for consumption purpose, whether the customer would be in a position to repay you. I think that is very, very critical for the banking industry, and that's why I would not be saying it's a exuberance, but I think if we would like to go into the direction of providing that access, even for consumption purpose, banks need to prepare very well for this, which would happen both in terms of using the data for credit underwriting and a very strong collection. If we go unprepared into this market, the likely impact on the credit cost could be very high. So I think it's important for the banks to enter into any area, first fully prepare in terms of what is the impact. Because ultimately you have to take care of the larger interest of the depositors and sustenance of a good quality of the banking in the country.
Next to Mr. Dave, is the pace of the depreciation in the currency keeping you awake? Keeping you awake?
No, it doesn't. I'm sure people in Mint Road have bigger concerns on the currency than private citizens. I would be awake if I was an importer, if I would be awake if I had unhedged foreign currency loans. But I think we make too much of this, right? I mean, when bond prices go up and down, it doesn't make headlines. When equity prices go up and down, it doesn't make equal amount of headlines. But when currency yesterday was 86.60, today it is 86.62, so it's a new low. I mean, frankly, immaterial 2 paisa, 5 paisa. But the broader question you put is relevant because, I mean, at least our sense is this whole currency move in the last 4 or 5 months has got triggered principally by the election, the US election result. But in our case, it is beyond that a little bit because there is actual dollar outflow also, right? The amount of selling, I'm sure somebody here will know the exact number, since almost 1st of October might be 10, 15, $20 billion or so. And the problem with financial markets is they are, once they gain momentum on their own. And all of us have seen that, I was just narrating the story how in big international banks, you go around dealing rooms around the world, somebody will be $10 million long, somebody will be $20 million long, and before you know it's $4 or $5 billion from one bank all put together. I think it is a subject on which, for the most part, Reserve Bank has done a great job of ensuring that they accumulated all these reserves. They accumulated almost $250 billion, of which they've spent $150 billion in the last 4 or 5 months, if I take the reserves plus their forward positions or so. So I think it's a subject on which we need to tread carefully and not draw a line. Nobody knows what the fair price of an HSBC stock is, or a Yes Bank or IDFC. So how can anybody know what the fair price of a... So if it goes because we think it's below. So I think that's the only thing that nobody really knows. It's only post facto that you know where the market has peaked. So I think we should let the market do its job and just come in here once in a while. But at a broader level, I would say prepare the country that the currency will float. You have to let the importers and the exporters and the borrowers and the NRIs just into whatever they are. If you set up a project with imported machinery, you need to know. I think that's where I think we could be going a little wrong, that we think there is a big daddy out there who will bail me out if my views on currency go wrong. That cannot be.
To Pranav, a similar question. So, for the last couple of years, we have been talking about how the domestic currency has depreciated much lower than some of the other EM currencies. But given now that we understand that RBI probably isn't going to intervene to check volatility in the manner that it has been doing for the last couple of years, how does it change the strategy for a bank that also has trade finance, you have exporters, etc.?
So I think the rupee dollar rates, I agree that at times I think it is overhyped. Yes, the rupee has weakened, but it is not fair to say that it is weakened to an extent where we are the worst currencies, because if you really look at it, euro has depreciated more than rupee. But even then, I would not take that as a benefit for our depreciation. The way I would look at it is whether the rupee depreciates and comes to a fair value, as we mentioned, whether it is 85.6 or 86 or 89 or 88. I think the real concern is not the level. The real concern is the time within which it reaches that level. So that becomes a concern if the importers are not prepared. If you look at it, the amount of imports we used to do in terms of certain products and categories, somebody who's been doing this import on an unhedged basis for last 5-6 years, he has seen the rupee dollar moving from 60 to 86. Has he gone out of business? The answer is no. Because if the depreciation happens gradually over a period, the market corrects by itself. Everything gets repriced accordingly. So the concern for us should not be 86 or 87. Concern is it happening in a very rapid way? That should be the concern. Now, a lot of times we look at the headline numbers and we start worrying, but the devil is in the detail. You start looking at the underlying numbers where it's coming from. So somebody was quoting that, 30% of our outstandings are unhedged. As a headline, maybe that data is accurate. But if you really ask bankers who are actually doing this lending on an unhedged currencies in the market, they will say, yes, this was borrowed as an unhedged currency by a company where the repayment is coming after 2 years, plant is coming up on stream 2 years later, which will do exports. So technically, he has a hedged exposure. It's just that till the time the repayment comes, the exports would have started. Same way, this is not only startup, even an existing customer who's already an export-oriented unit, he's going for a doubling his capacity. He's taken an unhedged foreign currency with an understanding that as and when the repayment comes up, the exports will be there to hedge it. But at a point in time today, is there a loan outstanding in dollars? Yes. Is there a hedge against that? The answer is no. So sometimes I think we have to look at the detailed part of it. But having said that, I think the rupee dollar for an importer who is unhedged and doesn't have the ability to do the pass on, yes, that's a big risk. And to that extent, that risk management should be looked at it very, very carefully right now.
To Prashant, credit booms have typically always been followed by some concerns on asset quality, etc. Are you seeing any pockets of stress right now? MFI is something that people are talking about, small borrowers. Somehow also moving to other categories of loans, small loans.
I think so far we have not seen that risk moving from either the unsecured side or maybe on the MFI, moving to the secured asset. On both these things in a very timely manner. So I think the risk of moving these kind of, say, stress into any other sector seems unlikely. But at least in our own portfolio and what we are seeing otherwise, we are not seeing that stress moving into any other.
And on consumption to you again, Prashant sir, is it also linked to the fact that after all of these problems with, not problems, rather RBI regulations around banks have tightened those and the flow has reduced now? For people who used to borrow in those unsecured products, is that also a reason why consumption is slowing down?
No, if our consumption is based on over leverage by the population, then this is not good either for the customer or for the banking industry. But when we are saying in terms of the growth, the consumption is coming down, I would be saying the consumption was always in the similar manner. Somehow, because there was a different, I would be saying the behavior of the population has changed. From the saving, it was moving to the consumption. So I think it is very, very important to have those kind of guardrails around how much leverage the household can take. So I think it is reaching to that normalized levels. Okay? But fueling the consumption by giving the bank loan is not something which is good either for the economy, for the banking industry, or even for the individual customer.
Mr. Vaidyanathan, we have been talking about risks and areas of concerns, but are there any pockets of opportunities in retail lending that you want to talk about?
Before we come to opportunities, to the previous point, see, as a bank, we have very low risk appetite. We should have, because a good benchmark is never to cross 2%. A net NPA should never cross 1%. Okay, we operate to these benchmarks for a long period of time. So thin, so skin is very thin. Therefore, when we say that we have curtailed, all of us, including our bank, we have tightened a lot of norms, because so when we do that, of course, to an extent, it affects consumption, but it's a small component. Consumption is actually not driven only by credit. There are so many means. Okay, there is how the economy itself comes up, how many jobs are getting created. That affects consumption. How is the environment and the mood of the nation? All that affects consumption. How much confidence people have in their own future based on how the economic. So a lot of things are affecting consumption. Credit is one component of it. I think we should not, think of it as the only big item. And we have to be careful because end of the day we can't afford to have much NPA, and all banks have to have certain stiff benchmarks on that front. Now, with regard to your question was regarding
on opportunities.
Opportunities. Well, frankly, opportunities are in this country a lot. You think about it. Out of India's about 65 million MSMEs on the bureau, live customers who have borrowed as of today is only 9 million. And if you take Udyam registered MSMEs, Udyam, which is formally they've gone through a process and registered, that number is only about 30 million. And out of that also, only 30% have taken credit. So the point I'm trying to say is that I see as a very big opportunity. I see a startup as a big opportunity. I see rural as a big opportunity. So we should not, so really there is no hurry and there's no dearth. It's just a very big one. It's more important to be, safe and running it at a very steady asset quality actually. And I can't comment more on that because we're a silent period, but I will only talk all numbers as of the last quarter.
Okay. Mr. Dave, on a similar vein, on opportunities, HSBC, sorry, just got that approval to open more branches. That must be, after several years, and you call it wealth, I guess, instead of retail. So, what kind of opportunity are you seeing? Because this kind of expansion is not very common among foreign banks.
No, it is very uncommon, and that's why I guess it drew media attention also. But see, what has changed in India, let's say last 10 years or so, is the fact that earlier Mumbai, Ahmedabad, Delhi, Chennai, Bangalore, Calcutta at best would have most of the wealth of India, right? Now in the last 10 years, you go to places, Amritsar, Ludhiana, Surat, Rajkot, you will find there is significant amount of wealth there. And our assessment at least is that market needs a professional international institution to manage their wealth and show them the opportunities both locally and globally. So that's if you ask me for opportunities, I think that is one. The second is, for example, while we spoke about the currency, one of the good things about the currency is the net service exports, right? It's gone from $6, $7, $8 billion a month to $15, $16 billion a month. Some bank has to help these companies navigate around the world, right? This is an explosion. When you export $15, $16 billion, the amount of employment you do is much higher than $15, $16 billion of manufacturing goods. Because the nature of service exports is all, the services are prepared by human beings, right? Not by machines. So I think there is wonderful opportunity for all banks. Not just my bank, but all banks to help Indian small exporters, IT and ITES kind of in segments. Shoe could be a shoe exporter. You go to near Chennai, the entire shoe production of many companies globally is getting done there, right? So somebody has to help them navigate the world. How does that small exporter know what is the credit worthiness of the importer? How does he know that fellow will make payments, right? So that is another wonderful opportunity. The opportunity made available through regulations change, where if you want to invest more of your money outside, opening an account in GIFT where you can, you open a rupee account here, for a hard currency account there and invest even if nothing else in a US Treasury bill or something. So I think the pockets that we identify are largely linked to our internationalism, cross-border, wealth proposition, etc. And the branch is largely triangulated around lots of wealth created, lots of NRIs live either they or their families, and these are increasingly the new industry or startup or industrial cluster. So I hope we have picked the right cities, and I hope we'll do justice to the opportunities that those cities offer.
To Pranav, not on retail, but on corporate, everybody has been debating about whether the capex cycle is back. It will come back someday. Whether it's just government spending that's happening. How do you see, when in your conversations with large corporates, mid corporates, what is holding them back?
Yeah, so just coming to the earlier point on the opportunities. So I agree that there is immense opportunity for all the banks, irrespective of which segments they cater to, right from consumer to corporate, within corporate, the different segments of corporates. Many years back, I used to run SME and MSME, and I used to keep going long saying this is like the biggest opportunity, and I continue to say that even today it seems to be a biggest opportunity. So in this current environment, also when there is uncertainty and there is volatility, I think it also throws a lot of opportunities. So coming to your question on the corporate side, I would say right now there is a lot of uncertainty about the tariff barriers and those things. I think this is not something that happened last week. This has been in the discussion, in the campaigning that was happening 3 months back, 4 months back. Some of the corporates that we were dealing with, we actually worked very closely with them saying that one option is to react when it happens. The other is to be prepared with some kind of a plan. And in some cases, we actually help the clients to say, why don't we help you to do the nearshoring? So go closer to the territory, which seems to be the least impacted or least spoken about. So to that extent, you are insulated. If that is an opportunity, then I think the global banks have that edge where we can bring those opportunities. Coming to the private capex, to some extent, I would say partially that's true, partially it's not true. The reason I would say partially it's true, let's understand an entrepreneur or a corporate who's running the company also has to look at the viability of every business project or the capex that he puts up. If the capacity utilization is at 70%, 75%, there is no reason for the corporate to put up a capex unless he sees a certainty in the demand picking up for a predictable future. So to that extent, I think the corporates are doing lesser of capex, but that's also for the right reasons as well. The second is the corporate balance sheets have become pretty good. So the profitability is pretty high. So to that extent, they have the ability to realize that unlike the previous era, in case the opportunity comes up in a very fast manner, they have the ability to react quickly and get this capex done at an opportune time, rather than say, borrow when you can, so that the opportunity comes, at least you are ready. They are not in that phase exactly today. Some may be, some may not. Partially why I don't agree with that is, in our corporate base, we have seen a lot of customers who are in the export-oriented businesses. They have already begun 12, 18, 24 months back, nearshoring, putting up a plant closer to their client bases. So we have seen customers in the pharma sector putting up a plant in the US, closer to the US markets. We have seen auto ancillary guys putting up a plant in Mexico. So some of these companies have put up capex. It's just that it doesn't show up onshore, it shows offshore. So in this data, it doesn't come. Which is why in the last interview I did with some editor, I mentioned the best way to know exactly how much is the capex, take the ROC data, draw down the financial statements of these companies, look at their fixed asset blocks. It has gone up. And especially on sectors which are export oriented and they are geographically diversified across the world, you will see the capex has actually happened by them, but not only in India. Because that's the way they have made the resilience plan for their businesses or their corporates.
Okay. To Mr. Vaidyanathan and to Prashant sir, on deposits, is the worst of the crisis that we saw, and I'm sure it's cyclical that you have seen it earlier also, is the worst behind us, and are you seeing more deposits flow into the banking industry?
No, at least my view is that on the deposit side, if we are seeing the banking industry deposit is in the range of 10 to 11%. If we are expecting like it will go to 14, 15%, I don't think so. Because there are fundamental reasons like why the deposit growth in the banking industry has come to this level. There has been a huge efficiency on the government side, which was the biggest supplier of the deposit in the banking industry. Today, the government would be crediting a account in the morning, and by the end of the day, it would be reaching to the thousands of beneficiaries, which I have seen used to take 3 to 6 months in the channels. Similarly, the corporates have also become very efficient. Okay. They don't see like the money would be lying in the current account for a very, very long time. Any sales, any surplus money is immediately credited to their cash credit account. So huge efficiency into the system. You are having a asset classes which gives better return than the banks. And I think we should not aim like we should not have those asset classes. I think it would not be good for the country. I think the customer should have a choice. So I think we need to live with this reality where the deposit growth in the banking industry would be in this range only. We just need to think in terms of how we need to use this deposit for which sector, for demand coming from which kind of customer. If the banks continue to lend to very large corporate infrastructure financing, I think it is going to be change. Because if the money is moving to like the mutual funds, pension funds and others, we need to see how we can develop the bond market to take care of the need of the large corporate and the infrastructure. So I think there has to be a change, and I would also think that maybe over a period of time, the whole focus on the credit deposit ratio would also undergo a change. Why the entire credit has to be supported only by deposit? It can also be supported by borrowings. So I think gradually things would change, but I don't expect that deposit growth would increase in a bigger way.
Mr. Medhanathan.
I think he said it at all, but basically, eventually, credit has to be supported by deposits. Otherwise, eventually, there will be a systemic imbalance. So to that extent, that approach is right. But I think the overall liquidity pool, I think, depending on the monetary policy, I think the regulator will look at it. And depending on liquidity in the system is what this overall system is going to grow. Currently, within that system, money is moving to different players depending on the quality of service, quality of products, interest rates, technology, quality of app. These are the various factors on the basis of which money is moving around. At least that's what we are seeing. And we are currently beneficiaries of it. So I'm not complaining in any way. But why are you laughing, man? Okay, it's true actually. But, we're in silent period, so I'll wait for the numbers to come out, yeah.
But then are you concerned about slowing credit also? Because, if the economic growth slows down, that could also lead to slowdown in the credit side. So, is that a concern?
Just get a question.
I'm saying that while you're doing fine on deposits, are you concerned over slowing credit growth? Because if the economy slows down, then eventually credit would also...
See, no, wait. It's a circular logic. But we should not think that it's only credit that's growing the economy. I told you, economy...
I'm saying the other way around. I'm saying the slowing economy would lead to slowdown in credit because fewer people would borrow.
No, I don't think so. See, the credit demand, I'm telling you, you have to trust me on this, that there is no shortage of demand. Okay, it is our ability to meet it, depending on our capital capabilities. How much capital do we have? You can grow only up to the extent of capital we have. The nation's all capital of all banks put together is about 25 lakh crores today. So on that 25 lakh crores at a particular leverage, you can lend only that much amount of money. So how much capital we have, how much you can lend safely. Just because credit opportunity, you can go and gorge at it. You'll pay a price. I told you, your gross NPA, net NPA credit cost has to stay within a particular tight band. So those are the constraints that and discipline you got to opportunity at all. I mean, opportunity is big. You touch any segment, there is opportunity. There is no shortage of opportunity. In fact, corporates, of course, have stopped or have reduced their borrowing because they have ECB, they have alternative means of raising it. The cash generation is very strong these days because of the nature of the businesses, at least post-COVID. Corporate demand is low, but rest, agri, MSME, rural, semi-urban, name it, opportunities, no short at all.
So, suppose RBI tomorrow lifts those restrictions on unsecured lending that it put in December 2023. Because there is no dearth of demand, you think banks will again go all bonkers?
I don't think so. We should, I think people are responsible players at least to see the overall systemic asset quality today. So, honestly, I can't call out one bank which is at this point of time who are irresponsible or anything like that. So I would imagine that therefore people are responsible. The data has become much more available. Technology is so much more available. so many sources of information is there. So we should hone them, and as I said before, we should expand the base. We should definitely not look to lend to the same parties because everybody is lending to the same party. We should expand, and this is one of the biggest agendas in front of the banking industry. How do we expand the banking system to more segments?
You want to add something? We are almost out of time, but before that, just one quick question to all of you. On your budget expectations, especially say if you were to be FM for a day, what are the few measures that you would take to spur consumption and any other measures, of course? Quickly, with all of you.
No, I mean, I'm sure it's a tough job right now because on the one hand, there is a forward-looking commitment to fiscal consolidation. On the other hand, the more you fiscally consolidate, the less money you pump into the economy. CapEx, we spoke about the fact that CapEx is largely been government-led. So, you cannot envy the finance minister, but if there is, I think just do something to really cheer up the mood music. Okay, I think something has changed in the last few months, and I think part of it is real, but part of it is also just mood and sentiment and things and this plays a role, right? Consumer confidence and all those things. So I'll leave it to the FM to talk about whatever taxations and GST and whatever else that they have in their, but certainly it should be a budget which just makes everyone feel better, that better days or good days are back again, that kind of a thing.
Pranav?
Similar, the job is quite tough. The constraints are way too many. And the variables or the things that could keep changing pretty fast is also going to make it a more difficult job. But if you ask me, the best way I would look at it is, first let's figure out what are the real issues which can bring up the mood. So clearly consumption is one. So there could be various ways of attaching the drivers for that. But it has to be led somewhere where the consumption goes up. And the related point to that is consumption is also linked to a disposable income, the certainty of jobs, and hence creating job opportunities is important and it's critical. We should be very clear that we have an advantage on the demographic of working population. That should pay the dividend. There is no questions about it. In which case, any industries which is labor-oriented, manpower-oriented, workforce-oriented, whether blue-collared, white-collared service sectors or whether it is skilled, low-skilled, semi-skilled, we should go all out to address those segments. And yes, there is a fiscal consolidation, so to that extent, the opportunities will be limited. But in that case, we have to be a little more innovative in terms of repurposing some of the expenses that we have done. Like a PLI that we have done is a good success in the electronics or those segment. Recently, we've done PLI also for the electric vehicles, which they are saying that they are now confident that they can sustain it without the subsidies. Those pools can be used for another segment that we can bring up. Exports, we are focused on exports PLI incentives. We could innovatively whether we can do a PLI for an import substitution. If there are any pockets of industries where we can bring down the imports and create a plant or a manufacturing capacity in India, and currently we may not be viable because of the difference in the cost of goods importing versus manufacturing, and that's a fit case for a PLI scheme as well, which is no different than an export, which is make it more competitive, whether to sell or competitive to buy or produce locally. So some of those things I would say, but clearly employment, disposable income and consumption should be there, the mood as well, and create that positivity that we are going in the right direction.
We'll go to Mr. Vaidyanathan first. He seems really keen on this. I'm saying we'll go to Mr. Vaidyanathan first. He seems really keen on this.
No, not at all. In fact, they want to be FMs. Let them be. No, not at all. I'll keep it very quick since they said a lot of points. I'd actually say that all the things they said, apart from that, make it a progressive tax code for corporates. Some amount of income, even at business level, all small entrepreneurs, some amount of income should come tax-free. So encourage all our next generation to get into business. There's something about zero tax, joy about zero tax, saying that, look, if you make a crore of income in business, no tax. And then, of course, after that, everybody pays tax. So I meant like a progressive, like personal income tax is progressive tax. Corporate can be progressive tax. I think you can spur a new generation to go into business rather than seeking employment.
Prashant sir.
I think you were asking like even a FM for a day. Yes. I think no such aspiration even for a day. But fundamentally, I think if we see in terms of a long-term solutions, I'm not talking of an immediate part, two key things in terms of employment opportunities and the employability of our demography. Because I think this is something which has to be solved over a period of time.
Thank you, everyone. We'll just take a couple of audience questions, if there are any. Are there any audience questions? I don't see any. Great. Everybody is very clear. Thank you so much. Thank you, everyone.
Shannon, please do the honors and honor our power panelists. Mr. Vedyanathan, I know you have a commitment to rush to, like always, but can you more seconds and take this plant on behalf of all of us? And ladies and gentlemen, I could hear some claps midway through the panel, but now is your time to applaud. Come on. The CEO panel, the ones who say it like it is. Thank you so much, gentlemen, for joining us here this evening. This moment is a must capture, and clearly the CEO panel has also attracted paparazzi. Thank you once again. Wow. Absolutely love the vibe and the energy in the room. Yes, you're right, we're inching towards the award ceremony, but before that we have two absolute stalwarts who are going to address us. These are clearly two gentlemen, one after the other, of course, who will be sharing their insights with us, things that we're really looking forward to. I must invite all of you. I can see all of you taking selfies, photos, videos. When you're uploading them on your social media platform, please use hashtag Mint BFSI 2025 so that we know where to find you. As we all know, the Securities and the Exchange Board of India plays a very pivotal role in ensuring integrity, and the stability of our capital markets. Our next speaker is here to talk to us about the current developments so that we're up to date before we leave the room this evening. Also share with us some of the regulatory trends for 2025. And of course, the one thing we're all so interested in, which is SEBI's future outlook. He's the whole-time member of SEBI, and I'm just going to wait a couple of seconds while we clear the stage. Leave it there for the next conversation. But at the moment, ladies and gentlemen, please join me in welcoming with a very warm round of applause, Mr. Anant Narayan Ji, whole-time member of SEBI.
Good evening, everybody. I hope I'm audible. I understand you're running about 30 minutes late. My job is to put you all to sleep so that you can enjoy the last session after this one as a boring regulator. I thank Mint for giving me the opportunity to address this August gathering. I thought I would use this opportunity to reflect on the current trends and some of the opportunities and challenges and the way forward around capital formation in the economy. First, I will look back at the very positive story of all-round flows, both from investors and now even from issuers, trends that the ecosystem should recognize and celebrate. Second, I will argue that there is no room for any complacency, that opportunities for sustained capital formation still abound, as do challenges. The whole ecosystem, all of us put together, have much to do to maintain and grow the trust and faith of the ecosystem. Finally, I will present SEBI's approach to fostering trust while growing the ecosystem, as exemplified in recent examples around FPIs, alternate investment funds, and equity derivatives. I will then suggest some takeaways for the future. A key positive feature of the last few years, particularly after COVID-19, has been the rise of the domestic investor. While we talk of mutual fund flows a lot, what we don't realize is that the flows into AIFs, alternate investment funds, and PMSs, portfolio management schemes, have also risen quite sharply. Let's start with the investments into domestic mutual funds. During the 6 years between fiscal year 15 and fiscal year 20, net risk-oriented investor flows into mutual fund schemes, which I define here as flows into equity-oriented schemes and into hybrid schemes excluding arbitrage funds and into equity index funds and ETFs, averaged around 1.4 lakh crores per year. This was between FY15 and FY20. After COVID-19, during the 3 years between FY22 and FY24, this number rose sharply to 3.2 lakh crores on average a year. So more than double during that particular year, these 3 years. In the current year, fiscal year 25, for the 9 months until December 2024, this number has already hit a record of INR 4.8 lakh crores. Note that this number is over 30% of the incremental time deposits booked by banks during the same period. So in the 9 months itself, we've hit a record for the year. Of course, we could have negative flows in the next quarter, but the fact is, this is a record period of flows for this FY25. On the supply side of the equation, between FY22 and 2024, the supply of fresh paper by listed companies, that is, issuances excluding offer for sales by promoters or by other shareholders, averaged around 1.5 lakh crores per year. I have in the past expressed apprehensions that this supply of paper may not be keeping pace with the rise in demand for paper, suggesting the risk of asset inflation and suboptimal capital formation. I'm happy to note, however, that during the current fiscal year FY25 till December, supply of fresh paper by companies, excluding OFS, has already risen to an all-time high of rupees 2.9 lakh crores. Across all sources, the gap between demand and supply has narrowed this year, even as both sets of numbers, the demand as well as the supply for paper, has actually risen quite a bit. For capital markets seeking capital formation, this is indeed the best possible outcome, rising demand for and rising fresh supply of securities. Alongside mutual funds, there has been a significant rise of flows into alternate investment funds over the years, something that is perhaps less appreciated. Remember, this is supposed to be an over-regulated set of people. As of September 2024, the net funds raised by AIFs from investors crossed 5 lakh crores with a creditable increase of 1.1 lakh crores on a year-on-year basis. That's a 29% increase in the funds raised from large investors. The year-on-year change crossed 1 lakh crore for the first time during that period. Around 65% of the net funds raised by AIFs are from domestic investors. Similarly, the total commitments made by investors into AIFs have risen to 12.4 lakh crores as of September 2024, with a rise of rupees 2.9 lakh crores or 30% on a year-on-year basis. Somewhat comparable, you will note, to the flows, incremental flows into the mutual funds during that period. Commitments have increased by about 31% on a compounded annual growth rate basis for the past 5 years. We don't seem to realize this, but actually flows into mutual funds, particularly in terms of commitments, have risen to levels comparable to mutual funds at this point in time. Let me now turn to the opportunities and challenges going forward. The trends in demand and supply is certainly remarkable and deserves celebration, and every stakeholder in the ecosystem deserves their share of praise for what is coming through. However, there is simply no room for any complacency. First, opportunities to grow the pot still abound. While we have over 13 crore unique investors in the SEBI ecosystem today, a number that has tripled from 4.4 crores, just 4.4 crores 5 years ago, CBDT data suggests that over 60 crore Indians have linked their PAN number with Aadhaar. That's the catchment area potentially for the entire securities market ecosystem. On the flip side, there are challenges as well. We have a fundamental responsibility to preserve and grow the trust of the rising number of investors in the capital markets ecosystem. Any egregious type 1 errors, such as governance failures, technology failures, market manipulation, or fraud, can endanger trust and kill the goose that's laying the golden eggs. At the same time, and I've said this to Mr. Damodaran here, one of our mentors in many ways of the SEBI ecosystem, we're also conscious that even as we take steps collectively to prevent or rapidly address type 1 errors, we must ensure that regulations do not come in the way of capital formation. That would constitute a type 2 error. In statistics, it is not possible to minimize type 1 and type 2 errors simultaneously. I suggest, however, that in our regulatory approach, if we apply our minds collectively and constructively, we can find win-win solutions where we minimize both type 1 and type 2 errors. I will try and present some practical examples of this from our recent experiences in FPIs, in AIFs, and in equity derivatives. Let me turn to FPIs. Since the time that we opened our country to foreign portfolio flows 3 decades ago, we've had periodic instances of concerns being raised around the identity of investors behind some FIIs, FPIs, P-notes, and now overseas derivative instruments. If, in fact, there was circumvention of SEBI's stipulations around minimum public shareholding or the stipulations around substantial acquisitions of shares and takeovers, that would indeed constitute a type 1 error. One way to detect this would have been to stipulate that every foreign investor must disclose all details of their ownership, control, and economic interest to the last cent on a look-through basis. However, instituting such a requirement across all FPIs would have led to large type 2 errors. Giving full details of all investors can be extremely onerous for even legitimate investment managers and funds of international jurisdictions where structures such as omnibus structures exist. In August 2023, with the approval of the SEBI board, we instead introduced a focused and clinical risk-based approach to mandating extensive disclosures. In respect of possible MPS and SAST circumvention, first, only FPIs that met a concentration criteria of more than 50% of their AUM invested in a single corporate group were considered for additional disclosures. Even here, no additional data was sought from funds such as sovereign wealth funds, public retail funds, and exchange-traded funds, where there was regulatory comfort around their identity on a trust but verify basis. Others, however, were required to provide granular disclosures on a look-through basis. Similarly, there was a size criteria for granular disclosures by FPIs with AUM of over 25,000 crores. This was to guard against the potential circumvention of Press Note 3 stipulations by FPIs with large Indian equity portfolios, with the potential to disrupt orderly functioning of Indian securities markets by their actions. Once again, some funds, such as sovereign wealth funds, were exempted from additional disclosures based on objective and transparent trust but verify considerations. Beyond FPIs, these requirements have now been extended to ODI, which is the erstwhile P notes as well. Now the question is, how has this approach performed on type 1 and type 2 errors? While history will tell us what the answer is, let me try and offer you at least our immediate perspective. First, the specific and targeted FPIs that were required to provide additional disclosures but were unable to do so had to exit the country by September 9th, 2024 to avoid stringent penalties. Note that FPI flows were a significant net positive during the period Jan 2024 and September 2024. We can also confirm that notwithstanding some unnecessary and baseless speculation from some quarters, any FPI outflows after September 2024 cannot be attributed to the circular. Finally, we can also confirm that to date, no FPIs have been required to cut positions or exit under the 25,000 crore size criteria, which is to prevent circumvention of PN3 stipulations. I have to compliment the ecosystem of custodians, DDPs, FPIs, depositories, and other stakeholders who work closely with SEBI to ensure that we minimize type 1 and type 2 errors through all of this. I think this has gone a long way in strengthening the trust in the ecosystem without coming in the way of legitimate investments. In fact, the feedback from FPI is that they actually believe the system has become stronger and more trustworthy after these stipulations have come in. And it's not been at the cost of actual legitimate investments coming into the country. Separately, through 2024, alongside this implementation, SEBI has also worked closely with all stakeholders to bring about additional ease of doing business for FPIs. Thanks to our collective efforts, processes have been improved so that, like domestic investors, now access their funds on the day of settlement itself, a significant improvement over the past. This change we brought about in September 2024. A common and transparent SOP for FPI registration has been put in place, and the registration process has been and will continue to be simplified. Depositories have built trackers allowing us to have an overview of pending registrations. SEBI now has an FPI outreach cell that has interacted with over 1,000 FPIs in this financial year to date, including to address their specific problems. I'm very happy to report that we are seeing around, on average, 130 new FPI registrations per month in FY25 so far, nearly twice the number of FY24. The numbers have almost doubled of the FPI registrations. Let me now turn to AIFs. We've already noted that this industry is now growing significantly, and the annual rise in AIF investment commitments is of a similar order of magnitude as the growth in the mutual fund ecosystem. You may recall that around 2 years ago, SEBI first highlighted a significant type 1 error surrounding AIFs. We had found that a significant chunk of AIFs appeared to be structured to circumvent existing financial sector regulations, including RBI regulations, FEMA regulations, and IBC stipulations. Through 2024, our approach in collaboration with industry was to address this concern, which effectively translate while ensuring that we minimized any collateral damage of type 2 errors. I'm very happy to report that we have largely addressed this issue. In fact, over the last 6 months, we have been pivoting to trying to leverage the gains of trust that we have had to improve ease of doing business for the overall ecosystem. A framework is now in place, which is a solution that we came out with, which effectively translate into a clear and specific set of do's and don'ts that AIF investment managers must follow to guard against any such circumvention. These do's and don'ts have been put together by the industry itself via the Standards Forum for AIFs in consultation with SEBI. They have been designed to be focused and targeted and as simple as possible. As an example, AIFs with significantly large or even one single investor are required to adhere to the simple principle of ensuring that the investor is not prohibited from making the ultimate investment directly, which is a person who is not allowed to make an investment directly should not be doing so via the AIF. A simple principle if you have large investors in the fund. In addition, both the assets of AIFs and the units of investors are now largely in dematerialized form. It's a unique ecosystem, unique to in the world, offers a significant benefit to investors while improving regulatory visibility all around. With the contours of this solution now in place to address the type 1 error alluded to above, the resulting increase in all-round trust has allowed all of us to pivot towards taking steps to improve ease of doing business. Tranching, a route that was in the past misused by some AIFs to circumvent RBI regulations, has now been allowed for certain sets of investors. AIFs have also been allowed to pledge their equity investments in infrastructure sector so that their investee companies can raise debt. AIFs have also been given significant flexibility to deal with unliquidated investments beyond the expiry of the fund. In addition, there is now a framework for erstwhile VCFs, which were in violation of regulations with unliquidated investments, to migrate to the AIF regime seamlessly. The process for accreditation of investors has also been considerably simplified. I believe that popularizing the concept of accredited investors can further contribute to the growth of the AIF and angel fund ecosystem. In summary, I want to emphasize that while 2 years ago we were talking about AIFs being a vehicle for circumvention of existing regulations, that issue has now been resolved the whole of last year, we believe. And since then, leveraging on that, we are actually building measures or taking measures to improve the ease of doing business for. So the pivot has changed from tackling type 1 errors to actually tackling type 2 errors now. Finally, a quick word on derivatives, FNO and the market infrastructure institutions. I have recently spoken of SEBI's approach towards equity derivatives, so I will not elaborate on this subject today. Suffice to say that I believe SEBI's approach towards equity FNO exemplifies our approach to try and minimize both type errors. There was a potential type 1 risk here in the form of consistent and egregious small investor losses and the potential for structural risk vulnerabilities in the ecosystem. Our extensive and detailed consultations helped identify the main root cause issue, clinically and specifically, as specifically egregious overtrading in index options on expiry day. You know, we were not painting the entire FNO space with one brush. We were only focusing on the specific issue of index options trading on expiry day, which is what we found was egregious. In October 2024, we took a series of 6 steps that were largely designed to address this specific issue surgically without painting all of FNO with one broad brush. Even as we judge the impact of these steps over the next few months, based on the trust that we now have in the ecosystem, we are looking at ways to grow the FNO ecosystem so that it contributes to price discovery, market depth, risk management, and ultimately to capital formation. Make no mistake, SEBI believes futures and options are essential for sustained capital formation in this country. We will look to improve the risk metrics in FNO and consider both tactical and structural steps to reduce the risk and fear of any manipulation across cash and derivative markets. A quick side note on this issue. As our recent orders have demonstrated, between exchanges and SEBI, we have strong surveillance mechanisms. While we can never say that we are perfect, we are watching and learning all the time. We will continue to invest in surveillance to safeguard trust in the ecosystem. Another side note, it is worth noting here that our MIIs, which are the exchanges, clearing corporations, and depositories, are the first-line regulators charged with ensuring investor protection and market integrity. Amongst other things, they are required to ensure adequate disclosures by issuers, conduct appropriate surveillance to deliver a free and fair market bereft of unfair trading practices, manage risks and operations to deliver smooth clearing and settlements, monitor the conduct of brokers and other intermediaries, and ensure that market technology platforms and ledgers are fair, secure, reliable, and resilient. Indian MIIs have a unique operating model in that they are empowered by law to regulate their own paying clients, such as listed companies, trading members, clearing members, and depository participants. They are required to primarily focus on the investing public as a public utility while ensuring the integrity of capital markets. At the same time, they are also commercial entities in competition with each other, and the larger MIIs in equity markets now enjoy high operating margins with profit before tax to income margins well in excess of 50%. To preserve and grow the trust in the ecosystem, it is crucial that MIIs, as is required by law today, continue to give primacy to ensure technology and operational resilience, risk management, and ensuring compliance in investor interest over business considerations. In a sense, when questions around areas such as F&O and SME IPOs come up, MIIs should be the ones taking the lead in finding appropriate solutions that are in the interest of the investing ecosystem over their own commercial considerations. We have collectively taken some steps to ensure this, including closely with the public interest directors of the boards of MIIs and ensuring that crucial key management personnel of the MII have a dual reporting to both the MD as well as the relevant board committees. Further steps may be needed to strengthen the framework of governance in MIIs and ensuring that they're the first-line regulators first. We've also proposed some possible ways to strengthen the independence of clearing corporation and ensure their continued focus on risk management. I had promised to put you to sleep. I now promise to wake you up with this very short announcement that we have now come to the conclusion. Our funds ecosystem has grown significantly in recent times with substantial growth in both issuances and investments. While we may have specific issues and concerns at the overall level, we must acknowledge that something good is indeed underway. There are opportunities and challenges ahead. One key imperative is to preserve and strengthen the trust in the ecosystem. We all know that the financial markets ecosystem entirely relies on trust. Type 1 errors such as governance failures, technology failures, market manipulation, or fraud can endanger trust and kill the goose that's laying the golden eggs. We must collectively continue to guard against this. This is too big a risk to be left to regulators alone. We are also conscious of type 2 errors, where in our zeal to minimize type 1 errors, we could create an ecosystem that comes in the way of legitimate and desirable capital formation. For our part in SEBI, I can promise you that we will look at both risks very closely and leverage extensive consultation to try and minimize both together. The topical examples that I've tried to provide today around recent events in FPI, AIF, and F&O hopefully stand testimony to this approach. In turn, I ask that all stakeholders must strive to be trusted advisors who focus on both errors as well equally. On type 1 errors, when you see something, please say something. On removing type 2 errors, when you make your suggestions, please think about how the risks of any resultant type 1 errors can be mitigated. Here's to us working collectively to ensure sustained capital formation in our country. Thank you once again to Mint for this opportunity and for your patience.
Thank you so much, Mr. Nayan. Ravi, may I please request you to join me on stage and present a token of our gratitude. Thank you so much for joining us, for talking to us. You certainly didn't put us to sleep, rather you awakened us this evening. everybody. A hearty round of applause for Mr. Anant Narayan. Thank you, sir. For all those of you who've joined us recently, I want to introduce you to the AI bot that's brought to us by IntraBot on your WhatsApp. When you registered for the summit today, you would have received a WhatsApp message from Mint BFSI Summit. Click on join now. You can alternatively even scan the QR codes that are on the black and white 10 cards on each one of your tables, and you can unlock an opportunity to network and to collaborate and to partner with people here, with like-minded people, I must say, during the strategic breaks. Well, it's time for our next segment. We're very fortunate, like Mr. Narayan said, to have with us a towering figure in India's financial regulatory landscape, someone whose leadership has shaped the very fabric of our capital markets. In this fireside chat, this champion will share his vast experience, deep insights on topics ranging from market evolution to regulatory changes and even corporate governances, and of course the future of financial markets in India. I'd like to invite Ravi Krishnan, Editor-in-Chief of Mint, on stage to moderate this conversation. And ladies and gentlemen, with a wholesome round of applause, let's welcome Chairperson of Excellence Enablers and former Chairman of SEBI, Mr. M. Damodaran.
It's my privilege to welcome Mr. M. Damodaran. Zinnia has given a good introduction to this. I would like to add, most of you know him, of course, but he was the government's crisis man when UTI had to be rescued, then IDBI. Following that, of course, he was chairman of SEBI. During his time, there were many momentous decisions that were taken. And after that, he's had a career as a director in the board of some of the bluest of blue chip companies in India. And of course, he's founder of Excellence Enablers. He's a corporate governance champion now. And dare I say, a writer of trenchant newsletters. So, Mr. Damodaran, I'd like to take off from where Mr. Narayan just left, where he was talking about, retaining the trust of investors. Now, over the last 3 years, we have seen demat accounts have surged, and now, almost a fifth of the nation, in terms of retail investors, a number of people, they are all participating in the stock market. Now, if you were to advise, the current SEBI dispensation, and indeed Mr. Narayan, what do you think they should do to ensure that the trust of the fifth of the country's public is intact?
It would be a very brave person who would advise Anant on these matters. And over the last 20-25 minutes, I think there was adequate evidence adduced why you can't advise somebody who's so much on top of his game. The markets have grown in complexity, in size. Number of investors have increased, and I think he laid out all of that. Number of issuers have increased, and therefore the supply is also improved. Complexities exist. There are external factors not related to India, but impacting on the Indian markets. All of that is happening. If you rewind to maybe a decade plus, many of these complexities did not exist. I think, and I say this as a former SEBI official, SEBI is not getting credit for the kind of work that it's doing. If they get 9 things right out of 10, it's only the 10th that gets focused. The 9, I think that business about, the good being interred and the evil living after them, that phenomenon. Or to give another example, that when dog bites man, it's not news. When man bites dog, it's news. So you pick out that one example and do that. I think they're doing a very good job. They don't need advice. What they need is, and I say this with some amount of trepidation, but I will say it nevertheless, the advantage of being much older than everyone else in this room is that I can speak without a mental filter. And I say this with some trepidation. In the excitement to do more good things, somewhere I think regulatory impact assessment should get factored into the decision-making process. That's all that I wish to say. He rightly identified trust as important, because I think we have moved to trust but verify. I had said many years ago that we need to make that move from distrust and crucify to trust but verify. And I think that has been done.
So how do you suggest that we go about this regulatory impact assessment? How can, regulators, because not just SEBI, but even with other regulators, especially now when we have technology and a lot of innovation happening, how should regulatory officials thread the needle between not, being excessively zealous but at the same time, ensuring that there is protection of investors and consumers?
I think one is doing the right things. The other is telling a disbelieving audience, at least one that has been disbelieving for several years, that you are doing the right things. Perception is as important as reality. And I think you can't expect a regulator, and I've said this times without number, what is SEBI doing in such and such case? I said SEBI does not come onto the streets and regulate in full public view. There must be something happening there that you and I don't know about. Because it's not that they are not seized of the problems, they're not seized of the issues that arise in the marketplace. They're acting on it, but they're not going to come out of the road and explain on a day-by-day basis. They don't have spokesmen of the kind that central investigative agencies have, that on a daily basis you explain what is happening. That's not SEBI's job. I would be disappointed if SEBI did anything that kind. I believe what SEBI needs to do more of is a very calibrated communication package that does not seem to be advertising its own work and at the same time getting the message across, look, your interests are safe with us, we know what your issues are, and we're looking at it.
So you're saying, like justice, like SEBI, the wheels of SEBI also grind slowly, but they grind fine.
I don't say they grind slowly, they don't grind visibly. When they finally grind and the final order comes out, then you realize what they have done. But that order is the product of a lot of work, of a lot of, let's say, investigation going on, surveillance, for example, and that translates to the enforcement action. So you won't see it happening. The process is not visible, and thank God for that.
You have been a champion of corporate governance. I would like to ask you this: when you look at what's going on in some companies, I'll take names here, Dish TV, Z, Religare, etc. We wonder as observers, whether the shareholders are the company's real owners. They are unable to hold AGMs and EGMs. It appears that the majority of non-promoter shareholders, want the company to be run by a new promoter. However, the incumbent promoter is not keen to move away. These companies were also the subject of your recent newsletter.
Yes.
So what I want to ask is, what more can regulatory bodies do? Nice of shareholders being the real owners of companies, that is actually enforced.
I think we shouldn't look at regulators to do this job. If somebody has actually invested his or her money in a company, the primary responsibility of ensuring that that money is put to good use is that of the shareholder. Now you are saying AGMs did not take place. It's true, AGMs did not take place. Accounts were not finalized. Auditors resigned in a few cases. All of this happened. Luckily, these are the exceptions, but these are the ones that get spoken about. there are several thousand companies where work goes on in a monotonous fashion. All these boxes get ticked. Now, what should shareholders do? Shareholders should demand of the board of directors that, look, you guys are sitting there in a representative capacity. Tell us what you are doing to protect our interest. They don't have to go to the regulator for that. Yes, if the board is not doing anything at all, bring it to the notice of the regulator. But today you are seeing more evidence, and that's a happy sign, of directors individually and boards as a collective standing up to the promoters and say, we will not have any of this. If they are unable to get any change in the boardroom, then they put in the papers and leave. And SEBI has rightly mandated that when you leave the board, tell us why you're leaving. Don't say you're leaving for personal reasons. Even then, some people write personal reasons. I know one director who, on the verge of leaving, she had been threatened by the promoters that if you continue opposing our proposals, you could come to grief. And so, in fear more than anything else, she put in her papers. But she spoke to me 2 days before that. Somebody had known for years. I said, why didn't you write all of this in your resignation letter? I'm not for a moment suggesting you stay in the board and fight, because clearly you're one against several, and you've noticed that it doesn't work. So there's more effect in your leaving the board, but leaving it in a manner which tells the whole world why you left it. But she still wrote personal reasons, and when I asked her, why did you write personal reasons? She said, my life and liberty are personal reasons. So therefore, I couldn't push it beyond a point. Yes, they are personal reasons, right? But directors are pushing back. That's the good news.
But from your experience, you yourself have been an independent director and was interacting with companies and such people. How difficult is it to stand up to promoters of a company, as an independent director?
Okay, I don't know whether disappoint is the right word, but let me disappoint you by what I'm about to say. I've had far less problem with promoter directors than with so-called professional directors. People who were appointed to senior positions, they reached those positions, believed that they owned the place, they owned the company, and nobody else counted. I don't want to take names, but if you look at some of the large companies where you had this larger than life chairpersons or managing directors, you get what I'm saying. Promoters are a bunch of misunderstood people. There are bad elements. I'm not for a moment saying they're all good elements. But I have come across promoters of large companies who actually reach out to the directors, and I'm not talking even about today's promoters. I'll take a name. Brij Mohan Lal Munjal, no longer with us, who died in his 90s. I had the privilege of serving on his board. He would not clear a proposal on the board if the management brought it, unless he looked around, saw whether the other directors, the independents, were happy, and he occasionally reached out to some of us. What do you think about this proposal? And you had the freedom to argue against it. It didn't matter that his son was the managing director. It didn't matter. So there was freedom there, but I've seen, I want to distinguish between professional-led companies and professionally-led companies. These are not the same thing. There is a difference.
So in general, would you say that corporate governance level in Indian companies have improved with more active participation by independent directors?
Yes, I think directors are pushing back when they see something wrong. And I think management and the controlling shareholder, except one controlling shareholder, which is the government of India, controlling shareholders understand that there could be embarrassment if one or two directors actually said, sorry, we don't want any part of this, and leave. As for the government of India, I've always maintained that having enacted the provisions in law, they are among the biggest violators of the provisions that they themselves, and I can give you hundreds of examples, don't want to delay you here.
Over the years, many people also credit proxy advisory firms with improving corporate governance at companies. What is your view on that?
No, I think they have a role, but I think the role is exaggerated. A lot of people look at them as this great white hope for the investors. They are not. They do point out some things that are wrong in resolutions that are being brought. But look at the way it operates, and I'm sure people in this room know this. Their recommendations on resolutions that are going to the AGMs or the EGMs come a couple of days or maybe 3 days before the AGM or the EGM. When this goes to the companies who are shareholders and who have to vote on that, the people that have to vote based on the proxy advisory firm's recommendations do not apply their mind. They say the proxy firm has recommended, let's go ahead and vote on this basis. Why? Because if you want to disagree with what a proxy advisory firm has said, you have to then seek approval in your own company for why you're disagreeing. Much easier thing is to agree with what the proxy advisory firm says. So you have highly theoretical recommendations which are actually no good. See, these are matters where you got to look at the context in which a resolution is coming. You can't oppose because it doesn't meet some of your requirements. Somebody has 70% attendance, doesn't have 75%. You promptly say, no, you should vote against this guy. Look at the previous 3 years, does he have 100% the previous 3 years? There may be good reasons why he has 70% attendance, but there's no time to ask him that. I would not give them much importance, but boards need to look at what proxy advisory firms are saying, and companies that act on the recommendations need to apply their minds rather than outsource the thinking to the proxy advisory firms.
Do you think they are becoming a little bit too powerful and they need to be regulated?
In fact, in the United States, there is no regulation. I spoke to a professor in the US who had served briefly in the SEC, and I asked, what are the regulations? He said, no, we practice freedom of speech. Anyone can say whatever he wants. In India, SEBI has made an attempt to include them in the analyst regulations. It's not been 100% kind of a situation. They appointed a committee under Sandeep Parekh. There were some recommendations. Based on that, they've been included in the analyst regulations. Long way to go. But I think what's important is, for proxy advisory firms, some amount of self-regulation.
Would you like to elaborate on that? What exactly they can do?
I think what they need to do is to look at, themselves. What are they doing? Are they doing enough to justify their place in the ecosystem? And I'm putting it very bluntly. Now, we heard Anand said this, several others have said this also. Whatever you do, you must ensure that the ease of conducting business is not disrupted or obstructed. You do what you like to see it's conducted properly. Somewhere along the way, proxies need to ask themselves whether their regulations, while they may tick boxes, and all of them have principles on the basis of which they make the recommendations, how are they playing out in space? And then, are you giving enough of an opportunity to that company on whose resolutions you comment to respond? It's just 2 days' time, 3 days. By the time you send it, the recommendations have gone out to the investing companies.
On a related note, I wanted to ask you about shareholder activism. Yes. In the developed world, it is feared, but it is also celebrated and sometimes, most times, seen as a win-win for employees and shareholders. But in India, it is almost a taboo topic. We seem to abhor, shareholder activism and hostile takeovers. And do you agree with this view? We haven't seen many.
I think in India there have been, the cases have been few and far between, cases of shareholder activism by institutional shareholders, pushing back on some things that they did not like. Retail investors, unfortunately, cannot organize themselves. But we did a study on voting patterns over the last 5 years and discovered that there were, in some cases, a very interesting phenomena where Retail investors in large numbers voted against the resolution, and institutions voted along with the management and got the resolution passed. We've seen instances of that also. But activism is good. We need activism, and we've seen, I'll take 2 minutes to explain to you one case that I was personally involved in the Unit Trust of India, and I'm talking about more than 20 years ago, where the proposal was to double the salary of the managing director of a company. The chairman was the father of the managing director. Family had significant shareholdings, but it was a listed entity. Company had done very badly. The sector had done very well. It was not a sectoral problem. It was a company-specific problem, and they wanted to double the salary. We as Unit Trust had 2% shareholding. We sent word that we will oppose the resolution. The chairman flew down here, he met me and he said, so you can oppose it if you want. You have 2%, the resolution will go through. I have spoken to other Indian institutional investors, they have agreed. I said, fair enough, you defeat us, we will vote. He said, then what will you do? I said, we'll release it to the papers on why we voted against this. That's all we will do. Your resolution will go through. He withdrew the resolution. So we've had instances off and on where an institution actually stood up and got counted in the process. Not enough. We need to do more of that. I would say this lastly, activism is good. What you see in the US on occasion is adventurism. We must draw that line. That's very clear. Yeah.
So on a related note, how do you view this whole Hindenburg episode? It's just 48 hours since they have shut shop.
Yes.
How do you view such companies and their interventions?
Well, I read that long message that he sent to people that had worked with him and his stakeholders. He said a lot of things there. But why did he say this now, not 3 months earlier or 6 months later? Was there a reason? We don't know. Nothing is coming out of that. That suddenly one fine day, is it that somebody gets into a business, makes money and says, I've had enough, too many headaches here, I'm leaving? Are there other pressures? We don't know. But there are people who say, and I saw one fairly well-regarded analyst who's made this statement, okay, short selling is not such a great thing. He might not have done short selling is not bad, but he might not have conducted himself well as a short seller. But some of his research findings you shouldn't just discard. Maybe you need to look at the research findings. So Gandhiji once said he got a letter full of abuse written in longhand. Gandhiji's time nobody used typewriters, I suspect, but written in longhand. And there were no staplers, so there was one pin which was tied to that. And Nehru was sitting in front of him. Nehru read it. Nehru was a fair complexioned person. He turned beetroot red when he read this particular thing. And then he asked Gandhiji, so what are you going to do about this? Gandhiji patiently removed that pin. And those days we had those pin cushions with a lot of stuff in this. I can notice some of the senior people in the audience shaking heads. So Gandhiji removed the pin, put it in the pin cushion and threw the rest in the waste paper basket. And Nehru said, why did you do that? He said, I have extracted the only thing of value in that. Right? So maybe there is something in this report that you can extract, you can use, maybe not specific to the case that he covered, maybe the other issues you can look at. Look for what you can find which is valuable, junk the rest.
We have 3 minutes. Are you okay to take a couple of questions from the audience?
I'm happy to, yes.
Any questions from the audience? Get a mic across. Please raise your hand if you have a question.
Good evening, sir. Sneha from Mint. So you've been through the entire Satyam scam and, you were at the top of it. We're seeing that increasingly corporate governance, not just in public sector, publicly listed companies, but there are these unlisted companies where a lot of VC and PE investments have flown in. Ideally, one would expect that wherever institutional investors like PE and VC are there, corporate governance standards would be top notch. But we are seeing a lot of those companies, coming out with, whatever has been reported. So what is your view on that, and how can we improve corporate governance standards in these unlisted companies? Because they would eventually make it to the public markets.
First, a point of detail. The Satyam problem manifested itself good 10, 11 months after I left SEBI. So it was not on my watch that it blew up. It must have been actually cooking there, unnoticed by anybody, including analysts, including people like yourselves who look at the corporate sector. Nobody seemed to know what was happening. There seemed to have been a kind of a lid. Now, what went wrong there? What went wrong there was that the board of directors didn't ask the right questions. Those that were looking at the financial statements did not ask the questions. There was 7,000 odd crores reportedly sitting in the books, which money did not exist. Nobody asked, where is this money? What are you proposing to do with it? Because if an IT company has 7,000 crores, they'll either make an acquisition or at least give it to the guy in charge of treasury to make some money on that. Not make an entry there and let it lie around. The auditors didn't ask. Nobody asked these questions. So the failure was not a system. The failure was that some individuals took liberties with the system, thinking that they wouldn't get caught out. And when you look at the composition of the board, person for person, the Satyam board was among the best in India. You had people who were eminent scientists. There's a professor of corporate governance from Harvard. He continued to teach corporate governance after the Satyam problem also, but that's another matter. So the board did not, and what happened? You see, when you constitute a board, in any company, more than 50% of the problem is board composition. If a board is constituted well, many of your problems will be addressed automatically. So there is an expression in English literature on governance, which is flower vase directors, those that bring color to the boardroom, but don't necessarily add value. In fact, long ago I had recommended that when you look at these people, go by the warning of the mutual fund industry, don't look at their past lives, because past performance is no guarantee of future returns. That is something you need to look at when you induct people who in their previous lives have been great. And that was the problem there.
Thank you. One final question because time's up. Who is better suited to head financial sector regulators? Who is better suited to head financial sector regulators, private sector leaders or government officials?
A good person. Let me elaborate. I'm not getting away just like that easily. You've had great regulators from the government sector. If you look at banking, for example, I will take a name. Dr. Venugopal Reddy was a government officer who went to the Reserve Bank as deputy governor, then became governor. I know some of the steps that he took were very unpopular with some people. And one editor of a newspaper described the Reserve Bank of India as the reverse Bank of India. They said things are going backwards. But when the crisis blew over, the international crisis, India was the last man standing. The rest had fallen by the wayside, or maybe nearly the last man standing, because one governor decided, I am not seeking a popularity vote here. I am doing what I think is right. Came from the government sector. You had people from the private sector who've done equally well, right? So I don't think it's a question of where they come from. It's a question of why you're selecting a particular person. What attributes does that person bring? Is there a sense of balance? Is there a temperament that is suited to a regulatory position? Because some very great people might not be temperamentally suited. So you can't get people to. The best football players are not the best football referees. I mean, let me put it that way.
Thank you, Mr. Damodaran. Ladies and gentlemen, Mr. Damodaran, please give a big hand.
Ravi, please do the honors and please present this token of gratitude to Mr. Damodaran. Thank you so much, sir, for talking to us straight from the heart. Thank you. And gentlemen, please stay with me on stage. Gentlemen, please stay with me. Ladies and gentlemen, we have come to the grand finale of today's program, the Mint BFSI Awards. Tonight we're here to celebrate the creme de la creme of India's financial services industry. It is a night that honors not just those who achieve greatness, but also those who've set the bar very high for the rest of the industry. So whether in the world of banking, finance, insurance, or mutual funds, this evening is to salute your incredible contribution. The awards in the second edition this year goes across banks, non-banks, insurance companies, and even mutual funds. We are thankful to our knowledge partners for their unwavering commitment and their exceptional quality of work. Thank you, Mr. Narayan. Have a good evening. To deliver perhaps the most robust methodology for awarding the financial services industry. Big thank you to Avinash Singh of howindialives.com and his team, and special thanks to Neerav Karkera and his team at FISDM. We're also deeply grateful to our jury members. They spared their time and they gave us the privilege of their knowledge, most importantly, their expertise. Our jury members were Mr. K.K. Mistry, Additional and Non-Executive Director, HDFC Bank, Ms. Nitya Iswaran, Managing Director, Multiples Alternate Asset Management, Mr. Tarun Chugh, Managing Director and CEO, Bajaj Allianz Life Insurance, Mr. Amish Mehta, Managing Director and CEO, CRISIL. In fact, Ms. Nitya Iswaran and Mr. Tarun Chugh are with us here in the room, and I'm going to request you to please join us on stage for the award ceremony. And ladies and gentlemen, let's give a thunderous applause to our jury members, even those who are not in the room. Thank you for working tirelessly to put this list together. So, you know, for this segment of the Mint BFSI Summit and Awards, you're not just an audience, you are participants, and you're going to actively participate by cheering and applauding for one another, because that's what a community is all about, right? So here we go, our first category, Best Small Mutual Fund. And ladies and gentlemen, the award goes to Bank of India Mutual Fund. Their dedication to providing small investors with quality opportunities has made them totally stand out in a crowded market. Let's hear it for them once again. Mr. Mohit Bhatia, CEO of Bank of India Mutual Fund, is receiving this prestigious award. Many congratulations, sir. The next category is Best Mid-Sized Mutual Fund. Ladies and gentlemen, please put your hands together, because the award goes to PPFAS Mutual Fund for its investor-centric approach and consistent performance. Mr. Neil Parag Parekh, Chairman and CEO, is here with us tonight to accept this esteemed award. Let's give it up for PPFAS Mutual Fund. And next we have the Best Large Mutual Fund, a category that celebrates excellence in fund management. This year, the award goes to Kotak Mutual Fund. Mr. Nilesh Shah, Group President and Managing Director of Kotak Mutual Fund, is here with us with his colleague. Their leadership and expertise have delivered outstanding results for their investors. Let's hear it once again. Kotak Mutual Fund it is. Many congratulations. And now we turn to the life insurance sector, where we have two incredible winners. The best mid-sized life insurer this evening, ladies and gentlemen, is Tata AIA Life Insurance. Mr. Harshad Patil, EVP and CIO of Tata AIA Life Insurance, is here. They've consistently delivered excellence in life insurance solutions with an unwavering focus on customer trust. One more round of applause, please, come on. And now let's prepare to welcome the awardee for Best Large Life Insurer. This award goes to SBI Life Insurance. Mr. M. Anand, President of SBI Life Insurance, is with us. Continues to be a trusted name. Many congratulations, sir. In the general insurance category, the best mid-sized general insurer award is earned tonight by Universal Sompo General Insurance. Rishan Rai, Chief Risk Officer, is here with his colleague. Ladies and gentlemen, they've built a reputation for providing innovative customer-first solutions. Let's give it up for them tonight. Best mid-sized general insurer. The next award, Best Large General Insurer, goes to Bajaj Allianz General Insurance. Mr. Satish Kedia and Mr. Kapil Pelwan is here with us. Mr. Kedia is the President and Head of the Corporate Business Group and Liability Business. And Mr. Pelwan is Executive Vice President and Head of Internal Audit of Bajaj Allianz General Insurance. Everybody, can I see you clap to the beat of the music? Come on. Our next category is called Best Health Insurer. And in this category tonight, ladies and gentlemen, we are thrilled to celebrate Niva Bupa Health Insurance. Mr. Nimish Agarwal, Chief Marketing Officer, Niva Bupa Health Insurance, is here with us. continuously setting the standard in providing accessible and affordable healthcare coverage for all. Many congratulations to Niva Bupa, ladies and gentlemen. Come on, keep the claps going. Okay. In the NBFC space, we have a set of truly standout winners. The best small NBFC, ladies and gentlemen, is none other than 5-Star Business Finance. Mr. Rangarajan Krishnan, Joint Managing Director and CEO of 5-Star Business Finance, is here. Making a name for themselves for their unique approach to small business financing. Let's hear it for them. Okay, moving on. The best mid-sized NBFC award tonight goes to Credila Financial Service. Mr. Arijit Sanyal, Managing Director and CEO of Credila Financial Services, is here with us. Many congratulations to you and your team. Their expertise in educational loans has been transforming the future of students across India. Talia dosto, come on. Let's keep the energy going. Few more awards to go. Thank you. And for the best large NBFC, the deserving recipient tonight is Bajaj Finance. Mr. Purav Zaveri, President Investments, Bajaj Finserv Limited, is here. Ladies and gentlemen, their growth and innovation in the NBFC sector are nothing short of remarkable. Let's hear it for them. Moving on with a big round of applause, let's welcome the awardee for the best small finance bank. It is AU Small Finance Bank. Mr. Sanjay Agarwal, Founder, Managing Director and CEO of AU Small Finance Bank, is here. They've mastered the art of personalized banking with a focus on financial inclusion and accessibility. Many, many congratulations to AU Small Finance Bank. Next, we have the award that's titled Best Mid-Sized Bank. And this award tonight goes to IDFC First Bank. Mr. V. Vaidyanathan, Managing Director, CEO of IDFC First Bank. They've made their mark by redefining what it means to be a mid-sized institution offering exceptional services with a personal touch. Let's cheer for them, everybody. Okay, Mr. Vedanathan, congratulations to you and your team. And all the winners, please stay in the room, all right? Please stay in the room. We've got literally one last award to go. Yes, last but certainly very, very important. It's called the Best Large Bank Award. And ladies and gentlemen, the winner is none other than ICICI Bank. Mr. Sandeep Batra, Executive Director of ICICI Bank, is here. A name that's synonymous with banking excellence. Their unwavering commitment to service and innovation has solidified their position as a leader. A thunderous round of applause, everybody. Come on. And sir, I'm going to request you to stay with me as I invite all the other winners. Please walk onto the stage with your awards in your hand. It's the perfect moment for us to capture and freeze in time forever. One last thing you got to do before I say the bar is open. Come on, make it quick, everybody. It's our shared success and a shared celebration that resounds in this room. Each and every person in the room knows what it takes for an organization and a team to make it to the list, to make it to the stage. I don't know who's going to clap because everybody's busy taking a photograph, but in case you don't have a camera in your hands, ladies and gentlemen, come on, give it your all. Winners of the Mint BFSI Awards 2025. All right, we've got our best shot. Thank you, everybody. Many congratulations to all of the winners. We'd like to take this moment to thank our partners, Zafin, JSA Advocates and Solicitors, Airtel Payment Bank, HDFC Pension, NetApp, Equirus Capital, Axis Max Life Insurance, our awards knowledge partners, HowIndiaLives.com, and FISDIM. It's time to raise a toast to the champions of this evening, and so with great joy I say, the bar is open.
Fine rooms at Westin Hotels.